I was really scared of this standard as a student, and during our days this used to be a part of CA intermediate syllabus, and bad luck you call it. Just before our attempt they revised the standard and they made it really complex, from about 15 pages to about 70 pages, really complex topics, difficult to understand at that level. It was only when I started working I understood that if the logic of the standard is understood, then this standard is not at all difficult. And for a lot of students, this standard appears to be in Greek and Latin, this standard appears to be a bouncer because they are not able to connect the logic of the standard with the real life scenarios. Now, I worked as an employee, I have done the accounting for employees benefits, I am also an employer now. Because of these experiences, I am able to connect the standard with the real life. And let me tell you friends, if you understand the logic, if you are able to connect the dots, this standard becomes a lot more simpler. It is not really complex. Yes, the terminologies are difficult, the standard is very lengthy, there are a lot of accounting treatments, but then with the right logic, you will be able to understand this standard and you will actually start loving this standard. So what are you waiting for? We are giving out the entire standard for free, and in this there are some special things as well. I will be discussing about my first CTC and the relation with take home, the number of leaves that I used to get, right, and how do we connect that with the accounting. All of these things are discussed here. All the illustrations are covered, fully animated videos. Watch as many times as you want and share it with your friends, and do let us know how did you like this standard in the comments box, and don't forget to subscribe to our channel. So what are you waiting for? The entire standard, please watch it, make your concepts absolutely clear so that you are not scared in the examination and you are not confused when you are working in your real life. Thank you.
To keep yourself updated, subscribe to Indigolearn and click the bell icon, and download our app OneFin to start learning on the go.
Friends, today we will start Ind AS 19 that deals with employee benefits. Now this standard you are getting introduced for the first time. The corresponding standard is Accounting Standard 15, which you did not have as a part of your syllabus at your CA inter level. We had at our times AS 15, and this was one another standard which was a headache. Like we had problems with AS 19, we also had lots of problems with Accounting Standard 15. Now again here it deals with a simple concept called employee benefits, but again lots of complexities around it. And if you understand the underlying logics and concepts, again this standard will not be difficult. If you try to memorize this, if you try to just keep on learning and by hearting things here, it will be difficult because this also is a lengthy standard as Ind AS 116. So this is equally lengthy, this is equally complex, but if you understand the underlying logic and approach, then this standard will not be difficult for you, right? Now, what are employee benefits? See, there is an employer, there is an employee. What does the employee do? Employee provides some services to the employer, right? Now, in return, the employer will provide some benefit to the employee. A simple example could be, employee works for an organization, the organization pays salary. As simple as that. This is the salary which is paid by the employer to the employee is nothing but an employee benefit. Now again, you would say, simple, right? Salary account debit to cash or bank. I wish it was so simple, but there are lots of aspects to these employee benefits. If you can recall what you learned in your income tax at your CA inter level, income under the head salaries, there were so many components as a part of salary. Not only basic salary, you had dearness allowance, you had house rent allowance, you had transport allowance, you have driver allowance, housekeeper allowance, you had gratuity, superannuation, so many components as a part of the salary. And that is where breaking down these components, understanding these components and how to account for them becomes very important. Okay, it's not just a monthly fixed payment which is made by the employer to the employee. There are many components which can form a part of this salary. So if I have to give you my own example, when I joined Bharat Petroleum, so Bharat Petroleum was the employer, I was the employee. Now there is an employer-employee relationship, and I will provide some service on a monthly basis to the employer. Whatever the employer asks me to do, I have to do that. And the employer in turn would provide me some benefits in form of compensation, right? So if I have to run you through the compensation breakdown, when we joined when we attended the campus interviews and when offer letter was given, the CTC was close to 12 lakhs, and it was, very exciting for us. Like, we're getting a CTC of 12 lakhs. Wow, it was such a wonderful moment at that point in time. Then as we went into induction, the HR session was the most important session for us because we wanted to understand, okay, CTC is so much, but how much will we get in hand? That was also relevant. So, and as we attended the induction session with the HR, then we got to know the various components which are a part of our CTC that was offered to us. So if I have to just run you through those components, we had something called basic pay, and the basic pay was 30,000. Okay. Then we had something called the dearness allowance. Dearness allowance, this generally is given, by traditional manufacturing or PSUs. Okay, you will not see this much in a private company. Dearness allowance was 2/3 of the basic pay. So 30,000 was the basic pay. Dearness allowance was 20,000. Okay. 30 plus 20 makes it 50. Then we had something called HRA, house rent allowance, right? Because we are posted in a metro city, the house rent allowance was 50% of basic pay. So 50% of basic pay came out to 15,000, right? That was our house rent allowance portion. Then apart from that, one of the component which the company included as a part of CTC was retirement benefits. The company said 50% of your basic plus DA, that is for a basic salary, that is 30 plus DA, which is 20, 30% of that is your retirement benefit related portion, right? Now 30% of that comes to how much? 30% of 50,000 worked out to 15,000. Now what were included in that? It included a 12% of basic plus DA as a PF contribution. So you would have learned about PF, right? 12% of our basic plus DA, so which worked out to 6,000, that the employer would contribute to a provident fund. It was a recognized provident fund managed by the company itself. There was a trust inside the company, right? So 6,000 would be contributed to a PF fund. Then it also included a portion of gratuity in that. Now what is that gratuity? You would have learned, right? For every completed year of service, let us say the company pays 15 days of salary. Okay, that portion is also included in your overall retirement benefits. Then the balance pertains to your superannuation benefits, that is pension and other benefits that the company would be paying. Okay, these were the three components which pertain to retirement benefits. Now out of this, PF contribution was straightforward. 6,000 is what the company contributes, and that will be contributed or credited to our account when we resign, or after specified rules under the PF, we could withdraw that amount, right? So that was very clear. But the catch was gratuity will be paid after you complete 5 years of service. So they included it as a part of the CTC, because if an employee works for 5 years, the company has to pay. What if the employee leaves within 2 years? Then the company is not needed to pay. And for us, if we left the company in 2 years' time, gratuity was lost. We would not get any gratuity. It was told that it's part of your CTC, but it does not come to your hand. Then other superannuation benefits would be paid if you work in the company for 15 years. So if you don't work in the company for 15 years, even that is lost. So out of that 15,000, what was relevant immediately for us was only that 6,000 which we would get after every month credited to our PF account, right? That was given. Then we had other allowances, some around 8,000, then asset on hire 2,000, right? And some other benefits, something like you can book a holiday home in Goa which is on the beach, and you just need to pay 1,000 rupees for that, right? Such kind of benefits were also provided, and they included that as a part of CTC. Okay, apart from this, there was also a component called annual performance bonus. The maximum ceiling was 10,000 per month. So maximum ceiling was 1,20,000. 10,000 per month is what we were entitled to if you perform well. That was also a part of the CTC. You will get, whether you will get or not get would depend on your performance. And if you leave within 6 months, you will not even get that. Okay. Then another interesting component was something called paid leaves. The company said every month you are entitled to 3 paid leaves. Over and above your casual leaves, you are entitled to 3 paid leaves. Now, what is the meaning of these 3 paid leaves? If you want to take those leaves, you can take in the current month. If you don't want, we'll carry it forward to the next month and so on, or to the next year. And even after that, if you don't take, you can actually encash it. We said, wow. So if you want, you can take those leaves. Let us say I did not take a single leave in the first month. Those 3 days, actually I can encash. I can encash in the same month, I can encash in the next month, I can encash when I am leaving the company, but I can encash whenever I want. So there was this component called paid leave, and the value attributed to that was 5,000. That was also included as a part of CTC. What if I take the leaves? If I take the leaves, I will not get that encashment benefit. But then, how is it a benefit to the employee? See, it is a benefit to me because I am not working for 3 days, but still I am getting a full month salary, right? So that is an indirect way of compensating an employee. All this put together was a part of our CTC. Now, the key question that we had was, fine, this is our CTC, how much will we get in hand? See, that is very important, right? See, there is one component called CTC, cost to the company. What will we get in hand? And because it was our first job, how much will we get in hand was very, very important to us. Like when you join an articleship firm, you'll ask, right, how much is the stipend? Whether it is 1,500, 2,500, 3,500, whatever it is, that stipend is valuable. Similarly, for the first job, the in-hand salary was also equally valuable for us. So we asked the HR, how much will be the in-hand salary? So the HR said, okay, you will get the basic, you will get the DA, you will get the HRA, then you will get the other allowances, right? All this put together, 30,000 plus 20, 50, 50 plus another 15, 65 plus 8, 73,000 minus your contribution of PF 12%, 6,000 will deduct that, and will deduct tax of some around approximately 9,000, some professional tax would be deducted. So whatever you get in hand will be around 57,800, right? That will be the in-hand salary. We are like, you said CTC of 12 lakhs at campus placement, and today you are saying in-hand salary is only 57,800. Why didn't you tell us at that point of time? He said, you never asked us. So, very important for you also, whenever you get an offer letter in hand, please check what is the CTC and what is your in-hand salary, because there will be a lot of things which you will not get if you don't work with the company for 5 years or 15 years, right? So, for us, if you don't work for 5 years, gratuity is gone. If you don't work for 15 years, other retirement benefit is gone. If you don't buy an asset on hire, that 2,000 is also gone, okay? Leave you will get when you encash it. So, it became very difficult for us to reconcile the fact that CTC was so high and in-hand salary was so low, okay? Now, the reason why I am giving you this example is not to tell you how to choose an employment or how to analyze the CTC. What I am trying to bring forward to you is, there is a component which the company paid me on a monthly basis. The basic, the DA, the HRA, the other allowances was paid to me on a monthly basis. For this, accounting is pretty simple, because every month the company pays me salary. I will say salary account debit to salaries payable, to tax payable or TDS payable, to PF payable, to PT payable. This is a monthly entry. Now, this PF payable, which is my contribution, employee's contribution, is something which the company has deducted from my salary, and the company will contribute to the PF authorities or the PF trust. There is another component which was setting with the retirement benefits of that 30%. Company will pay from its own pocket. So what is happening here? From my pocket, I am contributing 6,000. From company's pocket, company is contributing another 6,000. Now, the important question is, how do you account for this? That is what we will be understanding in this standard, right? So this is one aspect. The other important aspect is, I told you something about gratuity. Okay, when will the gratuity be paid? Gratuity will be paid if I work for 5 years. Let us say we are at year 1. I joined in at the beginning of year 1. So, year 1, year 2, year 3, year 4, year 5. If I work for these 5 years and then I let us say resign, I will get gratuity. Okay, now how will the gratuity be computed? Let us say 15 days of last drawn salary. Okay, 15 days of last drawn salary. At the end of 5 years, the company will pay me gratuity. Very simple. Now, the important question that you need to ask is, why am I getting gratuity? I am getting this gratuity because I have worked in the company for 5 years, which means the company has received 5 years of service from me, and because of that the company is paying me gratuity at the end of 5 years. Now, service has been provided over a period of 5 years. That means the relevant cost using the matching concept should also be accounted for in the 5 years, correct? Because gratuity, let us say my last run salary, the basic plus DA at the end of 5 years is 1 lakh. On 1 lakh, I will get half month salary, 15 days by 30, will not do 15 by 26, 15 by 30. So, 50,000 is entitlement. 50,000 for 5 years becomes 2,50,000. At end of year 5, I am entitled to 2,50,000, but this 2,50,000 pertains to the 5 years of service that I have provided to the company. So, what we need to do, this 2,50,000 of expense has to be appropriately accounted in each of these years. I am not saying 50, 50, 50, 50, 50 each year. That is not what I am saying. But this 2,50,000 which is paid at the end of 5 years has to be appropriately accounting. See, by the time you have seen this timeline, something would have struck your mind that there should be some discounting also, because in year 1 if I have to account for a portion of this 2,50,000, we have to calculate the present value. Yes, that is what we will be understanding in this standard. The other component that I told about is the paid leave. How to calculate for the paid leaves, how to provide expenses for those paid leaves, even those we will be understanding, because there may be a case that employee may not take leaves at all and he works for 30 years and then he encashes it at the end of his service. In that case, will you say that the leave expense will be accounted at the end of 30 years, or for every period when the leave had accrued, we should account in the relevant period? That is also what we need to understand as a part of this standard. Then the most important thing is, I gave you example of one employee. I said I worked in Bharat Petroleum. There are 15,000 employees that work in the company. The company has to say how many employees will work, how many employees will serve the 5-year period, then they will be entitled for gratuity. And there may be cases where employees have not worked for 5 years. Some employees may work till retirement, some employees may resign in between, some employees may take leave, some may not take leave, right? All of these will impact the amount of retirement benefits that the company is paying. Simple thing like gratuity is dependent on future salary. What will be the salary for an employee who will work for 15 years in the company? That has to be estimated, okay? Let us say there is a case where an employee dies during the service in the organization. If benefits have to be paid there, then how do we estimate that? All of these things are dealt with Ind AS 19. Now, one thing, we don't need to calculate all of these things, what will be the last run salary, how many years will an employee work, how many leaves will an employee take. We are not here to calculate those things for the company. That will be done by an independent professional called actuary, okay. So, there will be actuarial valuation, there will be a professional who will be estimating all of these things. What we are interested is, how do we account for these things? That is what is covered as a part of Ind AS 19. Now, apart from this, once when we joined the company, we got to know that there is an unwritten rule that after every 10 years of completed service, the company gives a gold coin. So, let us say you complete 10 years of service, you get 10 grams of gold coin. Then let us say at your 20 years, when you complete 20 years, you get another 20 grams of gold. Then when you complete 30 years, then you get another 30 grams of gold. Now, this was not documented anywhere as a part of the employer-employee contract, but this was something which was being followed in the company, and any employee who completed 10 years of service who used to get that long service recognition called 10 grams of gold, then 20 grams of gold, then 30 grams of gold, and at the time of retirement, how many number of years you have completed, those many grams of gold would be given to the employee. Now, I think this scheme has been withdrawn because the government said that you are not allowed to compensate over and above the CPSE guidelines, but still such kind of routines were also followed in the organization, right? Now, I gave you a lot of background. What we will be understanding in this standard is, how do we account for each of these elements? See, something paid on a monthly basis, how do we account for that? Something what the organization is contributing to a fund, how do we account for that? Something what the organization has to pay like gratuity, how do we account for that? Something like this leave benefits, how do we account for that? If there are any other benefits, how do we account for that? That is what we will be understanding as a part of Ind AS 19. Okay, with this background, I think we are good to go into the standard and understand each of these aspects in details. Friends, one thing that you need to keep in mind is, unless you understand the underlying logic and this breakdown and the concept that I have explained it to you, it will be very difficult for you to relate to the standard with a practical life. See, it is not a simple salary account debit to salaries payable account entry. That is not what we are learning here. We are learning different components of benefits and how do we account for each of them. Now, having set a lot of context, let us understand what is the meaning of employee benefits as per Ind AS 19. So, employee benefits are all forms of consideration given by an entity in exchange for services rendered by employees or for the termination of employment. So, basically this entity is nothing but the employer, right? So, you have an entity, there is an employee. Now, the entity provides some consideration to this employee in exchange for services, that is services being rendered by the employee or for termination of employment. What is the meaning of termination of employment? Let us say the entity introduces a voluntary retirement scheme. They are terminating the employment of the employee before their actual retirement age, right? That could be one example of compensation paid for termination of employment. So, this is what is meant by employee benefits. Now, when we talk about employee benefits, for this standard, employee benefits may arise out of contractual arrangements between the employee and the entity. That is, there is an employment contract. As per the employment contract, if the employer has to pay some consideration to the employee, that forms part of employee benefits. So, like your, in your offer letter of employment, you would have basic pay, HRA, all of those things, gratuity, leave entitlement, other allowances, bonuses, whatever is arising out of contract is included in employee benefit. That is the most common part of employee benefit. The other thing which is included is something which the employer is required to do as per a legislature. For example, the entity is required to pay 12% of salary as provident fund contribution. Okay, this may be included in the employment contract. Even if it is not included in the employment contract, the employer is under an obligation to make this contribution, right? Now, here first the employer will contribute to, let us say, a fund, and ultimately the fund will pay that amount to the employee. So, this also forms part of employee benefit. Apart from this, the third category is the informal arrangements. I told you about the gold coin, right? That is not written anywhere. It is not written in the employment contract. It is not a part of any of the legislature also. It is more of an informal practice, something which the company is practicing for a long period of time, and that also forms part of employee benefit. The third category, that is the informal practice, is basically a constructive obligation. The first two are the legal obligations, right? If an employer does not pay salary, the employee can sue the employer in courts of law. Similarly, under legislature, if something has to be paid, something has to be contributed, that is also a legally enforceable obligation. The third one, the informal practice, is more of a constructive obligation. Now, such constructive obligation could be, the employer running a school where the employees' dependents can come and study, or they can, enroll in that school. All of those things can be a part of the informal practice. So, the employee benefits to which this standard applies includes those provided under first one, formal plans or other formal agreements between an entity and individual employees or a group of employees or their representatives. So, what does this include? Formal agreement between employer and employee, that is covered. Or there is already a formal plan in place. There is no contract, but there is a plan in place which is formally documented by the company, that is included. Or sometimes there are negotiations between the company and, let us say, the unions of the employees, and based on that they agree to create a plan, even that is included, right? All of these are the formal category which is either created by the company or there is some form of formal agreement. The second category is under legislative requirements or through industry arrangements whereby entities are required to contribute to some national, state, industry or other multi-employer plans. So, basically the example that I gave you, a provident fund contribution, right, that is covered under this category, and by the informal practices that give rise to the constructive obligation, that is the third category. So, all of these three categories are covered as employee benefits in Ind AS 19. An entity may also provide something like an employee stock option plan or something like a share based payment which are dependent on the shares or the equity instruments of the entity. Such items are covered by Ind AS 102 which deals with share based payments, right. So, if there is a share based payment, something like an ESOP, that is not covered under Ind AS 19, but that is covered under Ind AS 102. So, when we go to Ind AS 102, share based payments, ESOP accounting, all of those things we'll understand there, that is not covered under Ind AS 19. The other thing that you need to understand is Ind AS 19 is for the entity or the employer who is providing some consideration to the employee. Now, I told you that, as with BPCL, we had a provident fund trust in-house. So, there was the organization BPCL, we had a BPCL PF trust. Now, the standard is applicable to BPCL, this standard is not applicable to BPCL trust, meaning to say the reporting requirements, the recognition requirements, the disclosure requirements of this standard is made for the employer or the entity. It is not made for the plan. See, when I say plan, here I am talking about a PF plan. There is a provident fund trust, that provident fund trust manages the PF contribution. This standard does not apply to this particular provident fund trust. So, it applies to the entity but does not apply to or does not deal with the reporting of employee benefit plans. So, if the trust has to prepare its financials, report its financial statements, it has to do it separately, not as per Ind AS 19. Let us now understand types of employee benefits as per Ind AS 19. Ind AS 19 classifies employee benefits into 4 categories: short-term employee benefits, post-employment benefits, other long-term employee benefits, and termination benefits. These are the 4 categories. First, let us understand what is the meaning of termination benefits. Organization would have something called a retirement date or a retirement age. It may be 60 years, in some private companies it may be 65 years, 62 years, right. So, what the company does is, the company says once you attain the age of, let us say, 60 years, you will have to retire, right. After that, you cannot work in the company. So, your employer-employee relationship comes to an end on the date of your retirement. Now, what is this termination benefit? Sometimes the employer may terminate the employee's services or they may terminate the employment before the usual retirement date. Let us say the company came up with a voluntary retirement scheme. Okay, so technically, if I was working in the company, I was supposed to retire in, let us say, 2040. In 2030 itself, that is 2030, they came up with a voluntary retirement scheme. That is to say, we are offering the employees choices. One choice is you can continue to work till 2040, or you can take some lump sum payment and retire from the company in 2030 itself, right. This is something called termination of employment, and if the entity is required to pay some form of benefit because of such employment termination, then those are called termination benefits. So basically, the employer may say that, the employee has a choice, if you want you can retire, or if you don't want you can continue. That is one aspect. Or maybe because of downsizing and all, the employer simply says we are curtailing our operations, we are downsizing our operations, so you will have to leave the organization. And because we are asking you to leave suddenly, we are paying you, let us say, 6 months of compensation. Okay, these kind of things may happen. For example, if there is a takeover of the company by some other company and there is a lot of employee redundancy. Redundancy means there are excess employees and the organization actually wants to terminate the employment services of some of the employees. In such cases, if the entity has to pay some benefits, it has to provide some benefits, those are called termination benefits. Okay, so if you look at the definition, termination benefits are employee benefits provided in exchange for the termination of an employee's employment as a result of. So, what is this benefit provided for? Because there is a termination of employment. And when can that happen? First case, an entity's decision to terminate employee's employment before the normal retirement date. So here, it is not an option given to the employee. It is like, we are downsizing, we are firing you, as simple as that, okay? And the employment is terminated. In return for that, if any benefit is paid, that is called termination benefit. Or an employee's decision to accept an offer of benefits in exchange for the termination of employment. This is something like a voluntary retirement scheme, okay? Now, when there is a voluntary retirement scheme, the entity makes an offer. We have this particular scheme. Employees who meet this criteria, they can accept this VRS or they can choose to work with the company. Now, someone who may be at, let us say 50 years of age and who has 10 years to retire, he'll do some calculation. I've already earned so much. I have so much of bank balance, PF balance in my account. I'll anyways get pension from the company. So, if I work for 10 years, I'll earn so much. If I leave now, I'll get a lump sum payment, and with that lump sum payment, maybe I can enjoy life, I can spend time with my family. So, some employees, they choose to accept this VRS, and some of them may think, I'll take VRS from this company and I'll start working in some other company, or I'll take up some consultancy job, right? Things like that. So, if that option is provided and the employee accepts a benefit in return for termination of employment, so that is what is about termination benefit. Now, coming to the other three plans. The first one we said is a short-term employee benefit plan. Now, what does this short-term employee benefit plan means? By the name itself, it is very clear. It is a form of benefit provided in the short term. Now, what is this short term? Say for example, employee provided services in year 1. If the benefit is payable within 12 months after end of year 1, that is called short-term employee benefit. For example, monthly salary. When is monthly salary paid? Maybe at the end of each month or at the beginning of the next month. Okay, that is paid before 12 months from the end of the period in which the employee renders services. That is to say, employee, let us say, works in April month. Salary will be paid either on 30th April or on 1st of May. Okay, it is paid within 12 months from the end of the period in which the service is being rendered. So, this is called a short-term employee benefit. Now, let me tell you, as far as short-term employee benefit is concerned, the accounting is very, very simple. Why? Because we know that some benefit has to be paid. It has to be paid within 12 months from the end of the period in which the employee renders the service. So, the accounting treatment would be as simple as the salary account debit or salary expense debit to salary payable, right? That is how you will account for it. No discounting, no need of actual valuation, nothing. Short-term employee benefits are pretty straightforward, right? Now, let us say a company also has something called a bonus plan, annual bonus plan. Okay. Now, I have worked in the company for year 1. The company is happy with my performance and the company said, okay, we will pay you that 1,20,000 of bonus. Okay. But when will that bonus be paid? Now, that bonus pertains to year 1. That bonus pertains to year 1, but that will not be paid in year 1. Generally, it is paid in the next year, that is year 2. And generally, because the entity wants to take benefit in the income tax, and if you remember the provisions of section 43B, you would know that this bonus are generally paid before the due date of filing return. Okay, in some cases they may pay after also, but generally to get that income tax reduction benefit, they would pay within 6 months period. They can pay later also, there is no harm in that. So, year 1 bonus is paid, let us say, on 31st of August of year 2. When will we do the accounting for bonus? When will we recognize this bonus in the books? We will recognize that bonus in year 1. We will not recognize it in year 2 because it is a bonus pertaining to service rendered in year 1. So, that payable entry, salary expense, that is bonus, to bonus payable will be accounted for in year 1, and in year 2 that will be paid. Is this a short-term benefit? Yes, this is also a short-term benefit. Anything which is paid any benefit which is paid within 12 months from the end of the period in which the services are rendered, then that is called a short-term employee benefit. So when I say anything paid for services means it has to be in relation to that particular service which is rendered in year 1. Now that was about short-term employee benefits. The next thing is post-employment benefit. What is this post-employment benefit? If you remember the breakup of CTC that I explained to you, there was something called as gratuity payment. When would the gratuity be paid? Gratuity would be paid only when the employment gets over, either retire or resign. Before that, gratuity will not be paid. So, let us say I worked in year 1, year 2, year 3, year 4, year 5, and after the 5th year I have resigned. Then that gratuity is payable. Okay, so the gratuity which is paid post the employment. It is not paid during the employment. Whereas if you look at the short term benefits, they are paid during the employment as well, right? But post employment benefit are paid only after the termination of employment or only after the completion of employment. Either you resign or retire, you are fired, whatever it is, only after that point you will be made those payments. Those are called post-employment benefits. For something, like pension, post-retirement which is paid, right? That is also a post-employment benefit. In some cases, companies also provide post-retirement, some facilities like medical facilities, some, healthcare facilities, education facilities for children and all of that thing. Those are also post-employment benefits. Then apart from this, we have something called as other long-term benefits. Now what are these other long-term benefits? These are those benefits which are neither short-term, they are not post-employment benefit, they are also not termination benefit. That residual category is the other long-term benefits. What could this example be? Something like the gold coin example that I gave you, right? That is not a short-term benefit definitely, because it is not payable within 12 months of the completion of service. You have to complete 10 years of service, right? Then it is not a post-employment benefit also, because it is paid during the employment. So that gold coin can be classified as a other long-term employee benefit, right? So having understood this, let us look at the definitions of each one of them. Short-term employee benefits are employee benefits other than termination benefit. So if it is a termination benefit, you will categorize that as termination benefit. So you will not classify them as short-term benefit. Short-term employee benefits are employee benefits that are expected to be settled wholly, means fully, not even partly, wholly before 12 months after the end of the annual reporting period in which the employees render the related service, right? As I told you, your normal salary, your the dearness allowance, your HRA, all of those things are paid within 12 months from end of the annual reporting period is called a short-term employee benefit. Then post-employee benefits are employee benefits other than termination benefit and short-term employee benefits. So if it is a short-term employee benefit, you will not classify that as a post-employment benefit, okay? And if it is a termination benefit, that also will not call it as a post-employment benefit, that are payable after the completion of employment. So whatever is payable after the completion of employment, then that is called post-employment benefit. Then other long-term benefits are all employee benefits other than short-term employee benefits, post-employment benefits and termination benefits. That's the residual category, and we have already seen the definition of termination benefits, right? So these are the 4 categories of employee benefits as per Ind AS 19. Now if you look at short-term employee benefits, as I told you, accounting is pretty simple. Why? Because the period in which the services are rendered, the expense for that will be booked in that period and corresponding liability would be booked. When it comes to termination benefit, there also accounting is simple, because once you have decided to terminate the employment, then there is a liability which arises that will be also accounted in the period in which the termination occurs. That is also pretty simple. The challenge would be to account for post-employment benefit and other long-term employee benefits. That is what is covered in the large part of this particular standard, right? That is where you have to pay extra attention and focus in understanding. Now, as a part of this standard, under each of the categories, we will understand how to recognize, measure and present. That is to say, you will understand the recognition, measurement and presentation aspects related to short-term benefits, post-employment benefits, other long-term employee benefits and termination benefits, right? The short-term one is most straightforward one, where you just need to book an expense and create a liability. That is the simplest one. A lot of effort will have to be put in to understand the post-employment benefits and other long-term benefits. Termination benefits, as I told you again, is a simpler one to understand, right? So first, let us understand how do we recognize, measure and present short-term employee benefits. Now here, we'll understand generally what would be the treatment for short-term employee benefits. Then we'll understand specific aspects related to paid absences, that is the paid leave related part, and the profit sharing plan or bonus related part. Okay, these two will need some more in-depth understanding, and we'll also understand what is the general recognition, measurement and presentation criteria. Let us now understand the accounting treatment for short-term employee benefits. As I already told you, it will have two components, one expense, other one is a liability. Now, sometimes some other standard require that employee benefits are added to a cost of an asset. For example, Ind AS 2, you will have to add wages to the cost of inventory, or Ind AS 16, add the cost of employee expense to the item of property, plant and equipment. In such cases, you will not expense it, but you will add it to the cost of inventory or cost of PB or cost of any other asset, right? So that is one aspect you need to understand. So one side you will have a debit item, which is debit the expense or an asset, and other side you will have an item where you will credit the liability. So say an entity pays a salary of 50,000, simple accounting entry, salary expense debit 50,000 to salaries payable 50,000. Let us say the company pays 2 months salary, that is 1 month salary for the current month, another month salary in advance, then salary expense 50, prepaid salary 50,000 to cash out bank 50,000. Okay, that is how you would pass the entry. And in the next month, when there is no salary payment, then you will adjust the prepaid salary and pass the entry like salary expense debit to prepaid salary 50,000. Okay, a simple accounting entry. One more thing, friends, the amount at which these benefits are recognized is on an undiscounted basis. That means you will not discount it. It may be possible that we are in April of year 1. Salary part is payable, let us say, in June of year 2, after 1 year from April, but within 12 months from the end of the reporting period. So in such case, you will not use discounting. Any short-term employee benefit will be recognized at their undiscounted value. There will not be any discounting, because if it is payable after 12 months of reporting period, then it will not be a short-term employee benefit at all. Okay, so that is one aspect which you need to understand. Now, having understood this, let us understand specific aspects related to paid leaves or paid absences, and then we'll move on and understand about the profit sharing plan or the bonus plan. Let us now understand short-term paid absences. Now, before that, we need to understand what is the meaning of this paid absences. Say you are undergoing your articleship training, and before writing your CA final, you need to complete your advanced ITT and other related trainings. So you have taken leave for 15 days from your office. Okay. Now, this 15 days of leave technically is not counted as leave, but you are not reporting to work during that 15 days period. Now, if your stipend is, for example, say 5,000 rupees, then for the entire month, the principal would have paid 5,000 rupees to you as stipend, right? But out of those 30 days in a month, you did not work for 15 days. You were given leave, right? You did not work for those 15 days. You were absent from the work for those 15 days period, and still you were paid for those 15 days period, right? Now, those leaves where you get paid even when you do not report to work or even when you don't work on those days are called paid absences. Now, you might be wondering, sir, why are you joking? Our principal deducts even if we don't attend office for 1 day. That is the practical aspect, but theoretically he is supposed to pay you. And don't worry, as you progress into organizations, when you join corporates, they will not deduct your salary for taking leaves, right? So the concept that you need to understand is there is an employer, there is an employee. The employee is entitled to some leaves or absences, meaning to say the employee may not report to work or the employee may not work on some days, but the employer will still pay for those days as if the employee has worked, right? This is something which is called paid absences. To understand this better, let me share with you our leave structure when we worked in BPCL. So we are entitled to Saturday, Sundays off. That is the case in most of the companies. So that was anyways off. Then 14 national holidays. Now even on these 14 national holidays, the entire company used to be off, right? So that is also a part of the holiday scheme. Then we had something called casual leave. Casual leave entitlement was 1 per every month. So in effect, it used to work out to 12 days per year. So the calculation was done on a calendar year basis. So 12 days in a year, you were entitled to casual leave. Now, what is the meaning of this casual leave? I can just inform my boss that I don't want to come to office on specific days, 1 day, 2 day, 5 day. You can plan in advance, inform the boss and take off from work. Now, when I'm absent from work, my salary would not get deducted because I was entitled to these leaves. What if I don't take those 12 leaves in the calendar year? Then those leaves used to be lapsed. Lapsed meaning it is gone, it is lost. So better to take those leaves rather than allowing it to get lapsed. Then we had something called sick leaves. I don't want to get into that because it makes the discussion very complicated. Then we had something called privilege leave. Right? These privilege leaves were 3 per month or 36 per year. Now what is this privilege leave about? this privileged leave is the leave which you can take if you want. Even if you take those leaves, your salary will not get deducted. And if you do not take these leaves for whatever reasons, let's say you don't want to take those leaves, okay, you are very hardworking professional and you don't want to take leaves, you don't want to take it this year, these leaves can be carried forward to the subsequent year. So, if I did not take these leaves, or let us say out of 36 I took 6 days of leave, then balance 30 leaves would be carried forward to the next period. Balance 30 days would be carried forward to the next period. Now, what will happen in the next period? In the next period, you can take those leaves, or you can encash these leaves in the same year or in the next year. Encash means you will get 30 days of salary. So, basically, if you don't take privilege leaves, either you can encash it, either you encash it in this year or in the next year, or if you want to plan and take leaves in the next year, you can take those leaves in the next year, right? So, that was the leave encashment related thing. Now, generally people would not encash it during the service because it would be taxable. They would generally accumulate it and encash it at the time of resignation or retirement. Irrespective of the fact, whenever you encash it or whenever you take it, these were the forms of paid absences, right? The privilege leave is a paid absence, the casual leave is also a paid absence. Now, casual leave is a kind of leave which would lapse if you don't take those leaves. Whereas, the privilege leave, you could take it forward, you could carry it forward to the next period and use it then, or encash it at a future date, or encash in the same year. Whatever you want to do, it is your choice, because that is the leave which you are entitled to, okay. Now, what used to happen is, casual leaves were almost taken by everybody. Privilege leaves were taken generally on a need basis, because if you don't take those leaves, you are actually being compensated. Now, the question in your mind would be, why did I share with you all of these leaves details? Because we need to understand the accounting aspect of this. Now, first, let us understand the categorization of paid absences. One form of paid absence is an accumulating paid absence. The other one is non-accumulating paid absence. Now, what is the meaning of accumulating paid absence? Something which can be carried forward to the next period. Non-accumulating is something which would lapse if you do not take those leaves within the same period. So, casual leave is which kind of leave? Casual leave is a form of a non-accumulating paid absence. See, it is a paid absence, meaning to say, even if you are absent from the work, you get paid, but it is non-accumulating in nature. You are not entitled to carry it forward to the next period. That is non-accumulating, and one example that I just shared with you is a casual leave. The other one is accumulating paid absences. So, these are those paid absences which, if you do not take in the current period, the employee can carry it forward in the subsequent period. And let me tell you, in most of the organization, you will not find these kind of absences. Only if you go to some traditional organizations like, manufacturing entities or PSU and all of those things, that is where you get this option to carry forward the leaves. Otherwise, the other organization that I joined in, we had 24 leaves in a year. If you want, you take it. If you don't want, it will get lapsed. As simple as that. Okay. So, what are the two kinds of paid absences? One, non-accumulating, which does not accumulate, you cannot carry it forward. The second one is accumulating, which you can carry forward to the next period. Now, coming to accumulating paid absences, these are categorized into two types. The first one is vesting, the second one is non-vesting. What is the meaning of vesting? Vesting here means that the employee is entitled to a cash payment at the time of leaving the organization, or in some cases even during the course of service. So, if the accumulating paid leave absence is of the type vesting, then the employee can get cash benefits or cash payments for the accumulated leave balance. The other one is non-vesting. Now, you would have already known what is the meaning of non-vesting. Non-vesting is the one which does not entitle the employee to any form of cash payments. So, what is the difference between these two? Say for example, I am entitled to accumulating paid absences. How many? For simplicity's sake, let us say 30. Okay. Now, if I am entitled to 30 days of leave which are accumulating in nature in this period and I do not take it, I can carry it forward in the next period, I can take those leaves. Okay. Now, if the organization gives me an option to encash those balance leaves, then it is vesting. If I cannot encash them, means in the next period you have to take it. If you don't take it, you will not get any form of cash benefits. Then it becomes non-vesting. Okay. So, this is the distinction that you need to understand. When we talk about paid absences, they can be non-accumulating or accumulating. Non-accumulating means you cannot carry it forward. Accumulating means you can carry it forward. Now, if you carry it forward and you can get cash benefits, that is called vesting. if you do not get cash benefits, you have to take leaves, that is called non-vesting, right? Now, having understood this concept of various types of paid absences, let us understand the underlying logic of the accounting treatment, because a lot of time I have seen students struggling to understand the logic as to why do we account for leaves in this way, or what is the need to account for leaves. Okay, see, I can teach you the journal entries, you can by heart the journal entries, you can by heart the way it has to be computed, and then you can reproduce that in the examination, but I think that will not do justice. You need to understand as to why and how we need to do the accounting for leaves. Now, coming to the accounting aspects, let us first take non-accumulating paid absences. Now, these are the leaves or these are the absences which do not get carried forward, which means the employee is not entitled to any form of additional benefit in the future. Whatever is the salary paid in the current period, that takes care of the non-accumulating paid absences. What do I mean by that? See, we were entitled to 12 casual leaves. If we take 12 casual leaves, also we'll get full year salary. If we don't take these 12 casual leaves, also we'll get full year salary, and these leaves does not entitle me as an employee to take leaves in the future. So, there is no benefit which will be provided in the future. Whatever has to be provided, whatever is paid as a part of the salary, that considers that this employee would take 12 days of leave, right? So, let us say for example, the salary is 1 lakh per month, the salary expense of 12 lakhs per year would automatically take care of this non-accumulating paid absences, right? Like in the case of the stipend that I told you, the payment of 5,000 of stipend takes care of those 15 days paid absences as well, right? So, there is no need to recognize any additional expense or any additional liabilities. The complexity comes, or the accounting aspects become more interesting when we come to accumulated paid absences. When it comes to accumulated paid absences. Now, what happens here? If let us say for example, I am entitled to 1 month of accumulated paid absences or 1 month of privilege leave. Okay, I am taking 1 month so that the accounting entries and the understanding becomes much clearer, right? Now, what is the meaning of me being eligible for 1 month of accumulated paid absences, or let me call it privilege leave? What is the meaning of that? It means that if I take those 1 month of leave in this period, then the employer would pay me 12 months of salary. The employer will not deduct any salary from me. So, say the salary is 1 lakh per month. For first year, I am entitled to how many months of salary? 12 months of salary. That comes to 12 lakhs. Okay. I am entitled to 1 month of privilege leave. Now, if I take this 1 month of privilege leave in the first year, then how much salary will I get? I will still get 12 months of salary. I will get entire 12 lakhs as my salary. So, if I have already taken that leave, then the salary part automatically takes care of the expense related to accumulated paid absences. But say for example, I did not take those privilege leaves. I did not take those 1 month of privilege leave. Okay. Now, because I did not take 1 month of privilege leave, what happened in the first year? In the first year, I got 12 months of salary. I will not get 13 months of salary. Okay. Unless I encash it, I will not get the extra 1 month salary. I have not encashed it, kept it with me as my balance leave, and still in year 1 I got 12 months of salary, 12 lakhs. Okay, that is the first part. Now let us say we come to year 2. In year 2 also, assume for a moment my salary is 1 lakh per month. If I work for 12 months, I will anyways get 12 lakhs. But say for example, I took 2 months of leave. How 2 months? 1 month carry forward and the second month entitlement of year 2. So I took 2 months of leave. So effectively, how many months did I work? I worked for 10 months only. Even though I worked for 10 months, I got 12 lakhs of salary because I had carried forward 1 month of leave from the previous period and utilized that in the current period. Now see the disparity. If I just do the accounting as it is, what would happen? In the first year, employee worked for 12 months, salary expense was 12 lakhs. In the second year, employee worked for only 10 months, even then the salary expense comes to 12 lakhs. Now here, the matching concept is not being followed. Why? Because employee who was ideally required to work 11 months in each of the year, in the first year worked 1 month extra, but we did not recognize any additional expense. In the second year, worked 1 month less. You're supposed to work for 11 months, right? I worked only for 10 months. Even then, the salary expense was being recognized at 12 lakhs. So, what we need to do is, this additional 1 month of entitlement, what the employee is carrying forward from year 1 to year 2, for that, the employer needs to recognize a liability. Why a liability? Because in the future, employee may not work and still I need to pay for that particular month. Or if it will be encashed, let us say in the next year, the employee would encash that amount. Then in that case, the employer has to pay that amount to the employee. So, whatever are the accumulating paid absences, whether vesting or non-vesting, the employer needs to recognize a liability for the accumulated balances in the current period. So, in the first year, what the employer would do is, employee is entitled to 1 month balance, that 1 month balance is being carried forward. So, make a provision for expense for that 1 month. So, salary expense will be 13 lakhs, to bank 12 lakhs, to paid absences liability 1 lakh. Now, why this additional 1 lakh of liability? Because I have 1 month of leave balance which I can carry forward to the next period. I may use that leave in the next period, or I may encash that leave in the next period. From the employer point of view, there is an obligation. What is the obligation? To provide a benefit to the employee. What kind of benefit to the employee? Either the employee will not work and you have to pay salary, or the employee may encash. In both the cases, there is a liability which has to be recognized. So, what will be the salary expense in the first year? Salary expense will be 13 lakhs. Now, come to the second year. In the second year, I took 2 months of leave. 1 month from first year, 1 month from second year. Now, even here, salary paid will be 12 lakhs, but salary expense that will be recognized will only be 11 lakhs. How is that so? Because 12 lakhs whatever is paid, out of that 1 lakh has been provided in the previous period. So, you will debit the liability that you had created in the first year for paid absences by 1 lakh. Salary expense 11 lakhs, to bank 12 lakhs, right. So, this ensures that there is matching concept followed between the services that is being rendered by the employee and the amount that is paid to the employee. What you need to understand is, if the employee is carrying forward any form of accumulated paid absences, then there is an obligation on the employer to provide a benefit in the future. Now, benefit can come in 2 ways. One, employee will not work and still you have to pay the salary. That is a form of liability, or the employee may encash it. That is also a form of a liability which the employee will have to settle, right. So, this is why we need to account for any accumulated paid absences for a particular period. The other thing that you need to understand is, if I had taken entire leave in the first year, then there was no obligation on the employer to provide me paid absences in the future relating to the services rendered in the first year. So, in that case, there is no liability which will be recognized. So, the basic underlying concept here is, when is the service rendered, to which period is the benefit attributable, in that period you will have to recognize a liability. Let's now have a look at a couple of illustrations and understand how do we do the accounting for it. The logic I have already explained. I have also given one example with a 1 month leave thing for an employee. We will see a couple of more illustrations and then we will move ahead. Mr. Rajan is working for Infotech Limited. Consider the following particulars. Annual salary of Mr. Rajan is 30 lakhs. Okay. Total working days in year 01, year ending 1, or you can say first year, is 300 days. Leaves allowed as per policy is 10 days. Meaning to say, in the first year, you have to work 300 days. Out of those 300 days, you can take 10 days of leave. Leaves utilized by Mr. Rajan is 8 days only. So, though entitlement is for 10 days, Mr. Rajan utilized only 8 days. Unutilized leaves are settled by way of payment, and accordingly carry forward of such leaves to the subsequent period is not allowed. So, what happens here? Here, for the number of leaves that the employee has not availed, to that extent, the company will pay in the same period. So, there is no carry forward. So, there is no obligation on the employer in the future to provide additional leaves. Okay. So, carry forward is not allowed, but for those 2 days extra that is worked, that is settled in the same period. It is not that it would be lapsed. Okay. Compute the total employee benefit expense for Infotech Limited in respect of year 1. Now, this question is a pretty simple one. We need to calculate what is the salary expense. Now, here salary expense comprises of 2 parts. One, the annual salary which will be paid, which is 30 lakhs. The other, the 2 days leaves what the employee has not taken, that has to be encashed. Now, if the salary for 300 days is 30 lakhs, salary per day will be 10,000. So, salary for 2 days will be 20,000. So, what will be the total salary expense? 30 lakhs plus 20,000, 30 lakhs, 20,000, that will be the salary expense, right. Now, here there is no future liability, but that 20,000 is being encashed in the same period, and hence that becomes a part of salary expense. Now, one question that may come to your mind is, what if this leave was carried forward and was taken in the next period? If it was carried forward and taken in the next period, then the entity would still recognize a salary expense of 30 lakhs 20,000, but the payment to bank, the entry when you pass to bank would be only for 30 lakhs and balance 20,000 would be a liability for leave encashment 20,000, right? That would be the slight change. Otherwise, in the current scenario, when the leave is not being carried forward, simple entry would be salary expense 30 lakhs 20,000 to bank 30 lakhs 20,000. Let us look at another question. Mr. Niranjan is working for Infotech Limited. Consider the following particulars. Annual salary 30 lakhs both in year 1 and year 2. Working days 300 days both in year 1 and year 2. Leave allowed 10 days year 1 and year 2 same thing. Leave taken first year is 7 and next period is 13 days. Now what has happened here? If you see, 7 days of leave was taken in year 1, which means 3 days is the leave which is unutilized and carried forward. In the next period, the employee has taken a leave of 13 days. Scenario 1. Based on past experience, Infotech Limited assumes that Mr. Niranjan will avail the unutilized leave balance of 3 days of year 1 in year 2. So, whatever is the balance which the employee has not taken in year 1 will take in year 2. Okay, that is the past experience what the company is applying. Infotech contains that it will record 30 lakhs as employee benefit expense in each of year 1 and year 2, stating that the leaves will anyway be utilized by year 1, year 2. So, what is happening here? In year 1, the employee took less leaves. In year 2, the employee will take those balance leaves. And what the company is saying is, anyways, the employee is taking the leaves. We don't have to pay anything extra, right? Had they in cash, then it is a different thing. But anyways, he is taking the leaves. No extra payout. So, we will say 30 lakhs in year 1 and 30 lakhs in year 2 as expense. Comment on the accounting treatment proposed to be followed by Infotech Limited and also pass the journal entries for both this. Basically, you need to understand how do we account for this in year 1 as well as in year 2. This is similar to the example that I gave you at the beginning when we said when we understood how do we account for short-term paid absences, right? So, now here what should be done? Here, in the first year, there is a salary expense of 30 lakhs plus whatever is this excess 3 days leave which will be carried forward in the next period. For that, the entity needs to create a liability and the entity needs to recognize an expense for that. Why? Because in the next period, employee will take this 3 days leave, he will not work for 3 days and we still have to pay him salary, right? So, these 3 days liability needs to be created and carried forward. When the employee actually takes the leave in the next period, that portion of the liability would be settled. Let us see how does the computation and accounting entry look like. So, let us see how do we do the calculations and accounting for it. So, we have 2000, 20x0, x1 which is the first year and then we have 20x1, x2 which is the second year. Okay. Now, let me write the particulars here. What is the annual salary? Annual salary is 30 lakhs. Okay. What are the working days? Working days in both the cases 300, 300. So, what is the salary per day? Salary per day is nothing but 30 lakhs divided by 300, that comes to 10,000 and 10,000. So, each day the salary attributable is 10,000. Now, what has happened in the first year? In the first year, the employee has taken only 7 days leave out of 10 days leave. So, leave unutilized and carried forward is how much? 3 days in this period. In the second period, there is no unutilized leave because the employee has taken all those leaves, right? Now, what we need to do is, at the end of the period, for the balance of leave unutilized, you need to create a liability and you need to recognize an expense because the employee will be getting a benefit in the future. Again, I am repeating, the benefit can be in form of a leave encashment or the benefit can be in the form of employee not working and still getting paid, right? So, to what extent do we need to recognize an expense and create a liability? For 3 days. Now, what is the value or what is the expense attributable to 3 days or what is the salary attributable to 3 days? The salary attributable to 3 days is 10,000 per day multiplied by 3, 30,000. So, we have to create accumulated leave liability. How much is that? 10,000 multiplied by 3, 30,000. Okay. So, what is the total salary expense? Total salary expense is 30 lakhs plus 30,000, that comes to 30 lakhs 30,000. Now, the other way to understand this is, because the employee has worked 3 days extra, we are recognizing expense for those additional 3 days. We have not yet paid. Payment may happen in the future or the employee may take leaves in the future, okay. That both the scenarios are possible, but in the current period, because the employee has worked 3 days extra additional, we are recognizing that portion of expense. How has he worked 3 days extra? See, so technically number of days required to be worked was only 290. Okay. Actual number of days worked is 290 plus 3, 293, or 300 minus 7, 293. So basically the employee has worked 3 days extra, for which the employee will take 3 days of leave in the next period. So for that additional 3 days we need to recognize the liability. Now friends, what happens is at times salary of year 1 may be different from salary of year 2. So in such cases, when the salaries are different, we need to consider the salary of the period in which these leaves should be actually taken for creating a liability. For example, if in the next period salary is increased by 10%, so based on that revised salary, you need to recognize the expense and the corresponding liability. Okay. But if there is no increment expected, or we do not know what will be the increment, then based on the current salary itself we can recognize, right? So salary expense for year 1 will be 30 lakhs 30,000. How much is paid? Paid is 30 lakhs, and provision and liability for balance will be 30 lakhs 30 minus 30 lakhs, which gives you 30,000. Right? So 30,000 is the liability for balance. So what will be the journal entry? The journal entry will be salary expense debit by how much? By 30 lakhs 30,000 to bank, because you would have already paid, or salary payable to bank, or if you have salary payable, you can have salary payable, which is 30 lakhs, then to liability for accumulated leaves, or you can have a leave encashment liability, because if at all they encash it in the future, that is also possible. Liability for accumulated leaves is 30,000, right? This is the entry that you would pass in year 1. Now coming to year 2, what has happened? In year 2, leaves unutilized and carry forward is 0, because all the leaves have been utilized, and the number of days which was again required to be worked is 290, but he has actually worked only for 287 days. Why? Because 13 days of leave were taken. So 300 minus 13, if you do, you get 287. So basically he has worked 3 days less in year 2 because he worked 3 days extra in year 1. That is why we recognize this additional liability or additional expense for this 30,000. Basically, the employee has provided services to the organization in year 1. The organization has received the benefit of employee service in year 1. So correspondingly, liability for that would also be recognized in year 1 itself. So basically you have to match the benefit received and the liability to be created, or you can also call it the accrual concept, right? Because the salary, the additional 3 days salary had accrued in year 1 itself. So you have to recognize a liability in year 1. Now if you look at the salary expense of year 2, how much should be the salary expense? See, if he had worked for 290 days, we would have said salary expense is 30 lakhs. If he had worked for 290 days, we would have said salary expense is 30 lakhs. But he worked for 3 days less, which means 3 days of salary expense should not be recognized. How much is 3 days salary? 30,000. So the salary expense that should be recognized is 30 lakhs minus 30,000. So you'll have 29 lakhs 70,000. Pretty simple. The way it works is, in year 1 he worked 3 days extra, so we recognize 3 days extra salary. In year 2 he worked 3 days less, so we recognize 3 days lesser salary, right? Then how much is paid? See, you have paid entire 30 lakhs. How much is paid? We have paid entire 30 lakhs. Why did we pay entire 30 lakhs? Because though he took 13 days leave out of 10 days, that 3 days of leave had been brought forward from previous period. So we need to pay salary for that period also. So 30 lakhs will be the payment. Then is there any liability? There is no liability for balance. Now this is a reversal of liability created in the previous period. So your entry would be in year 2, salary expense debit. How much? Salary expense debit 29 lakh 70,000. That is the salary pertaining to year 2. I'll put it here actually. Salary expense debit 29 lakh 70,000. And to bank will be 30 lakhs itself, because we are not deducting salary. So what happens? Where do we get that balance 30,000? Basically this reversal of liability for accumulated leaves. So debit liability for accumulated leaves, which is 30 minus 2970, which gives you 30,000. Okay, you can call it provision for leave encashment, all of that. the nomenclature of account is less relevant. More important is for you to understand the underlying logic. Now, in the same thing, let me make a slight tweak. Okay, I'll just change the example slightly and see how does the accounting change in that case. Okay, so I'm just modifying the example. Assume for a moment in the next period, leave taken was 7 days in the first period. In the second period, he took only 10 days leave. He did not take 13 days leave. He took only 10 days leave and 3 leaves were carried forward. 3 leaves were carried forward. So, whatever was brought forward from year 1 is carried forward to year 2. Okay, that is one scenario. Then, number of days required to be worked is 290. Number of days actually worked also is 290. He did not take the extra leave which he had taken, which he had brought forward from year 1. In that case, what will happen to year 2 accounting? In year 1 there is no change. In year 2, this salary expense will be for full 290 days, so there will be 30 lakhs, right? And entire 30 lakhs is paid, so there is no reversal of liabilities. So, the journal entry would be salary expense debit 30 lakhs to bank 30 lakhs. This liability of 30,000 will be carried forward, Now, what if the employee encashes those 3 days of leave entitlement? That is to say, I have brought forward from year 1, I want to encash it in year 2. What will happen in that case? You'll have to pay him 30,000. So, the entry for that would be liability for accumulated leaves 30,000 to what? Because you are paying to bank 30,000, right? So, this is how you will pass the entry if those leaves are actually encashed. So, what if the salary increased and he encashed at 35,000? Then liability for accumulated leaves debit 30,000, salary expense for the balance 5,000 to bank 35,000, right? So, that is how you will pass the entry if at all the leaves are being encashed. Now, let us look at another scenario based on the same question. Based on past experience, Infotech Limited assumes that Mr. Niranjan will avail the unutilized leaves of 2 days in year 0, year 1 subsequently. Okay, so he will avail only 2 days of leave, and assume for a moment there is no encashment option. And what the company believes is he has taken only 7 days leave, and based on his past experience, past records and all of that, he will take only 2 days of unutilized leave in the next period. Okay. However, in year 1, year 2, Niranjan availed all 3 days of brought forward leave. Compute the expense to be recognized. Now, what has happened here? Management thought employee is sincere, he will work extra and he will take only 2 days leave. Employee is like, I have worked extra in year 1, I will take entire 3 days leave in year 2. Okay. Now, standing at the end of year 1, you will create a liability based on what? Based on your estimate, right? Based on what? Based on what you estimate. What did you estimate? You estimated that the employee will take 2 days leave. So, accordingly, you will create a provision only for 2 days. Now, employee actually took 3 days in the next period, that is as good as a change in estimate. Okay. So, what you need to do is at the end of year 1, we will create a liability for accumulated leaves for a 2-day period, and if he actually takes more, the balance expense will be recognized in the subsequent period. Okay. So, how it would work in scenario 2 is leave unutilized and carry forward is 3. Management estimate of leave utilization next year is only 2. Meaning to say, management thinks this employee will take only 2 days leave. So, accordingly, the additional expense that you will recognize will be for a 2-day salary only. Why not for 3 days? Anyways, I think he will work only he will take only extra 2 leaves in the next period. These leaves anyways cannot be encashed. So I will provide for salary only for those additional 2 days. So, here your accumulated leave liability will be for 10,000 multiplied by 2. Okay, right. So, though he has worked for 293 days, technically we are recognizing only 292 days of expense, because we believe he will take only 2 days leave in the next period. So, accordingly, your salary expense will be 30 lakhs 20,000, bank 30 lakhs, and to liability 20,000, right. Now, in the next period, what did our hero do? He said, I will take entire 3 days leave. Now, 2 days we had provided for in the previous period, that 1 day we did not provide. Now, that 1 day of extra leave that he has taken in the current period will be a change in estimate, and it will be the expense for the current period. So, instead of 29 lakhs 70,000 of expense, it will be 29 lakhs 80,000 of expense. 29 lakhs 70,000 for the normal expense for the period, 10,000 additional because we did not provide for it in the previous period, and the 20,000 of the liability would be reversed. So your entry will change to 29,80,000 of salary expense. This includes 29.7 plus 10,000 of provision which was not made in the previous period. Liability reversal to the extent of 20,000, to bank 30 lakhs. Right, a simple accounting treatment, but you need to understand the logic as to why are we creating a liability even though the leaves are not being encashed. If you understand that logic, then the remaining aspect is not complicated. Only thing that you need to keep in mind is how many days of leaves is the employee entitled to, how much is being utilized, how much is carry forward. Whatever is the carry forward amount, for that you will have to recognize an expense and a corresponding liability. Now, some of you may have a question as to, will the employer make records and make estimates for each employees? Imagine a company like TCS where around 5 lakhs employees are employed, right? Do you think the company will be maintaining record of, okay, this person in this department will take so many leaves in the next period and all of that? It doesn't work that way. What the management does is they make an estimate, sometimes taking the help of an actuary. Okay, we'll come to actuary later. Even for short term leaves basis, they may take the help of an actuary to decide or to determine on an average, based on past experience, based on remaining service life of the employee, how many days of leave is being will be carried forward, and on an average how many number of days of leaves would be encashed or would be taken in the next period. See, sometimes what happens is an employee has accumulated leave in the first period, maybe in the second year he resigns, and if he resigns he cannot take those leaves. Then what do we do in that case, right? So based on all of these parameters, they will estimate, okay, so many number of employees, out of these at least 5% will resign in the next year, so they will anyways not take, okay. Then of the balance, these many number of employees will take leaves, these many number of employees will not take leaves. They'll do some calculations and make estimates to arrive at what should be the liability which has to be recognized, right? So let us have a look at a question on similar lines. Sundaram Limited has a head count of 100 employees. Okay, so we are just talking about 100 employees in year 1. As per employee policy, the employees are entitled to 30 casual leaves, out of which 10 casual leaves may be carried forward to the next year. So 30 is a casual leave entitlement, 10 you can carry forward to the next year, which means 20 you cannot carry forward. Sir, what if the employee does not take those 20 leaves or doesn't take any leave at all? If he doesn't take any leave at all, 20 will lapse. 20 will lapse, no payment, no benefit, nothing. Balance 10, maybe the employee can take it in the next period, or maybe they can encash. Let us read the question. The second thing is 10 sick leaves, out of which 2 sick leaves may be carried forward as paid leave. The sick leave thing is a very funny aspect actually in organizations once you start working also. This is a leave where you don't have to give reason. Simply you send a message to your boss saying, sir, I am not well, I am unwell, I will not come to office today, and apply for a sick leave. Okay, so that is how a lot of time, even when employees are not sick, if they want to take leave, they would just say, I am sick and I will take a sick leave. Okay, because prior approval is not needed. Okay, you can fall sick, and now because of COVID times, anything can happen. The moment you say cold and cough, employer himself will say, please stay back at home, right? So 10 sick leaves, out of which 2 sick leaves may be carried forward as paid leave. So 10 sick leaves means mandatorily employee will fall sick on 8 days. Even means when I say mandatorily fall sick, actually he may not be sick, but he will take those 8 days as leave. Otherwise what will happen? It will get lapsed, right? How much can be carried forward? 2 sick leaves you can carry forward to the next period. In a lot of cases what happens is employers also make a restriction, like if you fall sick or if you take sick leave for more than 3 days, you have to get a medical certificate and all of that thing. So all of those things do happen. It will be a good experience when you join companies, right? So coming back to the question. As at 31st March of year 1, the average unused entitlement is 5 days per leave for casual leaves. Meaning to say, on an average, each employee has 5 days of casual leave left to his account. What will happen to this casual leave? It can be carried forward to the next period. And 1 day per employee for sick leave. So, on an average, 1 day per employee for sick leave. On an average, it is found that the number of such employee who would be claiming casual leaves would be 30, and 10 employees would claim sick leave. Now, what does this mean? Though on an average, 5 days of casual leaves are unclaimed, which can be carried forward for 100 employees, actually only 30 employees will use these casual leaves in the next period, and 10 employees would claim the sick leave balance. Compute the liability to be recognized in respect of sick leaves and casual leaves by the entity at the end of the financial year 1. Right? A very simple question. Once you understood the concept, calculating the amount and passing the entries is not a great deal. Now, in this question, the thing that you need to keep in mind, or the thing that you need to understand, is for what value should we create the liability, or for what number of leaves should we create the liability. Now, if you see, the total number of employees are 100, average unutilized casual leave is 5, and expectation is 30 of those employees will actually use those unutilized casual leave. Now, what you need to understand is, while creating a liability and recognizing an expense, should you consider 100 or 30? So, you will create a liability, you will make a provision based on your estimate. What is your estimate? Estimate is 30 employees. So, 30 employees will take 5 days of casual leave in the next period. So, for 150 casual leave days, you will create a liability and recognize a provision. Similarly, coming to sick leaves, there are 100 employees, average leave left is 1 day. Now, should I create for 100 sick leave days? No. Only 10 employees. So, 10 employees multiplied by 1. For 10 sick leave days, you need to create a liability, because that is what our estimate is. So, total number of days for which we will create a liability and recognize an expense will be 150 for casual leaves and 10 for sick leave. The total comes to 160 days. Let's have a look at another question. An entity has 100 employees who are each entitled to 10 working days of paid sick leave for each year. So, every year the employees can take 10 paid sick leave. Unused sick leave may be carried forward for one financial year. So, if you are not able to take sick leave in the current year because you did not fall sick, you can carry it forward to the next financial year. Sick leave is taken first out of the current year's entitlement and then out of any balance brought forward from the previous year. So, it's there and they follow a LIFO basis, which means if an employee has not taken some leaves in year 1, that will be carried forward to year 2. But if the employee takes sick leave in year 2, first you have to use the balance in year 2, only then you can use balance from year 1. Okay. As at 31st of March of year 1, the average unused entitlement is 2 days per employee. Now, what does this mean? On an average, for all the 100 employees, 2 days is the unused entitlement. Now, this unused entitlement of 2 days can be carried forward to the next period. Based on the past experience, the management expects that only 20% of the employee will use 1 day from their carry forward leave. Okay, so we have 100 employees. Out of those 100 employees, only 20%, that is 20 employees will use that to 1 day, meaning to say whatever is the unutilized balance as at year end. Now, in our case it comes out to 100 employees, it says on an average 2 days, right? So, out of those 200 unused balance, how much is carried forward? Entire 200 is carried forward, but usage will only be 20 employees and that to 1 day. So, out of 200 of unutilized balance, only 20 will be availed in the next period. Salary per day is 2,500. Compute the expenses in respect of the short-term compensated absences if they are assumed to be vested short-term compensated absences and non-vested short-term compensated absences. Now, we have understood the meaning of vested and non-vested. Vested are those which entitles to a payment. Non-vested are those which does not entitle to any form of payment, right? So, now if we assume that these leaves are vested compensated absences, means what? If the employee do not utilize those leaves in the next period, they can actually encash it. What are the two possibilities there? The first possibility is that employees would avail those leaves, and for whatever is not availed, the second possibility is that employees would encash. So, either ways, the entity is having an obligation to provide those benefit to the employees, either by allowing them leaves or by making the payment. Now, in such a situation, the entity has to create a liability for entire balance of unutilized leaves, because either the employees will take the leave or the employees will encash the leave. So, in such a situation, what would we do? We would take 100 employees, 2 days on an average. So, that accounts to 200 leaves. So, 2,500 multiplied by 200. So, 5,000 another 2 zeros, that comes to 5 lakhs. 5 lakhs is the liability that the entity should be creating, and correspondingly salary expense will also be 5 lakhs, right? That is when we assume that these sick leaves are vested compensated absences. But what if they are non-vested? Non-vested means the employee does not have a choice to encash. They have to either avail it or it will lapse. Now, what is the entity's estimation of leave availment in the next period? The question says, the management expects that only 20% of the employees will use 1 day from their carry forward leave. So, if we assume that it is non-vested, then we are bothered about only how many leaves will the employees take in the next period. The question says 20% of the employees will use, that is 20 employees, that too 1 day. So it comes to only 20 days of leave utilization in the next period. So accordingly, if it is a non-vested compensated absence, then we will create a liability only for 20 days. So 20 days multiplied by 2500, that comes to 50,000, right? Now, what you need to understand is the difference between vested and non-vested is, so when we talk about vested, for 20%, that is 20 employees and 1 day leave, that is for 20 days leave, 50,000 of liability is created, plus the balance which will be encashed. How many days are left? Out of 200, 20 are availed, 180 days are left over, right? Now for that 180 days, the entity will have to make a payment, because those leaves would be encashed. So 180 days multiplied by 2500, that comes to 4,50,000. So this is the total breakup of 5 lakhs liability. But if it is a non-vested thing, then the leave encashment option does not come forward. So the liability that you need to create is only to the extent of how many leaves will be availed in the next period, and that is only to the extent of 20 leaves, which works out to 50,000. Let's have a look at another question. Acer Limited has 350 employees, same as a year ago. So that is their employee strength. The average staff attrition rates observed during the last 10 years represents 6% per annum. Acer Limited provides the following benefits to all its employees. So the company has 350 employees and every year 6% employees leave. So attrition rate means 6% employees leave the organization, where we can assume that the entity will hire new employees to replace the existing employees. Okay. So if you look at 6% of 350, that comes to about 21 employees. So every year 21 employees would leave and fresh 21 employees would join, unless they give any other information. Reading further, Acer Limited provides the following benefits to its employees. So what are the benefits? Paid vacation. The first one is paid vacation, means a paid leave. Okay. See, when we say paid leave, whether it is encashed, not encashed, whatever it is, the company is providing an employee with a leave, and even if the employee takes leave, the company is paying that. That is what is called paid vacation or paid leave. 10 days per year regardless of the date of hiring. So even if you join in the last month of the year, you will get 10 days entitlement of paid leave. Compensation for paid vacation is 100% of employee's salary. So if the employee takes leave, even then 100% of the salary would be paid. And unused vacation can be carried forward for 1 year. So whatever is the balance can be carried forward to another year. As of 31st March of year 1, unused vacation carry forward was 3 days per employee and average salary is 15,000 per day. Okay, so on an average, each employee has 3 days of unused vacation or unused leaves, and average salary per day is 15,000 per day. Okay, and accrued expense for unused vacation year ending 1 was 65 lakhs. Then during year 1-2, that is in the next year, employees took 9 days of vacation in average. Salary increase in year 1-2 was 10%. So as at the end of year 1, the accrued expense or the liability for unused vacation is provided for at 65 lakhs, right? We do not know exactly how did they compute it or estimate that. And the information further given is, in the next year, employees took 9 days of vacation on an average, and salary increase over year 1 to year 2 was 10%. So salary has become from 15,000 now to 16,500. How would Acer recognize liabilities and expenses for these benefits as of 31st March of year 2? Pass the journal entries to show the accounting treatment. Now, if you look at these kind of questions, the only thing that is important for us is to arrive at what should be the liability for unused vacation as at the end of year 2. Once you get to know that, then passing of journal entries and all of those things are simply secondary. If we can understand the information given in the question and calculate that leave balance correctly, calculate the leave liability correctly, then passing of journal entries should be the last of the problems. Okay, so using the given information, let us see what should be the leave liability balance as on 31st March of year 2, because there is attrition, right? 6% employees would leave and fresh 6% employees would join. Based on that, what should be the closing liability balance? We already have opening liability balance, and based on that we can pass the accounting entries. Let's start solving this problem. It's a pretty simple one. Just you need to put the right information and calculate the number of days of leave entitlement and corresponding leave liability. Okay, so calculation of leave balances and liability for, so we are looking at the next year. We are not doing for year 1. Okay, particulars. Now, if you look at the employee count, the total number of employees are 350. But every year 6% employees would leave the organization and fresh 6% employees would join the organization. Now think of it, in year 1, year 2, there were 350 employees, okay. On an average, each employee has 3 days of unused paid leave. Now, in the next year, out of this 350, how many would leave the organization? 6% would leave the organization, which means 21 employees would leave the organization. So, how many are left? 329 employees are left. So, only to this 329 employees will the entity have a liability to provide those 3 days of leaves, okay, because 21 employees have left and the newcomers who will come in the next year, they are entitled to the leaves only for the next year. So, what you need to understand is, out of 350 employees in the first year, only 329 employees will remain with us in the second year, and hence we are required to provide paid leave benefit only to those 329 employees. So, what we will do is, we will categorize this into existing employees and new employees, okay. So, we have existing and new, right. So, unused paid leave balance as at 31st of March of year 1. For existing, what is the unused paid leave balance? 3. For new, there will be nothing because they are joining afresh. If they are joining afresh, that means they will not be entitled to any carry forward leave balance. For them, it will be 0. This is the first thing. How many number of employees? Existing employees will continue is 350 multiplied by 94%, that is after reducing 6%, which gives us 329. New employees will be 350 multiplied by 6%, which gives us 21. Okay. So, carry forward leave balances from previous year is how much? 329 multiplied by 3, you get 987, and here you get 0. That is the part related to carry forward balances, okay. Then, what is the leave entitlement for year 2? Each employee is entitled to 10 leaves, both new as well as old, okay. Now, how many number of employees? Same, 321 and 21. How many leaves are taken? The question says the employees have taken 9 days of leave on an average, right. So, if you just come back to the question, it says 9 days of vacation on an average has been taken. So, 9 days, these have also taken 9 days. So, balance leaves is how much? 10 minus 9, which is 1 day for existing employees and 1 day for new employees. Based on this, how much will be the total leaves carried forward? 329 multiplied by 1, and here also 21 multiplied by 1, okay. So, this total leaves carried forward is from current year. Total unutilized leave balance is how much? So, basically what you need to do, you need to sum up this 987 plus 321 and 0 and 21, right. So, 987 plus 329 you get 1316 and 21 plus 21 you get 21. So, if you sum this up, both of them, 1316 plus 21 you get 1337. So, this is the total leave balance which will be carried forward, okay. Now, this is one way of computation. The other way of computation is, ignore this calculation here, okay. I'll just show you quickly. What you can do is, the other way of calculating is, what is the unused paid leave balance as on 31st March of year 1, which is 3. Then, how much is the leave entitlement for year 1 2? 10. How much are the leaves taken? 9. So, what are the balance leaves? Balance leaves are opening balance plus leave entitlement minus leave taken. 4 in case of these people, existing guys, and 1 in case of new joinees. So, what is the total leave balance to be carried forward? It would be 329 multiplied by 4, which is 1316, and 21 multiplied by 121. So, you get the same number. This is a faster way to calculate, okay. In the examination, you can calculate it faster by doing this method. The earlier method I did for your understanding. In examination, you can follow this also, because once you understand the concept, then there is no need to prepare an elaborate detailed working. Okay. So finally, by doing this we will save 5 steps. Okay. So finally what we need to do, we need to provide for leaves for 1337 days. Okay. Now salary per day in previous year is how much? Salary per day in the previous year is 15,000. Then they said increase by 10%. So 10% of this will be 1500. Salary for 20x1, x2 will be how much? 15,000 plus 1500, it will be 16,000. 15,000 plus 1500, 16,500. Okay. Number of days to be provided for how many number of days? 1316 plus 21, 1337. So leave liability is how much? 1337 multiplied by 16,500. You get 2 crores 20 lakh 60,500. So how should we pass the journal entries? See, in the question they have not specifically mentioned whether the leaves will be utilized on a FIFO basis or a LIFO basis. If nothing is mentioned, generally employees would utilize the leave on a FIFO basis, right? So whatever was the leave balance in the previous period would have been utilized in the current period. That means we would have paid the employees for the leaves that they have taken in the current period. So whatever is the opening provision, we can assume that it has been fully settled, and whatever is the closing provision that we have calculated, that is what pertains to entirely the current period. And in fact, if you work back and see how that 65 lakhs is arrived, that number also cannot be derived at, right? Because you had 3 days of leave balance in the previous period, and if you calculate the liability amount, it should be actually higher, but that is what is the information given in the question. So we will assume a FIFO basis. So first you will settle the opening liability, you will debit the provision for accumulated leave or provision for leave encashment. Leave encashment is not a correct term here because you are actually not encashing the leave. So provision for accumulated leave 65 lakhs to cash or bank 65 lakhs, that is the first entry, and for the second entry would be employee benefit expense debit 2 crores 20 lakhs 60,500 to the provision account, right? So these are the 2 entries that you are expected to pass. Let's have a look at another question, an interesting one actually. An entity has 100 employees who are entitled to 5 working days of paid sick leaves for each year. So every year how many days are entitled? 5 days are entitled. Unused sick leave may be carried forward for 1 calendar year. So you can carry it forward to the next calendar year. Can we carry it beyond that? Generally, when they say it can be carried forward for 1 year, it cannot be carried forward beyond that. Okay. Sick leave is taken first out of the current year's entitlement and then out of any balance brought forward from the previous year. So if the employee falls sick in the second year, they have to first use the second year balance, and if any excess leaves are taken, then you can use the brought forward balances. At 31st March of year 1, the average unused entitlement is 2 days per employee. So if you see, for 100 employees on an average 2 days per employee, that comes to 200 days of leave entitlement. The entity expects on the basis of experience that is expected to continue that 92 employees, how many employees? 92 employees will take no more than 5 days of paid sick leaves in year 1, year 2. Means what? Out of 100 employees, 92 employees will take a maximum leave of 5 days. Now, if they take 5 days of leave in the next year, which balance will be utilized? Balance of the next year will be utilized. Nothing from the first year will be utilized. Okay. Then, remaining 8 employees will take an average of 6.5 days each. Now, remaining 8 employees will take average of 6.5 days each. Meaning to say, they will use 5 days of second year and balance 1.5 day will be used from the first year. So what we should be bothered about is for these 8 employees who will be utilizing 1.5 days of balance from year 1, that is from year ended 31st March of year 1. For that we need to create a liability. So the question is, would the entity require to recognize any liability in respect of leaves? Now here, if the leaves are non-vesting, that is if the leaves cannot be encashed, then what is the obligation on the entity's part? The estimate is 8 employees will use 1.5 days of leave from year 1. So 8 multiplied by 1.5, it comes to 12 leaves. For 12 leaves, liability has to be provided for. But if we assume that this is a vesting leave, that is in the next year the employees can encash it, then in that case for the entire 200 days, that is 100 employees multiplied by 2, for that we need to create a liability. right? So this is how you need to approach questions related to leaves in the examination, right? As we move ahead, we will see, a combination of leaves and other kind of benefits when we solve the questions, but these are simple questions. Once you understand the logic of how to calculate the number of leaves, the leave carry forward and all of that, it is a simple thing. So to quickly summarize, short-term paid absences, they can be non-accumulating and accumulating. If it is a non-accumulating short-term paid absence, do we need to create any liability? We are not required to create any liability because those absences or those leaves cannot be carried forward, right? So there is no obligation on the entity or there is no obligation on the employer to provide any form of benefit in the future. So in case of non-accumulating short-term paid absences, there is no need to create any further liability or accrue any expense. The other category is accumulating. If it is accumulating, we have to check whether it is vesting or non-vesting. If it is vesting, which means employees may encash those paid absences in the future. So in such a case, for the entire unutilized balance, you need to provide for as a liability and corresponding expense will be recognized. And if it is non-vesting, then you will provide liability only to the extent that the entity expects that employees would take leave in the future. So whatever is the expectations of leaves being taken in the future, only to that extent you will create a liability and recognize an expense. Now you might be wondering, why would employees not take leaves that they are entitled to? I think some experience you already have during the articleship. Sometimes due to work pressure, due to work requirements, you cannot take leaves. Sometimes the principal doesn't gives leave, right? Same thing would happen in corporates also. So sometimes because of work requirement, work pressure and all of that, you are not taking leave. Sometimes your boss may not agree for a leave, right? So such things keep happening and you need to get used to such kind of, events happening. Don't get upset that, my boss did not approve my leaves, okay? In fact, in my career, I also had lots of leaves which got lapsed because I could not take those leaves, right? So that's how it works. So we're done with short-term paid absences. Let's now move on to the next aspect, which deals with profit sharing and bonus plans. Let's now understand the next form of employee benefit, which is profit sharing or bonus plan. What are these profit sharing or bonus plans? You would have come across these terms earlier as well, right? When you were doing accounting, you would have learned about something like a percentage of profit being paid to the manager, right? That is an employee benefit, that is a profit sharing plan. Or you would have come across terms like bonus when you learned income tax, that is a part of an employee benefit. What are these terms and why are these given to the employees? See, when an employee works in an organization, the employee gets salary. Now, that salary is generally a fixed monthly salary, right? Now, if it is a fixed monthly salary, do you think the employee will be incentivized to work harder or get better results? Because if he works harder, if he gets better results, who gets the benefit? The owners of the entity gets the benefit. For example, if I work very hard for my organization and I help the organization increase its profit, what will I get? I will still get my monthly salary. The additional profit will be taken away by the shareholders or the owners of the company or the owners of the business. So, to ensure that even employees are encouraged to perform better, employees do better jobs, employees ensure that the organization achieves its objectives, what an entity does is they provide something like a profit sharing plan or a bonus plan. Now how does that work? Say for example, the entity's profit grows from 100 crores in year 1 to 120 crores in year 2. There is an increase in profit. Now what the entity can say is, out of this incremental profit, we will share 10% with our employees. Now, employees are also happy because if we work hard, if we get more sales, if we get more profit, if we save cost, profitability of the company would increase and whatever is the incremental profit, in that we will get some share, right? So, that can be one way of sharing the profit, or sometimes the entity may say that whatever is the profit, 10% of the profit will be shared amongst the employees as a profit sharing plan. So, that could be another way. And sometimes the employer may say that if the employee achieves all of his or her objective in the year, then a percentage of salary would be paid as bonus. For example, if the employee performs well, if the employee achieves all his target, in that case, the employer may pay a percentage of salary as something called as bonus. And in India, we have something called as Payment of Bonus Act, which provides for mandatory payment of bonus for employees who are drawing certain level of salary or wages, right? So legally also it may be imposed on the company to pay a percentage of salary as bonus. Now this is applicable to specific industry where employees draw specific amount of wages or salaries, right? Now basically what do this plan mean? This profit sharing plan or bonus plan are nothing but an additional employee benefit which is provided to the employee. It could be a percentage share in the profit, it could be a percentage share in the incremental profit, it could be a percentage of salary, it could be some legal obligation, or there could be some other formula as well. Now in our case, when I was working with Bharat Petroleum, so each employee would have an annual rating at the end of each year. And if the company achieves its profit targets, then a part of the profit would be distributed as bonus to the employees. And it is not that all the employees will get equally. Employees who have higher score will get higher bonus, employees who have lower score will have lower bonus. Okay, so that is how it used to be distributed, right? So there can be multiple ways in which these kind of profit sharing plans or bonus plans are devised by organizations. What we are interested here is to understand when should we recognize a liability and a corresponding expense for a profit sharing plan or for a bonus plan. And generally these kinds of plans are short-term employee benefits. So the bonus for one particular year would be paid generally in the immediately next year. A share in profit would also be paid generally in the immediately next year. Okay, it is not that today you will earn and after 10 years the entity will pay you the bonus. Okay, generally it doesn't work that way. Most of the cases these profit sharing plans and bonus plans are short-term employee benefits. Let us now understand when should we recognize a liability for these profit sharing plans or bonus plans. Expected cost of profit sharing and bonus plan shall be recognized when and only when the entity has a present legal or constructive obligation to make such payments as a result of past events. Now what comes to your mind when you read this sentence? Is it not something similar to the definition of liability that we learned? Yes, exactly. So here also you will recognize a liability if and only if, or when and only when, as the standard puts, the entity has a present obligation. So there must be a present obligation. Now this present obligation can be a legal obligation or a constructive obligation. Legal obligation means under law it is provided, or as a part of the employment contract you have told the employee that if you achieve your targets or if the company achieves the targets, we will share some part of the profits with you or will provide you with a bonus. Now these are legal obligations because either under a contract which can be enforced in the court of law or under any legislation, and it can also be a constructive obligation. Maybe the employer has not mentioned anything about bonus in the employment contract, but the employer has been making payment of bonus on every Diwali. Okay. The other aspect is a constructive obligation. Now what is a constructive obligation? It is not written in any contract. The employer and employee have not mentioned that in the employment contract, nor it is provided under any law, but as a matter of practice, as a matter of tradition, the employer has been making payment of bonus to the employees, right? Let us say every Diwali, the employer makes a payment of bonus to all his employees, right? Now in that case, there is a constructive obligation because for many years, the employer has been making those bonus payments. Then there is an expectation which is created. Now the employees are expecting that every year on Diwali a bonus would be paid. Okay, so this is something which is called a constructive obligation, right? So either there is a present legal obligation or constructive obligation. So that is the first thing which needs to be satisfied, and it is because of past events. So generally bonuses and profit sharing plans arise as a result of past events because the employee would have worked in the organization would have made some profit. Based on that, the bonus would be paid. Okay, and a reliable estimate of the obligation can be made by the entity. So if there is a present obligation because of past events, and you can make a reliable estimate of the same. Why we are talking about estimate here? Because there may be some formulas involved in the calculation, right? So as I told you, after end of every year in our organization, they used to rate employees. Now based on those rating of the employees, the bonus amount will be decided. So there is an element of estimate involved, and the entity must be able to make a reliable estimate of the same, right? So if these two conditions are satisfied, then a liability for profit sharing plans and bonus plans would be recognized. Correspondingly, employee benefit expense would also be recognized. Now when we say it is an obligation, the entity does not have any other option but to settle the obligation. The entity can't say that no, we just the entity cannot say that we will not pay. The entity has to make the payment. That is when you recognize a liability for these profit sharing plans and bonus plans. Now, when we talk about making a reliable estimate, when can we make a reliable estimate? Either there is a formula in place for calculating the amount under the profit sharing plan or the bonus plan. If there is a formula, then you can estimate the amount of employee benefit expense. Or even if there is no formula, but the entity has determined the amount to be paid as bonus or as a part of the profit sharing plans before the financial statements are issued for approval. So, even in that case, we can say that there is a reliable estimate being made. So, this is kind of a subsequent event. Or based on the past experience, the entity can readily determine the amount to be paid as employee benefit under those plans, right? So, if there is a clear evidence based on past, let us say historically the entity has been making payments of, let us say, 10% of the profits, right, on an average. So, that can be an estimate for the bonus plan or for the profit plan for the current period, right? Based on that, the entity can make reliable estimate. Now, in some cases, what organizations do as a matter of policy is that to ensure employees continue to work for a longer period, they make conditions like bonus for year 1 will be paid 6 months after the end of the financial year. So, let us say we are on 31st of March of year 1. Bonus will be paid in October of year 1. So, for anyone to receive the bonus, they must continue to work in the organization for 6 months in the next financial year as well, right? Now, such kind of conditions are imposed or such kind of policies are made to ensure that employees just don't take away the bonus and run away from the company, okay? So, that is why they make conditions like, we will give you bonus, but if you want bonus, you have to work in the organization for 6 months, or some of them may say you have to work in the organization for 1 year, okay? So, these kind of conditions may be put by the organizations, or these kind of policies can be kept in the organization. Now, if organization has such kind of policies, then the estimate of liability or estimate of expense under those profit sharing plans and bonus plans should take into account as to how many employees are likely to leave without even taking the bonus, and that is possible. Say, at end of year 1, an employee is entitled to 1 lakh of bonus, okay? But when will that bonus be paid? It will be paid in October. Let us say in some May or June, the employee gets an offer from another organization. The employee says, if I join you now, I will lose 1 lakh of bonus. The other organization says, don't worry, we will pay 1.5 lakhs as joining bonus. You resign and you come over, okay? Now, in such case, the employee would leave the organization without even taking the bonus. And because of these reasons, when an entity makes an estimate, they have to estimate how many employees are not likely to take the bonus or receive the bonus and accordingly create a liability. Let's look at a couple of simple questions. Lakshmi Mills is a profit-making entity and has reported profit of 200 crore in the financial year 1-2, okay? According to its profit sharing plan, it distributes and pays 5% as its portion of profit to its employees if they complete 1 year with the organization. So, if an employee completes 1 year with the organization, then 5% of the profit would be paid to the employees. Now, it is not that every employee will get 5% of the profit, okay? The amount calculated will be 200 crores multiplied by 5%. That comes out to 10 crores. That 10 crores will be distributed amongst different employees, right? Under this plan, an entity is under an obligation to pay if the employees complete a specified period with the organization, that is the 1 year period. Lakshmi Mills has estimated that due to staff turnover in the organization, the estimated payout could be around 4.5%. Now, what does that mean? Not all employees will work 1 year in the organization, not all employees will complete 1 year with the organization. So, instead of 5%, the payout will only be 4.5% of the 200 crores of profit. So, what should be the amount of liability? For 200 crores multiplied by 4.5%, 9 crores will be the liability. A very simple question. Let's look at the next one. Acer Limited has 350 employees, same as a year ago. The average staff attrition rate as observed during the past 10 years represents 6% per annum. Acer provides the following benefits to the employees. Okay. Earlier we saw an example of leave, now there is a bonus. What has happened in the last 10 years for bonus? Acer paid bonus to all employees who were in service during the entire financial year. So, whoever is in the service during the entire financial year, bonus was paid. Bonus was paid in June following the financial year end. Amount of bonus for year 1-2, that is 31st March of year 2, paid in June 2 represented rupees 1,25,000 per employee. So, each employee was paid 1,25,000 and the condition is the employee must be employed in the entire financial year. So, if someone joins in between, that person will not be entitled for bonus or profit share, okay. In this case, the bonus. Acer Limited used to increase amount of bonus based on official inflation rate, which is 8.5% for 2-3. Although there was no legal obligation to increase the bonus by such inflation rate. So, every year based on inflation, the bonus amount would be increased. Now, there is no legal obligation, but for the last 10 years, the entity has been doing so. So, what kind of obligation is this? This is a kind of constructive obligation. How would Acer recognize the liability and expenses for these employee benefits on 31st of March of year 3? Pass the journal entry to show the accounting treatment. Now, a very simple question if you ask me, they have 350 employees. Out of that, 6% employee would leave during the period, which means 21 employees would leave during the period and only 329 employees would be entitled to bonus. Bonus at what amount? 1,25,000 for the previous period. This year, the applicable inflation rate is 8.5%. So, this 1,25,000 amount will be increased by the inflation rate. See, though there is no legal obligation, there is a constructive obligation because of past practices. So, 1,25,000 will increase it by the inflation amount of 8.5% and you will provide for bonus to be paid for 329 employees after considering 6% employees would leave, right. So, if I just note down the numbers here. So, if you see 350 multiplied by 94%, that comes to 329 employees. So, let me just note down number of employees entitled is how much? 329, okay. Bonus per employee is equal to 1,25,000 multiplied by 1.085, okay, or you can do 8.5% and add it to it, but I think you have reached a level where you can do these kind of shortcut calculations. So, 1,25,000 multiplied by 1.085, you get 135,625, that is nothing but 1,35,625. So, total bonus expense is equal to 135,625 multiplied by 329, you get 4 crores 46 lakhs 20,625, 4 crores 46 lakhs 20,625, right. Now, what will be the entry? Employee benefit account debit to provision for bonus of what amount? Of 4 lakhs. So, I will just copy the amount here. 4 crore 46 lakhs 20,625 and credit also 4 crores 46 lakhs 20,625. A very simple question, just that you need to understand what should be the basis of the estimation, how should we make the estimates, that is what is more important, right. Passing entries is just a routine activity for you because you have been passing entries since the time you were in 11th or since the time you were in the foundation, you have been passing journal entries. Debit credit should be the last of the problem. Once you arrive at the numbers, passing entries is just a procedural aspect, right. Even when you start working in organizations, what is important is how can you arrive at the numbers accurately. That is what will be more important than deciding which account to debit and which account to credit, right. So, this is how you will make provisions for bonus and profit sharing plans. Now, when we are talking about profit sharing plans, what is the entity doing? Entity is sharing a portion of profit with the employees. Now, entity also shares a portion of profit or the entire profit with the owners of the entity, right. Now, just because you are sharing profits with the employees, employees don't become owners. So, sharing of profits with the employees does not fall in the criteria with transactions with owners of the entity, okay. So, if you are making a payment to the employee as a part of profit sharing, that still will be treated as an expense. But if you share profit with the owners of the entity, then you would call that as dividend. If you share a portion of profit to the shareholders of the company, you would say we are paying to dividends to the shareholders, that is an appropriation of profit. But if you are making payment to employees not as shareholders, but because they have worked in the entity, then it is not a transaction with the owner. Even if employee owns shares in the company, this profit sharing plan as a part of employee benefit expense will not be considered as transaction with owners, but it will be treated as an employee benefit expense. Another thing that we need to keep in mind is if these profit sharing plans or the bonus plans are not expected to be settled wholly within a period of 12 months from the end of the reporting period, in that case they are not treated as short-term employee benefits, they would be treated as long-term employee benefits and accounting would be done accordingly. As far as disclosure requirements are concerned, Ind AS 19 does not prescribe any disclosure requirement for short-term employee benefits, but other standards may require disclosure. For example, if there is a related party transaction, then you will have to make a disclosure, or under Ind AS 1 you may have to make certain disclosures. Those disclosures are applicable, but Ind AS 19 specifically does not provide any disclosure related to short-term employee benefits. Now that we have understood what are short-term employee benefits, let us move on and understand post-employment benefits. See, the post-employment benefit section is the most critical aspect in this standard. Short term was very simple, right? You just need to calculate the expense, book the expense and create a liability and settle the liability. Now when we move to post-employment benefit, that is where we need to go deeper. We need to understand various different aspects like what are defined benefit plans, what are defined contribution plans, what is actual valuation, what are different actuarial assumptions, what is a plan asset, what is a plan liability, what is an obligation. There are a lot of things to understand, and you have to pay utmost attention to understand the underlying concept. And again, if you understand the concept, then post-employment benefit plans would also be a cakewalk for you. Let us now understand post-employment benefits. What are post-employment benefits? We have already seen the definition. Post-employment benefits are the benefits which are payable after the completion of employment. Now, don't take this notion that completion of employment means only retirement. No, it not only means retirement, it also means resignation. Okay, so whatever are the benefits which are payable at the time of resignation or retirement is covered under post-employment benefit. But something which is payable because of termination, something like VRS, that is outside the scope of post-employment benefit. That is a part of termination benefit which we will be discussing separately. Now, what could be the examples of post-employment benefit? Say someone has worked in an organization till the age of retirement. At the time of retirement, he may be entitled to gratuity, for the years that he has put into service. Then he will be entitled to pension. So that is a form of post-employment benefit, because pension will be paid only after retirement, right? So that whatever is paid after retirement as pension, that is a post-employment benefit. Sometimes the organization may give an option of lump sum payment instead of pension. Something we understand as commuting of pension, that is a post-employment benefit. Then apart from these, gratuity, pensions, employers may also provide some form of benefits like post-employment healthcare. So even after retirement from the organization, if there are any medical costs associated for treatment of employee or dependents based on some conditions, they may provide healthcare services, or they may provide healthcare facilities, or they may reimburse the cost of medical expenses. Some form of benefits, whether monetary or non-monetary, to which the employee is entitled to after the completion of employment, right? So, whatever are the benefits that are payable to the employee after the completion of employment is what is called post-employment benefit. Now, here the accounting for this post-employment benefit becomes both challenging as well as complex, because say an employee has put in services for 30 years and at the end of 30 years you are paying him gratuity. Why are you paying him gratuity? Because he worked in the organization for 30 years. The lump sum payment is happening at the end of 30 years. Let us say 15 days salary works out to 1 lakh rupees for that employee. For 30 years, the gratuity amount comes to 30 lakhs. When are we paying that 30 lakhs? At the time of his retirement. Why are we paying? Because he served the organization for 30 years. So, don't you think that expenses should be booked in each of the year in which the employee has completed his service? Because the gratuity is a function of the employee working in the organization for some number of years, and based on the last run salary, we are paying him gratuity. Now, why does the accounting become complex? First, whatever you are paying at the end of 30 years is a future value. You have to discount that and arrive at what is the present value. Now, it is not present value for 1 year. How much of that 30 lakhs is attributable to each of the years, that has to be calculated. That is the first thing. Second thing, today, how will I know what will be the employee's salary after 30 years? I don't even know what will be the salary after 5 years. So, how do I estimate salary after 30 years? So, that is another challenge. The inflation rates may go up, inflation rates may come down, based on that the salary may change. Another problem is, how will I know how many employees will work in the organization till their retirement, or how many employees will resign, let us say after 7 years, after 10 years, or how many employees will resign, let us say after 3 years. How will I make that estimate? Because if someone is resigning in 3 years time, then I don't need to pay him gratuity. But if someone is resigning after 10 years, I need to pay him gratuity. And I don't know who will work with me till 3 years or 5 years or 10 years or till the time of retirement. So that estimation becomes a challenge. And also, as the organization grows, they may hire more and more number of employees. Again, you have to estimate for them. Or in some cases, some employees may die during service. At that point in time, some other benefit has to be paid. So there are a lot of complexities involved in estimating the expense and the liability part for post-employment benefits. See, if it is a short-term thing, if it is something like bonus, I know last year I paid bonus of 1 lakh, I'll add maybe 10% and I'll make a provision. Okay, but something which I have to pay after 30 years, how will I estimate it today? Or think of a case where post-retirement medical benefit is being provided. Now, if someone may live till the age of 60 years, someone may live till the age of 70 years, 80 years, 100 years. How will I estimate the medical expenses related cost? Also, if the pension has to be paid, for how many years will the pension be paid? Accordingly, I'll have to make a provision, right? So because of all of these variables, because of all of these estimations, accounting for post-employment benefit plan becomes both complex as well as challenging. Now, we as chartered accountants are not experts in estimating all of these things. Okay, so don't think that we will have to make the estimate. We will take the help of a professional called actuary. So that actuary is another expert who deals with all of these kind of assumptions. So basically, the actuary will study the past pattern, actuary will make certain assumptions, actuary will understand the organization, the composition of employees, and based on that they will make certain assumptions. So they will say on an average the employee remaining service life will be, let us say, 12 years. On an average, this percentage of employee will resign every year. On an average, this will be the salary growth over a period of time based on inflation rate. On an average, this will be the interest income that you can earn on investment, or this will be the interest expense, or this will be the interest factor which you have to consider to discount the future payments. All of these assumptions are made by someone called an actuary. Okay, so you don't need to worry about that. You will have to sit and make those assumptions. You will get an actuarial report. Based on that, you will have to recognize a liability. Now, you might be wondering, sir, if there is an actuary who is doing all of the complex activity of estimating and all of that, then why is it complex in accounting? It is complex in accounting because there are a lot of elements involved in this post-employment benefit. As we learn about these elements, we will get a clarity as to how do we account for each one of them. Let us now understand the types of post-employment benefit plans. Now friends, there are two types of post-employment benefit plan. First one is a defined contribution plan. The second one is a defined benefit plan. Now for this, let me give you a general example, then we'll come to specific aspect of employer and employee. Say you started your CA journey and your father asked you, how long will you take to become a chartered accountant? You said 5 years, and your father said, okay, if you become a chartered accountant in the next 5 years, then I will gift you a car. For that, your father gave you two options. Option number one, every year he will deposit 1 lakh into a fixed deposit account with a bank, right? So first year, second year, third year, fourth year and fifth year, he will deposit 1 lakh each, right? And the bank will give some interest on that fixed deposit. Whatever is the amount available in those fixed deposit accounts at the end of year 5 when you become a chartered accountant, you can take that amount and purchase a car of your choice. That is one option. The second option that your father gave was you decide the model of the car today itself. Not that you can decide on Mercedes, okay? So something around 5-6 lakhs of range, you decide the model of the car today, and at the end of the 5th year, whatever is the amount that is needed to pay for that car, I will pay that amount. That is what your father told. So in the first case, he said, I'll keep on depositing 1 lakh every year, and at the end of the 5th year, whatever is that amount, you take that amount and buy the car. What if that amount is not sufficient? Then you will have to pay out of your own pocket and purchase the car. In the second option, your father said, decide on the model today. Now don't say that, sir, in 5 years if the model is not available, what we will do? Generally, a model of a car, runs for about 10 to 15 years. So don't get into that, right? Today you decide the model. At the end of 5 years, your father will buy the car for you. Now, think of these two scenarios. In the first scenario, what was your father's liability? Every year he will contribute 1 lakh, or every year he will deposit 1 lakh. Apart from that, he is not bothered about how much will be the interest, whether the bank will pay 7% interest, 6% interest, interest rate falls, interest rate rises. All of those things your father is not bothered about. Who is bothered about that? You are bothered about that because you are taking those risks. If the interest rate fall, the amount that you will receive at the end of 5th year will be lower. Let us say, price of the car rises a lot, then also you are at risk, right? So, your father's liability was restricted to the contribution he was making to the deposit account. Apart from that, he does not carry any further liability. Whatever is the risk that, the bank will pay lower interest, or the car's prices have gone up substantially in the market, even then you are at risk, your father is not at risk, okay. This kind of plans are called defined contribution plan. Why defined contribution plan? The contribution that your father has to make is defined, okay. The contribution that your father has to make is defined. Apart from that, your father does not bear any further responsibility, any further liability. The interest rate risk, the investment risk, everything else is borne by you, okay. That is called a defined contribution plan. Now, I gave you an example of bank. Assume for a moment that 1 lakh rupees was being invested in a mutual fund. Then, if the market crashes, you will be at risk. If the market crashes, you will be at risk because the value of investments may fall down, right? That is a defined contribution plan. What is the other plan? Defined benefit plan. Here, the benefit that you will get, what is the benefit? The car, that itself is defined. So at the end of 5 years, let us say for increase in raw material prices or shortage of chips and semiconductors, whatever the reason be, the price of the car went from 5 lakhs to 10 lakhs. Now at the end of 5 years, your father has to pay 10 lakhs and buy you the car once you become a chartered accountant. There the benefit is defined. Who is taking the risk there? Your father is taking the risk. You are not taking risk because you will anyways get the car of your choice. Your father is taking the risk. Say for example, the sales tax is increased, or say for example, the road tax is increased. All those risks are with your father because there the benefit which will be given to you is defined. That is called a defined benefit plan. Let's now take examples to understand defined contribution plan and defined benefit plan. Right? As far as defined contribution plan is concerned, the best example is a provident fund contribution. Now, if you recollect your income tax provisions which you have learnt in CA Inter, then you would know that there is an employer, there is an employee, and there is something called a fund, right? We can call it a provident fund, right? Now, that fund can be internally managed, it can be the government fund, whatever it is, there is a fund. Now, what the employer does? The employer contributes 12% of the salary of the employee to the provident fund, right? Now, there are some limits, there are some thresholds and all of that. We'll not get into all of those things. Let us say the salary of the employee is 10,000. 12% of 10,000 is contributed by employer to this fund. Every month, 12% of the salary, which comes to 1,200. Now, once the employer contributes the amount to the fund, then employer is not required to contribute anything over and above that in the future to meet the payments from the fund to the employee. Say the employee retires. At the time of retirement, who will settle the benefit to the employee? The fund will settle the benefit to the employee. So, whatever is the amount that the employer contributes to the fund would invest that in some government security, some portion, maybe small portion in stock market, some portion in some good quality corporate bonds based on the existing rules and regulations. They will invest those amounts. Then, once they invest those amounts, they will earn certain return. Those returns are added to the investments, and ultimately at the time of retirement or at the time of withdrawal, the fund will pay the amount to the employee. Now, in India, the amount of return that is paid from the fund to the employee is determined by the government. The government says every year, okay, the interest will be 8%, 8.5%, 9%. That rate is decided by the government. Okay. So, once the government says, okay, this year the provident fund will make a payment of 8% or 8.5%, whatever is that, whatever is the amount, right? Now, the obligation to settle the benefit to the employee is on the fund and not on the employer. Employer is like, once I have contributed 12%, I don't care at all, right? It is the fund's responsibility to make the payment to the employee, right? This is called a defined contribution plan, where the employer contribution to the benefit plan is defined, where the employer contribution to the benefit plan is defined. The final benefit is not defined. The final benefit depends on how much will the fund earn as a return, and then finally it will settle it to the employee. But contribution by the employer is defined. Let us say because of some reason the fund does not have sufficient amount to pay to the employees. Does the employer has any liability? The employer does not carry any liability, because employer says, I have contributed 12%, what is required as per law. After over and above that, I am not required to make any kind of payment. These kind of plans are called defined contribution plans, where the contribution by the employer is defined. Let us now understand an example of a defined benefit plan, and the best example that fits here is a gratuity payment. What happens under a gratuity payment? The employer will make certain payment to the employee based on a formula. For example, the formula could be that for every completed year of service, 15 days of salary is paid by the employer to the employee. Now, say for example, an employee has worked in an organization for 10 years. So, how much will be the benefit that will be paid? 15 by 30, I'm assuming 30 days month, not 26 period. Okay, 15 by 30 multiplied by 10 years. So, basically 5 months of salary multiplied by the last drawn monthly salary, right? That is the benefit which will be paid by the employer to the employee. Now, the employer knew that this employee will resign after 10 years. For example, he made that estimate. So, for that he started making some investments right from day one. Okay, right from day one he started keeping some amount aside and started investing them. Now, and what did he think? At the end of 10 years when this employee resigns, I'll take this amount and I'll make the payment to the employee. Now, say for example, based on the calculations, right, the amount payable to the employee works out to be 10 lakhs, and the amount of investments in hand with the employer is only 9 lakhs. Now, can the employer say that I'll make only payment of 9 lakh because that is the amount I have set aside? He cannot say that, because he is liable to pay the benefit to the employee based on the formula. So, that 10 lakhs has to be paid to the employee. Okay, the employer cannot escape from his liability. So, irrespective of what happens on the investment side, the employer cannot escape from the liability. They will have to make the payment as per the benefit formula. That is called a defined benefit plan. What is a defined benefit plan? It is a plan in which the benefit is defined. The contribution is not defined, the benefit is defined. Who will bear the risk of actuarial assumption? Let us say the salary increases significantly. Who will bear that risk? The employer will bear that risk. Let us say the investments do not face the return. Who will bear the risk? The employer will bear the risk. The employee will say, based on this formula, this is the amount I have to receive, please pay that amount. Okay, that is what is a defined benefit plan. Under contribution, once the contribution is made by the employer does not care. Employer is not bothered about actuarial risk, investment risk and all of those things. All those are borne by the employee, right? This is the broad understanding of defined contribution plan and a defined benefit plan. So, let us broadly summarize the discussions we had for a defined contribution plan and defined benefit plan. As far as a defined contribution plan is concerned, what is defined? The contribution to be made by the employer is defined. Under defined benefit, what is defined? The benefit that the employee will get, that is what is defined. Now, under a defined contribution plan, what will be the benefit that will be received by the employee? It will be the contribution plus the return on investment. That is what will be received by the employee. Okay. Under the benefit plans, what is the benefit that the employee will receive? They will receive the benefit as decided by the formula. Now, coming to the risk aspect, there are two kinds of risk. One, benefit is less than expected, which we generally call as an actuarial risk, or the assets may not be sufficient to make the payment to the employee. That is the investment risk or the asset risk side. Now, who bears this risk in case of a contribution plan? The employer does not bear the risk. The ultimate risk, the actuarial risk, falls on the employee. Even the investment risk, let us say the fund doesn't have money, that also falls on the employee. Whereas, if it is a defined benefit plan, the actuarial risk and the investment risk are borne by the employer himself. So, there is a possibility that the employer may have a higher obligation than expected. Whereas, in case of a contribution plan, there is no increase in obligation, right? Even if the fund doesn't have money to pay, employer does not have any responsibility to make good the shortfall, right? So, this is a broad understanding between a defined contribution plan and a defined benefit plan. Let's have a look at some questions to understand whether it is a defined contribution plan or a defined benefit plan. A company pays each employee a lump sum one-time benefit upon retirement. So, some lump sum payment is made. This benefit is computed based on employee's years in service in the company and the final salary prior to retirement. So, something like a gratuity payment which we discussed about, right? To cover its liability from this remuneration, the company contributes 3% of annual gross salaries to a fund. Would this obligation represent a defined contribution plan or a defined benefit plan, and why? Now, to answer this kind of question, what you need to understand is what is defined. Is the contribution defined or is the benefit defined? Finally, whatever the employee gets, the benefit, that is what is defined in the question, and it says the benefit is computed based on the employee's years in service and the final salary prior to retirement. Based on that, based on some formula, a benefit is defined. Now, though the company contributes 3% of salary towards some fund to provide for that particular benefit, this does not make it a defined contribution plan. See, in a defined contribution plan, once the contribution is made, the employer has no further liability. But here, in this case, let us say the contribution that the employer is making is not sufficient. Maybe towards the last few years, the salary has been increased substantially, and the amount in the fund is not sufficient. So, in that case, the employer will have to pay the money out of its own pocket, right? And hence, this is a case of a defined benefit plan and not of a defined contribution plan. Let's have a look at another example. In accordance with applicable legislation, company contributes 12% and employees 12% of annual gross salaries to the provident fund and pension fund. Okay, so these terms you would have come across multiple number of times earlier also, especially when you deal with income tax. Upon retirement, the employees will get accumulated balance that is calculated based on employee's year of service and his average salary for past 15 years before retirement. So, here what is being contributed? Some amount is being contributed, 12% of annual gross salaries. So, employer also contributes, employees also contribute, that is contributed to a fund. And once the employee retires, based on the average salary and number of years of service, some benefit will be paid to the employee. The pension will be paid out of the state fund assets and the company has no further obligation except to make contribution. Would this obligation represent a defined contribution plan or a defined benefit plan? Now here the employee benefits are defined, that is one part. The contribution of employers are also defined. Okay. Now once the employer makes the contribution, is there any further liability on the employer? There is no further liability. Who will bear any actual risk on that? The state fund will bear the actual risk on that, and hence these kind of plans are called as defined contribution plans. See, you have to look at it from the point of view of the employer. We are doing employers accounting, we are not doing employees accounting or the fund accounting, we are doing employers accounting. And as far as employer is concerned, once the 12% contribution is made, then there are no further liabilities on the head of the employer, and hence this is a defined contribution plan. Let us now understand the accounting treatment for a defined contribution plan. That is, how do we recognize it and how do we measure it and how the items should be presented, right? Now, as far as defined contribution plans are concerned, the accounting is pretty simple and straightforward. Why? Because the actual risk is not borne by the employer, right? As far as the employer is concerned, his responsibility, his liability is to pay a specified contribution to a fund, and after that amount has been paid to the fund, then there is no further liability on the employer, right? Let's take a simple example and understand the accounting for defined contribution plan. So let us say after you qualified as a chartered accountant, you joined a company and you were offered a salary. So let us say your basic salary is 1 lakh monthly. Okay, I hope all of you are able to draw this salary at the beginning of your career. Okay, then there is something called as HRA, right? So HRA, house rent allowance, what you call. Let us say this is 40% of your basic salary. Then you have other allowances of, let us say, 60,000, right? So these are the three components of your salary. I am not making it very complicated like we were offered, right? I am not making a complicated offer here, right? Other allowances of 60,000. This is what it is, and what the company says is company will contribute PF. Who is contributing? Employer would contribute to the PF, and that is 12%. Okay, so 12% of basic salary would be contributed to the PF by the employer. Okay, now we will not put into those restrictions like maximum wages should be 15,000 and 1,800. Let us assume for a moment that entire 12% of the basic salary is contributed to the provident fund. And I suggest all of you that once you start working, you ask your employer to contribute to the extent possible, means use the maximum limit of 12% rather than restricting yourself to the 15,000 of wage limit. Okay, because as you save and after 5-6 years, you will realize that the amount of interest you start earning on this accumulated fund is more than your annual contribution, right? And that is when you will see the benefit of compounding, right? So just a simple advice from my side, even if the employer says that we'll restrict it to the wage limit, but please ensure or please try to contribute as much as possible from your side as well as from the employer's side. Okay, so this is the monthly thing, right? Now this is what is being offered to you. Now when I say contribution of to PF by the employer, this 12%, this is over and above these three components. This is over and above these three components. So how much will be the PF contribution by employer? If you look at the amount, it will be 12% multiplied by 1 lakh, that comes to 12,000. So if you look at the cost to company, the company will pay you 1 lakh plus HRA of 40,000 plus other allowances of 60,000. That is what the company has promised to pay you, plus the company said I will also pay 12,000 to the Provident Fund Authority. So this becomes the cost to company. Now does it mean that you will get 2,12,000 in your hand? You will not get 2,12,000 in your hand, because you will also have to contribute 12% of your basic wages as Provident Fund. That is one aspect. There would be other deductions also, professional tax, income tax, all of those things, even those would be deducted. Now to keep it simple, we will assume that the income tax that is deductible from your salary is 25,000 per month. So we will not make it complicated. So let us say TDS will be 25,000 per month. Now at the end of the first month, what will you get in hand? What you will get in hand is your basic salary, HRA, other allowances. These three are your payments. So if you say total, or sometimes they call it gross salary also. Two lakhs is the gross salary. Then it would be, they will deduct employee PF contribution. Now please note, this is not employer contribution, this is your contribution. How much will that be? That will be 1 lakh multiplied by 12%, which will be deducted, and TDS or your income tax. How much was that? 25,000. Okay. So what are total deductions? Total deductions are 12,000 plus 25,000, 37,000. So what is your in-hand salary? Net amount payable or paid will be 2 lakhs minus 37,000, that is 1,63,000. That is what you will get in hand. Okay. Now we said the cost to company is 2,12,000. The cost to company is 2,12,000, but you got only 1,63,000 in hand. Let us see how do we account for this in the books of the company. Now first thing that you need to understand is this total salary 1 lakh plus 40 plus 60 is the salary expense for the company. So the company will debit salary expense and credit salary payable. Okay. So the entry would be salary expense debit how much? 2 lakhs. This is the first item. To what? To salary payable. Now how much is payable? 1,63,000 is payable. 1,63,000 is payable. What happens to balance? Balance comprises of 2 employee PF payable, that is 12,000, and 2 TDS payable 25,000, right. So you have 37 plus 63 makes it 2 lakh. This is the first entry. This is your salary expense. Okay. This is the salary expense based on whatever is to be paid to the employee. But there is one more component which the employer has to pay. What is that component which the employer has to pay? Employer has to make a payment of his own share of contribution, which is 12%. So you'll have one more item which is salary expense debit to employer PF payable. You can have a single account also, right? How much is that? 12,000 and 12,000. So what will the employer recognize as salary expense? Not only the salary expense which is payable to the employee, but also the expense which is on account of contribution to a provident fund. Now you might be wondering, actually we got only 163, right? Actually we got only 163. This is what will be paid through bank. Then what happens to these two? This 12,000 of contribution employer will make to the PF authority. So this will be paid to your PF account, and it will be available in your PF account. So you can claim this amount once you complete a specified number of years of service, or once you retire, or once you resign. Okay. Based on that you can withdraw the amounts. This is paid to your PF account. What happens to this? This is your TDS credit. So whenever you file your income tax return, you can claim this 25,000 as TDS credit. This you can see in your form 26 AS. Okay. Or your TDS certificate, right? That is what it is. Then employer PF payable, what happens to this? This also goes to your PF account. Now there are split between PF and pension, we will not get into all of that. This 12,000 will be paid to your PF account. So as far as the employer is concerned, employer is making payments of all of these things. He is paying you salary of 163, he is making a payment to PF account 12,000, TDS he will have to pay 25,000, and this 12,000 will also be paid, right. So your total expense will be 2 lakhs plus 12,000, 2 lakhs 12,000. This is a simple accounting for a defined contribution plan. See what we are understanding here, how do we account for this defined contribution plan? Simply whenever the contribution becomes due and payable, you will recognize it as a employee benefit expense, and you will create a liability for that. Okay. Now will we use discounting? Generally we will not use discounting, because these are generally paid within 12 months from the end of the period in which the employee renders the service. If at all there is something which I have not yet come across, but there may be cases where the contribution has to be made after 12 months, then in that case you will use the discounting factor, but otherwise you will not discount this payment. So whatever is the contribution, that will be directly be treated as an expense in the books of the employer, right. So as far as defined contribution plan is concerned, a simple treatment, you will debit the expense and you will create a liability for the amount that has to be contributed. Okay. Now to quickly summarize this, there is an employer, there is an employee. Employer contributed 12% to fund. Employee will also make a contribution of 12% to the fund, and at the time of retirement or resignation or after completing certain number of years of service or for some specific purpose, from that fund, the amount will be paid to the employee. Employer has no further liability. Now, when I say employee contributes 12%, basically, employer will deduct that 12% from the salary of the employee and contribute that amount to the provident fund. Okay. So, this is how we account for defined contribution plans. So, how do we account for defined contribution plan? First, you will calculate how much is the contribution to be made. Now, based on that contribution, you will create a liability and correspondingly there will be an expense which will be recognized. Unless, of course, that particular contribution is to be treated as a part of the asset or as a part of the cost of an asset as per other standards like Ind AS 2 or Ind AS 16, etc. You will treat them as an asset, but otherwise, you will recognize them as an expense. This will be done on an undiscounted basis. When will we discount? If the contribution has to be paid after 12 months from the end of the reporting period, in that case, you will use a discounting factor. Now as far as disclosure requirements are concerned, an entity is required to disclose what is the amount of expense that the entity has recognized as far as the contribution plans are concerned, right? And apart from that, if there is something related to related parties as per Ind AS 24, those disclosures also need to be given, right? But otherwise, it's a very simple accounting treatment. There are no complexities as it is in the case of a defined benefit plan. Let's have a look at another question. Acer Limited provides a lump sum remuneration upon retirement to its employees. Okay, some form of benefit. Remuneration is paid out of the fund to which Acer Limited contributes 12% of annual gross salaries. So, what is happening here? The entity is making a contribution to a fund. Now, whenever we are using this term fund, it could be a statutory provident fund or a fund which is managed by the government, right? That is one case which is possible. Or sometimes there may be a case where the entity itself has set up an independent trust to which contributions are made. So, that could also be a possibility. Or in some cases, they may make contribution to insurance companies. That is also a possibility. We will come to each of those aspects, right? So, whenever we say a fund, please understand that fund is a separate entity from the employer. The employer cannot manage on its own all of these contributions. Otherwise, what will happen if the employer is managing employees' contribution, if the employer is keeping those contributions with himself, then there is a high chance of misappropriation. Okay. So, for that purpose, the laws are very strict, the laws are very clear that the employer has to make these contributions to a separate fund, okay. And if you remember, there are also deadlines by which the contributions have to be made, and if they are not made within the specified deadlines, income tax does not allow those expenses, right. So, all of these provisions are kept to ensure that the employer does not misappropriate the amounts which belong to the employee. So, whenever we talk about these contribution plans, employer will have to make this contribution to a fund which is a distinct entity, maybe an independent trust, maybe the statutory authorities, any of these, but it is a distinct entity, okay. So, contributions are made twice a year, that is in the month of November of the related financial year and in June after the financial year end. So, for a financial year ending in March, one contribution will be made in November and the other contribution will be made in June. Total annual gross salaries for year 1 amounted to 50 crores. Contribution made by Acer Limited in November 20 was 2.8 crores. Remuneration depends on the number of employees' service and amount of cash in the fund at retirement date. Acer Limited has no further obligation except for contribution. So, basically, once you make a contribution to the fund, it is fund's headache to settle the amount to the employees. Employer, that is Acer Limited, does not have any further obligations. How should this transaction appear in the financial statements of Acer Limited as on 31st of March of year 1? Now, here if you see, there is a one full financial year. Financial year ends on 31st of March of year 1. It begins on 1st of April of year 0. When is the first contribution made? The first contribution is made in November 20. So, in November 20, a contribution was made and that amount of contribution is 2.8 crores. Now, when will the next contribution be made? The next contribution will be made in the month of June, after the financial year end. Okay. When are we standing? We are standing as on 31st of March of year 1. Now, standing on 31st March of year 1, is there any obligation on the employer to make contributions to the fund? Yes, because the question says that 12% of annual gross salaries has to be contributed. What is the annual gross salary? Annual gross salary is 50 crores. So, 12% of 50 crores, 12 5 is 60. So, 6 crores is the total amount which has to be contributed to the fund. Okay. So, this 6 crores becomes your expense. The entity will recognize an expense for 6 crores. Now, out of these 6 crores, how much is already paid? In November, 2.8 crores is already paid. So, 2.8 crores which the entity has already paid, so that need not be contributed again, but the balance 3.2 crores will have to be contributed in the month of June. So, as on 31st of March, if you stand on 31st of March, there is an obligation on the employer to contribute the balance 3.2 crores to the fund. So, the entity will recognize this as a liability, right? You will create a liability called contribution payable to the extent of 3.2 crores, right? What has happened here? The employee benefit expense is 6 crores. You will debit that account. To contributions payable 3.2 crores, to cash or bank 2.8 crores. So, whatever is paid will be credited to the bank account. Whatever is payable will be shown as a liability in the books of Acer Limited. Let's now have a look at a question which appeared in the May 2019 examination. And let me tell you friends, these kind of simpler questions which appear in the examination should be a cakewalk for you. It should act like a free hit for you, because it's a very simple question and there cannot be any kind of complexity either in the answer or in the way of evaluation, okay. If you write it correctly, out of 5 marks, at least 4 marks is in your pocket, okay. And if you look at any of the examination papers, you will get some of these type of questions which are straightforward or direct or simple questions. Once you have understood the concept, there is no complexity in that, right. So, let's have a look at the question. In 2017-18, Dyna has 3,000 employees in the company. So, in 2017, that is the number of employees. As per the company policy, the employees are given 30 days of PL. Okay, looks like BPCL only. 30 days of PL, 12 days of sick leave and 12 days of casual leave. Pakka BPCL. Out of the total PL and SL, 10 PL can be carried forward to the next year. So, whatever is the PL and SL balance, that is 30 days of privilege leave, you can carry forward how many leaves? 10 leaves. Out of 12 days of sick leave, you can carry forward 5 sick leaves to the next year. On the basis of past trends, it has been noted that 1000 employees will take 5 days of PL and 2 days of SL, okay, and 2000 employees will avail 10 as PL and 5 as SL, okay. So, this is one part of the question. Now, if you come down, the question says, what is the treatment for the short-term compensating absences, profit sharing plan and defined contribution? So, we have now reached the short-term compensating absences. Now, what will be the treatment for short-term compensating absences? We need to estimate how many leaves will be carried forward, how many leaves will be carried forward, and based on that you will create a liability and recognize a corresponding expense, okay. They have not given us details of what is the salary and how much is to be accounted for as an expense. We just need to tell them for how many number of days the entity will have to recognize or accrue a liability and corresponding expense. Now, here the employees are divided into 2 categories, 1000 employees and 2000 employees. So, let us see how many leaves will be carried forward and based on that what should be the liability, okay. So, first we will talk about the 1000 employees, right. Now, for the first 1000 employees, how many leaves are they entitled to? As far as PL is concerned, they are entitled to 30 days of PL. How many have they taken? They have taken 5 days of PL. How many leaves are left? 25 per employee. Can they carry forward entire 25? They cannot carry forward. They can carry forward only 10 PLs. The question clearly says they can carry forward only 10 PLs. So, for the first 1000 employees, number of PL to be carried forward is 10, okay, that is 1000 multiplied by 10, you get 10,000, right, that is first part. Then number of SL to be carried forward is how much? Now, here if you see there are 12 days of sick leave and the question says employees will take 2 days of sick leave, which means they are left with 10 days of sick leave. Can they carry forward entire 10 days of sick leave? They cannot carry forward, they can carry forward only 5. So, 5, that is 5 into 1000, 5000 SL days, right. So, 10,000 PL days and 5000 SL days for 1000 employees. Then coming to for 2000 employees, number of PL to be carried forward. How many PL can be carried forward? 2000 employees will avail 10 PL. So, out of 30 PLs, they will avail 10 PL. So, how much can be carried forward? Again, they have a balance of 20, but they can carry forward only 10. So, number of PL to be carried forward is 10. That is 2000 into 10, 20,000 PL days, and number of SL, they will take 5 sick leaves, okay. Out of 12 sick leaves, they will take 5 sick leaves. So, 12 minus 5, 7 is the balance, 5 can be carried forward. So, again here also it will be 5, that is 10,000 SL days, right? So the entity has to create a liability and correspondingly recognize an expense for 10,000 plus 5, 15,000 plus another 30,000. So that comes to 45,000 employee days. Now in this question, if you observe carefully, entitlement is 30. Some have taken 5 and others have taken 10. Anyways, maximum 10 PL can be carried forward. So you can directly compute for 3,000 employees together, saying for 3,000 employees 10 PL days, that comes to 30,000, and 5 SL days, which comes to 15,000. For total of 45,000 days, expense has to be recognized and corresponding liability has to be created. Okay. Now reading on to the next part of the question. Also, the company has been incurring profits, so it should not be incurring, the company has been making profits, okay. Since incorporation, it has been decided that in 2017-18, the company will distribute profits to its employees at 8% during the year, okay. However, due to the employee turnover in the organization, the expected payout of the company is around 7%. The profit earned during 17-18 is 12,000 lakhs. Now, very simple. On 12,000 lakhs, you have to share profit with the employees. How much will be shared? Normally 8% is shared, but because employees leave during the next period, the company expects that only 7% has to be paid. So for this, how much of liability has to be recognized? 12,000 multiplied by 7%, you have to recognize a liability for 840 lakhs. A pretty simple question, nothing complicated here. So the liability that will be recognized will be for 840 lakhs. Why 7%? Because the expected obligation is only 7%, right? Then Dyna also has a post-employment benefit plan available, which is in the nature of defined contribution plan, where contribution to these funds amount to rupees 500 lakh, which will fall due within 12 months from the end of the accounting period. The company has paid 120 lakh to its employees in 17-18. What is the treatment for the short-term compensating absence, profit sharing plan and defined contribution plan as per the provisions of relevant Ind AS? Now here, what does it say? It says that there is a defined contribution plan, there is a post-employment benefit plan where contribution to the fund amounts to 500 lakh. Which will fall due within 12 months from the end of the accounting period. The company has paid rupees 120 lakhs to its employees in 17-18. So if you look at this question, it says that the company has paid 120 lakh to its employees. Generally, the company will not pay to the employees, but the company will contribute to the fund. So we'll have to understand the question in that way, right? So the contribution to the fund is 500 lakhs, which will fall due within 12 months from the end of the accounting period, the total thing. And the company has paid 120 lakhs already. So what should the company do? The company should create a liability for the balance contribution, right? How much is the balance contribution? 500 minus 120. For 380 lakhs, the company should create a liability, and if the 120 which the company has already counted for as an expense already, then for the balance the company should recognize an expense, and if it has not been recognized as an expense, then for the entire 500 lakhs the company should recognize an expense. A very simple question. If you understood the concepts, you would be in a position to score easily the 4 to 5 marks out of this. Let us now understand the recognition and measurement aspects related to defined benefit plans. Now let me tell you friends, this is one of the most complex topic and discussion in this particular standard. I used to be really scared when I used to learn about this in accounting standard 15, but once I understood the logic, it no longer scared me, okay. So what you should also be doing is first understand the underlying logic based on which the accounting treatment is given. Don't worry about so many definitions to learn, so many concepts to understand. That is the wrong way to approach. First understand why we are doing what we are doing, and then how to do all of that will follow automatically, okay. Now coming to defined benefit plans, we'll take a very simple example. We'll reduce the number of periods and we'll take only one employee and try to understand what could be the various impacts that we need to consider, okay. We'll take the example of a gratuity plan. Say at the beginning of year 1, an employee joined an organization, okay, and the organization has a gratuity plan under which the employee would be paid certain gratuity after completion of 5 years of service. And for simplicity's sake, let us assume that once he completes 5 years of service, on the very next day the employee resigns, and because he resigns, he will be entitled to gratuity payment, okay. Now how is the gratuity payment decided? Say for example, half month's salary for every completed year of service, okay. Half month salary. Which salary is this? This is the salary as at the end of year 5 or on the last working day, okay. Whatever is that salary, based on that salary we will compute half month salary, and for 5 years we will make that payment. Now assume for a moment when he joined the salary was 1 lakh, and based on entity's past experience, actuarial assumptions, valuations, all these things put together, it is expected that by the time he resigns, his salary will be 2 lakhs, okay. Now how will we compute the gratuity payable, or how will we calculate the amount of gratuity for that employee? gratuity will be half month salary, so 1 by 2 for 5 years, right, 5 completed years of service multiplied by 5 multiplied by last drawn salary, which is 2 lakhs. So 2 lakhs multiplied by 5, and if you divide it by half, how much do you get? You get 5 lakhs. So 5 lakhs is the lump sum gratuity amount which will be paid to the employee at the end of year 5, right, if he resigns at the end of year 5. Now, few things that we need to answer. Is this gratuity which is payable at the end of year 5 an obligation on the entity? Yes, there is an obligation on the entity that if the employee completes 5 years of service, we will have to make a gratuity payment of 5 lakhs. Okay, so there is no escaping. The entity cannot say that I will not pay you gratuity. The entity has to make that payment of gratuity to that employee. Okay. Now, this 5 lakhs, if you look at it from the point of both the entity as well as the employee, when did the employee render service to earn that 5 lakh of gratuity? The employee rendered services for 5 years to earn the gratuity amount at the end of year 5. So, though it is paid at the end of year 5, the benefit that the employer has derived, the service that the employer has received is for the 5-year period and not only at the end of year 5. So, logically speaking, this payment of 5 lakhs should be accounted for as an expense in each of the years, correct? Now, another question that comes to our mind is, the payment is 5 lakhs. Can I do something like 1 lakh, 1 lakh, 1 lakh each year and charge it off to the P&L as a salary expense? Can I do that? Think of it. See, we are settling the amount at the end of year 5. Now, at the end of year 5, we are paying 5 lakhs and say for a moment, out of that 5 lakhs, 1 lakh pertains to year 1. Okay, 1 lakh pertains to year 1. We are paying 1 lakh at the end of year 5. So, if you have to account for it as an expense at the end of year 1, we will have to discount that, right? So, we cannot say that every year 1 lakh will be the expense. We will have to consider the time value of money. We will have to use a discount factor to arrive at what will be the expense that will be recognized at the end of each period. Okay, so as far as an expense is concerned, we have to see how do we calculate this expense amount which has to be recognized, which we generally refer to as current service cost. Don't bother about the definition or the terminology, just understand that this is an expense to be booked in a particular year. That is one aspect. Okay, now let us say I have calculated the present value of 1 lakh and brought it to the end of year 1 and I have arrived at some number. For argument's sake, let us say it is 60,000. That is the estimate of obligation at the end of the first year. But this 60,000 will not remain 60,000. Every year we will have to add interest on that, so that at the end of year 5 we reach the final amount of 1 lakh. Similarly, for year 2 we'll have to do the exercise, year 3 we'll have to do the exercise, and for year 4 and year 5 we'll have to do the exercise. So there will be an element of interest cost also. So you have an element of service cost, that is the employee benefit expense, then we'll have an element of interest cost. Then we have this obligation at the end of year 5. At the end of each year also, we need to estimate what is the obligation on the employer for the services which the employee has already rendered, right? This is one aspect broadly which covers the recognition of expense and the liabilities. Now, another aspect that we need to understand is the employer knows that at the end of year 5, I have to pay 5 lakhs to this particular employee. One option is I do not make any investments, I do not keep aside any amount, right? Obviously, I recognize the liability, but I do not make any investments. Whenever the employee resigns, I just pull out 5 lakhs from my bank account and pay to the employee. But this is a very risky proposition because on that day you may not have 5 lakh rupees of balance in the bank. Now I am talking about one employee, there could be thousands of such employees. So what employers generally do is, they know that they have to make a payment of a benefit at the end of 5 years. So to meet that particular expense, they start investing some amounts in some assets. Like we also do in our families, right? If there is a marriage coming up, or if at all there are amounts to be kept aside for education or purchase of a car or a home, we keep aside some amount separately, right? Similarly, what the employer can do is, employer can keep aside some amount every period, right? And invest that amount into some assets. Why is he investing those amounts? He is investing those amounts so that whatever is the amount invested plus the return on those investments, whatever is received, that can be used to make the payment of gratuity. Now the question may come, what if there is a shortfall? If at all there is a shortfall, he'll have to add more money to that and make the payment to the employees. Now these assets which the employer creates is called plan assets, and the return which these plan assets generate is called return on plan assets. So if you broadly look at this discussion what we had so far, there is a cost or an expense to be provided, there is an interest expense on that particular cost. Then there is an obligation which is a liability. Apart from that, there are assets as well which the employer would be creating, and there is income on those assets which the employer would be earning, right? We will have to understand different dimensions of all of these components that we have discussed just now. What we will do is, we will take an example of again the same gratuity, we will assume some discount rates and see how do we calculate these expenses, how do we calculate the interest, how do we calculate the obligation, and then we will look at the definition and understand more aspects onto that. Let's now have a look at a question and understand how do we calculate these related expenses and liability. We'll come to the technical terms later, okay. So don't be bothered about, sir, we have not done the definition, how do we calculate that? Don't worry about all of that. First understand how it works, okay. Then for each component we'll see what is the definition and what it includes and how do we calculate all of that. So a company has an employee benefit plan which involves a lump sum payment to employee on termination of service that is equal to 1% of final salary for each year of service. So something like gratuity, okay. There we said 15 days, here we are saying 1% of salary. Consider the salary in year 1 is rupees 10,000 and is assumed to increase at 7% compounded each year. So basically if you start with 10,000, next year your salary will increase by 7%, then next year after that your salary will increase by another 7%, like that the salary will keep on increasing 7% on a year to year basis. It's so compounded basically means we are not saying 7% per year, 7% of the previous year is what will be the salary increase, right. Then taking a discount rate of 10% per year, you are required to show benefits attributed year on year, the obligation in respect of this benefit. Now when we say obligation, we are basically talking about the liability, right. Now what we will do is, we will see how much is payable at the end of year 5 and how do we apportion that payment to each of those years. That is what we need to understand. That is the fundamental thing that you need to understand for defined benefit plan. If you are thorough with this concept, remaining related concept will not be a challenge, okay. Now what is the thing? We have to do it for an employee who is expected to leave at the end of year 5. Okay, so basically we are assuming that, as I gave you an example, joining at year 1, leaving at the end of year 5, and we are not assuming any other changes like salary increased by a higher number or the discount rate changed. All of those things we are not considering. We are just assuming that the employee will join at year 1, he will retire or he will resign at the end of year 5, and because he has completed 5 years of service, we will have to pay him some lump sum payment, okay. What if he resigns earlier, what if he continues later, we are not computing all of those things for now, right. A simplistic assumption related working. So first we need to calculate what will be the salary at the end of year 5, right. Only then we will get to know how much is payable at the end of year 5. So salary at year 1. What is the salary at year 1 given? 10,000. Okay. This is what is the salary at year 1. Now what is the annual increment? Annual increment is 7%. So what will be the salary at year 5? Salary at year 5 will be basically 10,000 of salary in year 1 growing by 7% each year. Now for how many periods will the salary grow? See, we are at year 1. Year 1 salary is 10,000. So in year 2 it will increase by 7%, year 3, year 4, year 5. So we have to see how much will be the salary in year 5, basically considering 4 periods of growth. Okay, it is not 5 periods of growth, it is 4 periods of growth. From 10,000 of year 1, you will have to see year 2, year 3, year 4 and year 5. Basically have 4 periods of compounding. So what will be the salary? Salary will be 10,000 multiplied by 1 plus 7% to the power of 4. Why 4? Because we have to see increment over a 4 term. Why 4 and why not 5? Because we are seeing increment from year 1 to year 2, year 2 to year 3, year 3 to year 4 and year 4 to year 5. So there are only 4 terms, okay. So how much will that be? That will become 13,108. This is nothing but your future value formula. Future value is equal to, or amount is equal to, present value multiplied by 1 plus r to the power of n, right. Now I don't expect at a CA final level that you calculate it on a yearly basis, 10,000 for year 1, then 10,700 for year 2, then on 10,700 add 7%. Don't do that. You can directly use this formula and arrive at the amount. Now what is the benefit payable? That is what is important. Benefit payable is equal to 1% of final salary for each year of service. So here, what does this 1% of final salary mean? Means 1% of the final salary that you have arrived at. Okay, so here this 10,000 is salary for the entire year, and similarly 13,108 what we got here, this 13,108 is also for the full year. It is for the full year, it is not on a monthly basis kind of a thing. 1% of this for every year is payable. So 1% of this is multiplied by 1%, you get 131. Okay, so we'll round it off to 131, and total benefit payable is how much? 131 multiplied by 5, which you get 655. So at the end of year 5, the employee is entitled to 655. This is the payment that has to be made. Now, this 655 of payment pertains to how many years? It pertains to 5 years of service. It pertains to 5 years of service. So we will have to recognize expense in each of the year. We can't say that, because we are paying at the end of year 5, we'll recognize it as an expense only at the end of year 5. That is incorrect. We'll have to split this and calculate the amount which is attributable to each year of service. So what we'll do is, this 655 will divide it into 5 periods and then see how much is the expense which is attributable to each year. So year 1, years. So we'll have years, benefit, how much of the benefit is attributable. Now this benefit is based on the future value. So we'll have to see how much is the present value of that. Okay, so we'll have a present value calculation also. So you'll have your benefit, you have cumulative benefit, benefit for the year, cumulative benefit, then present value factor, present value, right? These are the things that we need to understand. So you have 5 years, 1, 2, 3, 4, 5. Okay, you have a total of 5 years. For each year, how much is the benefit attributable? For each year, benefit attributable is 131, or you can do 655 by 5 also. Okay, 131 there, 131 here, 131 here, 131 here. Okay, that is the benefit attributable individually for each of those years. Okay, what is the cumulative benefit? Cumulative benefit, this is undiscounted. This benefit that whatever we are writing is undiscounted. Okay, now if you see cumulative, it is 131 at the end of year 1, 131 plus 131, 262, then 393, 524, 655. That is how you get the cumulative value. These are undiscounted. These two are undiscounted, and let me tell you, these two are not relevant for us to pass any journal entries or do any kind of accounting. Okay, what we need to do is, we need to arrive at what is the present value of this, what is the present value of this, and accordingly we will have to do the calculation. Now friends, please understand, when I say that there is a benefit of 131 attributable to year 1, what does that mean? Out of this 655, 131 pertains to year 1. So this 131, whatever we are saying, this is actually at the end of year 5. It is not at the end of year 1. This is the benefit which is payable at the end of year 5. We have to see what is the present value of this benefit. What is the present value of this benefit? Similarly, this 131 here also is payable at the end of year 5. We have to see what is the present value of this benefit at the end of year 2. Like this we have to calculate for each of the period, right? Now what is the discount factor given in the question? They said take discount of 10% per year. Very good. So we'll do the calculation at 10%. Now how do we arrive at the present value factor? Just don't do 1 divided by 1.1 to the power of 5, because we need to see for what period are we calculating. Where are we? We are at the end of year 1. This is at the end of year 1. This is at the end of year 5. Okay, because accounting and all you will do at the end of the period. Now, from end of year 1 to end of year 5, how many periods are there? There are basically 4 periods. So, you have to discount this 131 by 4 periods to arrive at the present value factor and present value, right? So, basically 1 divided by 1.1 to the power of 4 is what you need to do to arrive at the present value of 131, which is payable at the end of year 5 to arrive at its present value. So, the present value factor comes to 0.68. Let me increase the decimals. 0.6830. What does this 0.6830 represent? 1 rupee which is payable at the end of year 5 is equal to 0.6830 at the end of year 1. So, this 131 which will be actually paid at the end of year 5 is worth how much today? Is worth 131 multiplied by 0.6830, which is 89.47. So, the present value of the obligation at the end of year 5 which belongs to or which pertains to year 1 is 89.47. In other words, in this 655, there are two components. One, the cost component and interest component, right? For year 1, 89.47 represents the cost component. Similarly, for second period, how much will that be? That will be for a 3 term, or you can do a multiplication by 1.1, that is also fine. 98.42 represents the cost of year 2. Then for the next period you will do a 2 factor. 108.26 represents the cost of year 3. Then you will do a 1 factor. 119.09 represents the cost of year 4, and here because we are at the end of year 5, the factor becomes 1 and entire 131 becomes the cost of year 5. Let me repeat once again. This 655 has 5 components or 5 years. Okay, each year represents 131. Now here something which is paid at the end of year 5, for calculating the value at the end of year 5, what will be the discount factor? It will be 1. So 131 represents the cost of year 5. But if you have to go back by 1 year, if you have to see what is the cost pertaining to year 4, you cannot say 131, because 131 is payable at the end of year 5. If I have to see that value at the end of year 4, I will have to use a discounting factor which is 0.9091 and the value becomes 119.09. Like this, I will have to repeat for each year to arrive at the present values. Now, sometimes if counting becomes difficult for you in the examination, what you can simply do is start from the end. Start from the end. What is the end value? Because you are paying at the end of year 5, something which pertains to year 5 will have a discount factor of 1. So take 1. Then what do I do? 1 divided by 1.9091. Then like we did in the case of lease accounting, right? This divided by 1.1, 0.8264, 0.7543, 0.6830. So reverse working can also be done if you get confused with the number of years. So you should not be making mistakes in these simple computational aspects. What did we understand here? I am repeating once again. 655 is payable at the end of year 5. This is in future value. Okay. This 655 of future value is basically representing 131 for each of these years. These are all in future values. Now, how do we do the accounting? We will do the accounting based on present values. What is the present value? All of these represent the present value, and accordingly we will do the accounting for. Okay. Now, a simple thing, just don't do this in the examination. If I sum all of this present value, it comes to only 546. Okay. Now, I am not saying that 546 will be recognized in each year. At the beginning of the year, this represents the service cost. But we are paying 655. What is the difference? The difference is on account of interest factor. Okay. That is what we will do. So, in year 1 you will say my service cost is 89.47. In year 2 you will say 98.42 is my service cost. Then 108.26 is the service cost, 119.09 is the service cost, and 131 is the service cost. Each year you will provide for service cost based on these amounts, right? Now, let us prepare another table and see how do we take this service cost, how does the interest impact this, and how do we ultimately reach the closing balance of 655. Let us now see how do we calculate the interest cost and the obligations at the end of each period. Please understand, friends, the service cost that is being recognized is at the end of each period. Okay. So accordingly, you will need to calculate interest and also arrive at what is the obligation. Now, this all years represent end of the period. Now, what is the opening balance of obligation? Now, when I say opening here and closing here, this refers to this obligation, right? What is the opening obligation? There is no opening obligation, so it is 0. And when do we recognize the service cost? We will recognize the service cost at the end of the period. So that is how much? 89.47. So service cost recognized at the end of the period is 89.47. Now tell me one thing, if you are recognizing some liability or obligation at the end of the period, do you think you need to provide any interest on that? We will not provide any interest, right? So interest for this period is 0 and the closing balance is your opening plus interest plus your service cost. The closing balance is 89.47. We have done enough of these kind of liability and interest calculations in leases, in Ind AS 16. By now you would have been expert in doing this, right? Then in the second period, what will be the opening balance? 89.47. On this opening balance, that is from the beginning of year 2 till the end of year 2, you will need to provide for 10% interest. So 89.47 multiplied by 10%, interest comes to 8.95. 8.95 rounded off. Okay. And how much is the service cost? Service cost for second year we calculated to be 98.42. Okay. What is the closing balance? Opening 89.47 plus interest plus service cost 196.84. Similarly, opening for next year, interest 19.68, service cost, closing balance. How did we get 108.26? This number. Then year 4, opening balance 324, interest on that 32.48, 119.09 is that year's service cost, closing is 476.36, and at the end 476.36, interest 47.64, service cost 131. Now please note, at the end of year 5, whatever the service cost is being recognized, that is equal to 1% of salary, and because we will be settling it at the end of the same year, there will be no interest cost involved in that. And what is the closing balance? 655. What do we do with this 655? Pay the employee. Now here we are assuming that there will be no changes in any kind of actuarial assumptions, there will not be changes in the interest rate and all of those things. 655 is what will be paid to the employee at the end of year 5. Now, each year we have recognized this cost, right? This is called current service cost. This is called current service cost. Why are we recognizing this cost? Because the employee has rendered 1 year of service, and because of which the employee is entitled to a payment at the end of year 5. That is why we are recognizing this cost, and this is called current service cost. Now, what is the meaning of current service cost? Current service cost basically represents the cost that is attributable to the service rendered in the current period. So, for year 1 it is 89.47, then 98.42, for year 2 108, 119, and for the 5th year it is 131. Okay, that is what is called current service cost. Then what is this interest cost? This interest cost represents the increase in obligation, because we have moved forward by one period. See, we moved forward from end of year 1 to end of year 2. 8.95 represents the interest cost or the interest element, because we are moving 1 year closer to the obligation settlement date, right? This is what is called the interest cost. And what is this 89.47, 196, 324, 476, 655? This is nothing but the present value of obligation. This is nothing but the present value of obligation or the benefit which is payable as at the end of the period for services already rendered. What do I mean by that? 89.47 represents the obligation at the end of year 1 for services rendered in year 1. 196.84, what does this represent? This represents the obligation at the end of year 2 for services rendered in year 1 and year 2. So basically, at the end of the period, whatever is the present value of the obligation, that is, so basically at the end of the period, for example at the end of year 2, what is the present value of obligation? What is the present value of obligation for services already rendered by the employee? That is, year 1 and year 2, whatever is the service, for that what is the present value of obligation? So what are we trying to do here is, if you just want to reconcile this 196.84, for year 1 and year 2, obligation will be 131 multiplied by 2, which is 262. Okay, this 262 is payable at the end of year 5. What is the present value at the end of year 2? So basically we have to discount this by 3 periods, right? This will be paid at the end of year 5. We need to know what is the present value at end of year 2. So basically we are looking at 3 discounting periods. So 262 divided by 1.10 to the power of 3 gives me 197. So if I increase it, it becomes 196.84. So this 196.84 represents the present value of obligation for services which the employee has already rendered in the past, right? This is called a defined benefit obligation. What is it called? Defined benefit obligation, DBO, defined benefit obligation. So in the example that we just saw, we understood what is a current service cost. We also understood what is the interest cost, and we also understood how do we calculate the present value of a benefit obligation. Now when I say a benefit obligation, we are talking about a defined benefit obligation, right? Now what is this current service cost? Current service cost is the increase in the present value of the defined benefit obligation resulting from employee service in the current period. Now if you go back to the calculation that we just did, the closing balance of the obligation was increasing, correct? In every period, the closing balance of the obligation was increasing. One increase was because of the current service cost, that is, the employee has rendered some service in the current period. Because of that, there was an increase in the obligations. So basically, that increase by 89, the increase by 98, right? Those are increase in the present value of obligation because of employee service. Now, apart from this, what was the other factor resulting in the increase? The increase was because of passage of time and because of interest cost, right? So the increase because of passage of time is called the interest cost. The increase because the employee has rendered the service in the current period, something which pertains to the current period, is called the current service cost. So we have current service cost and interest cost. Then what is this present value of defined benefit obligation? Present value of a defined benefit obligation is the present value of expected future payments required to settle the obligation resulting from the employee service in the current and prior period. So when we calculate the present value of a defined benefit obligation, we are considering the obligations only for the period for which the employee has already rendered the service, that is in the current period as well as in the previous period, right? That's why I calculated one number and showed you for year 1 and year 2 what is the present value of the obligation. That is called present value of defined benefit obligation. In simple word, this is the closing balance of obligation that you actually calculate. Now, so far in our discussion and in the example that we discussed just now, we understood what is the current service cost and we also understood what is a defined benefit obligation and how do we compute the present value of defined benefit obligation, right? Now, these are the three key terms that you need to understand before we move further. When I say defined benefit obligation, we are looking at what is the obligation under the defined benefit plan. And at the end of each year, the obligation on the employer is nothing but the present value of the defined benefit obligation for services already rendered. And what is the meaning of current service cost? Current service cost is nothing but the part of benefit which is attributable to the service rendered in the current period, right? So, I have seen that the final obligation is attributed or allocated to each of the year and we calculated the present value to arrive at the current service cost. Now, to this current service cost, every period will add the interest cost and whatever is the closing balance, that is nothing but the present value of the defined benefit obligation for services already rendered. Now, before we move further, let us understand what are the various things that could impact the defined benefit obligation. See, when we talk about gratuity, we said there is a formula, 15 days of salary for every completed year of service multiplied by last drawn salary, right? Now, it's not just one employee, correct? There are hundreds and thousands and lakhs of employees in an organization. So, what are those factors which would impact the final benefit obligation? One thing is obviously the number of years of service. If we assume that the employees on an average would work for 5 years, there would be one amount of obligation. If we say no, employees would actually work on an average for 6 years or 7 years, as we keep on increasing the average expected year of service, the final obligation would also change, okay? Then there could be an impact of, the discounting factor, interest rate changes. There could be an impact of number of employees who would leave the organization and who would join the organizations. And all of these are assumptions that we make to arrive at the benefit obligation. See, when you look at an organization, no one would for sure be able to say that how many employees would work for how many years in the organization, and also what would be their salary at the time of resignation or retirement, because salary increment would happen on a year-to-year basis. Sometimes they may give a higher increment, sometimes they may not give high increments, right? And it might also be possible that employees who are leaving the organization were having lesser salaries, employees who are joining the organization who are more experienced will now draw more salaries. All of these factors would ultimately impact the benefit obligation. And as we understood earlier as well, all of these assumptions and estimates are made by actuary and these are called actuarial assumptions. These are called actuarial assumptions. Now please understand, whenever an actuarial assumption changes, there would be a change in the obligation. For example, let us say we assume that on an average an employee would work for 5 years in the organization. Based on that, we would arrive at some amount of benefit obligation. But now let us assume for a moment, as time passed by, the actuary came back and said, looking at the past history and looking at the employees working in the organization, we believe that on an average an employee would not work for 5 years, but he would actually work for 6 years or maybe 7 years. Now, the moment you change this assumption, the obligation payable also changes, right? Because earlier you thought that employee would work for 5 years and accordingly you would have calculated the obligation. Now, for 7 years, the obligation would be higher. Similarly, there could be changes in estimates of salary. Earlier we thought salary would grow by 5%. Now, if we assume that salary will grow by 8%, then again your obligation would change. So, what happens is, as time passes by, every period, the actuarial assumptions may change, and it is not only increase in obligation, there may be a decrease in obligation as well. So, Based on this, the final obligation may change, and accordingly, whatever is the expense that you recognize in a current period might also change. Say for example, an employee joined an organization in year 1 at some salary, and it is expected that the employee would work for 5 years and the salary increase would be 5% every year. Based on that, we calculated the obligations, we calculated the current service cost. Now in year 3, say for example, the actuary comes back and says, based on your increment in salary and all of that, salary will not increase by 5%, but it will actually increase by 10% going forward. Now, because the salary will increase by 10% going forward, what will happen to the gratuity which is receivable by the employee? The gratuity that the employee will receive will be higher. Now, that higher amount of gratuity, is it only for year 3, 4 and 5 or right from year 1, 2, 3, 4 and 5? It is right from the beginning, correct? It is right from the beginning. Now, why are we saying here that the gratuity payable will be higher? Because the actual assumption for increment in salary has changed, right? Now, as far as year 3, 4 and 5 are concerned, we can consider that as a part of current service cost. But what about the incremental benefit payable for year 1 and year 2? That is something what we call as actuarial loss. Actuarial loss. Why loss? Because the obligation has increased. Similarly, there may be a case where the obligation reduces. In that case, we will say this is a part of actuarial gains. So, while determining the overall employee benefits, what happens is we make a lot of actuarial assumptions. Okay, we'll come to the various kinds of assumptions we take. Based on those assumptions, we make estimates of obligation. Now, these assumptions may change year on year basis. Okay, every period there may be changes in assumptions. Now, if because of assumption changes, there is an increase in obligation, then we say there is an actuarial loss or loss on account of changes in actuarial assumptions. If there is a reduction in obligation, then it would be an actuarial gain. Okay, so actuarial assumption is one thing which would impact the estimation of obligation that an employer would be making. This is one category. There could be another scenario where actuarial assumptions may not change, but the employer changes the plan. Now, what am I saying here? Initially, what the employer said was, for every completed year of service, we will pay you 15 days of salary. Now, the employer in the third year comes back and says, for every completed year of service, we will pay you 1 month of salary. Oh wow! So, suddenly from 15 days, it has become 1 month. Now, tell me one thing. Is this a change in assumption or is this a change in plan? This is actually a change in plan. This is a plan amendment. This is a plan amendment which will now entitle the employee will be able to get more benefits. Now, whenever such kind of plan amendments happen, what would be the impact? Take the same example. Year 1 the employee joined. We estimate him to work for year 5. In third year, the employer said instead of 15 days salary, we will now pay you 30 days salary. Now, what will happen? The final obligation will increase. The final obligation will increase. Again here, for year 3, year 4 and year 5, you will increase the current service cost accordingly. But what about the incremental benefit that the employee is entitled for year 1 and year 2? Like for year 1 and year 2, because finally the amount that will be paid will be based on 30 days salary, correct? Now, because there is an increase in obligation, because of change in plan, we have to pay the employee extra benefit for year 1 and year 2 as well. And did we provide for year 1 and year 2? We did not provide. Now, in such a scenario, the incremental benefit which is attributable to year 1 and year 2 is called past service cost. It is called past service cost. Now, please understand, past service cost arises because of plan amendment, whereas actuarial gains or losses arise because of changes in actuarial assumption. This distinction is very, very important for you before we proceed further in this particular chapter. So, what would happen? The first case is changes in actuarial assumptions, like we change the estimated number of employees, or we change the discounting factor, or we change the estimates of salary, or we change the number of years that the employees would work, right? Those changes can also increase the obligation or reduce the obligation. If it increases the obligation, there is an actuarial loss. If it reduces the obligation, there is an actuarial gain. Okay, that is one aspect. The other aspect is there is a change in plan itself. There is a change in plan itself because of which an employee is entitled to higher benefit. Now, whatever is the extra benefit for the current year, we will say it is a current service cost, but there is a portion of extra benefit which is attributable to first 2 years or the earlier years, that is what we call as past service cost. Now, you may get a doubt as to, sir, can there be a plan amendment where the employee get lesser benefits? Yes, even that is possible. The employer may say, instead of 5 years, we will pay gratuity only if someone works for 7 years. That is possible, obviously, if the law allows it. Okay, so the employer can have such kind of changes to the plan where the benefits are reduced, and this is called curtailment. This is called curtailment. Now, why is it called curtailment or benefits are reduced? Because if you see number of employees who work for 5 years, they will be more than the number of employees who would have completed 7 years of service, right? So, if you change the plan and if you reduce the scope of the benefit, then it is called a plan curtailment, right? Now, I hope you have understood about what is the impact of changes in actuarial assumption and what is this thing called a past service cost. So, friends, let us now understand two important concepts. One is a benefit payment and other one is a settlement, okay? What is the meaning of a benefit payment? Benefit payment basically means under the plan, the payment is happening to the employee. So, let us say the employee is entitled to gratuity. Now, when I say benefit payment, we are actually paying gratuity to that particular employee, or employee is entitled to pension. So, when you make the pension payments, that is what is called a benefit payment under the plan. There is another concept called settlement. Now, what is the meaning of settlement? When do we settle? Say there is a dispute between two parties, party A and party B. Okay, party A says, I want 15,000 of payment. Party B says, no, I'll give you only 10,000 of payment for some transaction, right? There is a negotiation going on, and finally they say that, okay, I'll pay you 12,500 and let us settle the account. Okay, now it can happen in multiple transactions. There could be quality issues, there could be rejections issues, there could be legal cases. Wherever you hear this term settlement, what comes to your mind? Two parties are coming together, they are negotiating on some amount and they are saying, okay, finally this is what has to be paid to settle the transaction. Now, once you settle the transaction, what would happen? Is there any further obligation on either of the parties? Let us say A and B agree that the transaction will be settled at 12,500. Now, after 12,500 is paid by B to A, is there any further need to make any payment? Is there any further obligation on the part of B? Is there any receivable from the point of view of A? There is no future obligation, right? That is what is called settlement. So, maybe A had recognized receivable of 15,000, but 12,500 was what was received by A. Similarly, B would have accounted for a payable for 15,000, but B paid only 12,500. Now, at the time of this settlement, B stands to gain 2,500 and A stands to lose 2,500. Now, coming to employee benefits plan, settlement can happen here as well. Now, we have an employer, we have employee, okay. Say for example, employer is required to make monthly pension payment after retirement to the employees. But for some reason, the employer financial situation or condition is not so great. So, what the employee says, we do not trust you, we do not know whether you will pay us the pension or not. What you do is, you transfer the amount which is payable to us as pension, whatever is the value as on today, you transfer that to a third party, maybe an insurance company. An insurance company will make us the pension payment. And for this deal, maybe the employees are ready to give up some of their benefits also. Maybe they are entitled to pension of 10,000, but they say that we are happy with a pension of 8,000, but we do not trust you, your financial condition is not so great. You transfer that amount to an insurance company, you buy an insurance policy for us, under which we will be getting pension payments regularly. We don't need 10,000, 8,000 is also fine. Now, what is this? This is a form of settlement. This is a form of settlement. Once the employer buys that insurance policy, then after that, employer no longer has any further obligation. Employer has settled the obligation under the employee benefit plan. After that, it is headache of the insurance company who will pay the regular pension to these employees, right? This is what is called settlement. Now, what happens in settlement is, there could be cases where there is a gain on settlement, there could be cases where there is a loss on settlement, depending on which party is in a position to negotiate better, right? So, in this example that we said, employees were entitled to 10,000 rupees per month of pension, but now employees are okay with 8,000 rupees per month of pension. Is it a gain or a loss? It is a gain, right? It is a gain to the employer, not to the employees, gain to the employer. So, there may be gains on settlement, there may be losses on settlement, right? Now, this gain or loss on settlement is also a part of your service cost, right? So, whatever we have discussed so far, service cost comprises of current service cost, past service cost and gain or losses on settlement of employee benefit plans. Now, take another situation. Say, employees are entitled to pension of 10,000 rupees per month after retirement. Now, you would have understood or learned about a concept called commuting of pension or commutation of pension, right? In your income tax at your CA inter level, you would have learned about this concept. So, say there is an option given to the employees that in lieu of pension, that is in place of pension, they can take a lump sum payment. A lump sum payment would be made by the employer to the employee. Now tell me one thing, is this a settlement or is this a benefit payment? This is a benefit payment, okay. If something is paid as per the benefit plan, a lump sum payment, that is a benefit payment, that is not a settlement. So please be clear that the settlement aspect is different and benefit payment is different, okay. When you are settling, there is no future obligation. When you are making a benefit payment, you are making the benefit payment as a part of the benefit plan. So if you are paying gratuity to the employees, the gratuity paid at the time of resignation is employee benefit payment. It is not a settlement. Settlement happens when the entity enters into a transaction and eliminates any future obligation or payments, right. That is what is called settlement. But something which is paid as a part of the plan, that is not called settlement, that is a part of benefit payment. Now whenever there is a settlement, as we said, there could be a gain or there could be a loss. Now what is this gain or loss on settlement? The gain or loss on settlement is the difference between the present value of the defined benefit obligation being settled as determined on the date of settlement and the settlement price including any plan assets transferred and any payments made directly by the entity in connection with the settlement. Simply put, the settlement gain or loss is the difference between what is the present value of obligation on the date of settlement and what is the price that is paid to settle that particular obligation. Now price paid meaning you could transfer assets, you could make a payment by way of cash, you could make payment to any third party, whatever is the payment you make, compare that with the present value of obligation, whatever is the difference will be your gain or loss. If the settlement price is less, there is a gain. If settlement price is more, there is a loss, right. So this is what you need to understand as far as gain or losses on settlement is concerned. Now so far we have understood about what is the meaning of current service cost. We have understood about what is the meaning of past service cost, and there is this net gain or loss on settlement of employee benefits. All these three put together is called service cost, okay. Actual gains and losses are different, they are not a part of service cost, please understand that. So what is service cost? Service cost is current service cost plus past service cost plus any gain or loss on settlement of the employee benefit plan, right. Let us have a look at the definition of service cost and then I will take you through one example where I will actually show you what is the impact of what is the impact of a plan amendment and how do we calculate the past service cost before we move further. Service cost comprises of current service cost and we have already understood what is the current service cost. Current service cost is the increase in present value of the defined benefit obligation resulting from employee service in the current period. So once the employee renders service in the current period, whatever is the increase in defined benefit obligation, that is what is called current service cost. And please note, when we calculate current service cost, we have to take the present value. Then we have past service cost. What is the past service cost? Past service cost is the change in the present value of the defined benefit obligation for employee service in prior periods. So the increase in present value of defined benefit obligation is because of services rendered in the prior periods. If it is increased because of current period service, then we call it the current service cost, right? Now why will this change happen? This will happen because of a plan amendment. It will happen because of plan amendment. What is the meaning of plan amendment? Plan amendment could be introduction or withdrawal or changes to a defined benefit plan. So it is possible that you introduce a new plan. It's also possible that you introduce a new plan, you withdraw an existing plan, which is less likely the case, or you make changes to the plan. Now what are these three scenarios? One, there could be an introduction of new plan. Maybe there was no gratuity related benefit plan available in the organization. They have introduced that. Okay. So that is an introduction of plan. Or they might withdraw a plan. Okay. If allowed by the statute and if allowed by the law, existing plan may be withdrawn. And third thing is there may be amendment to the plan. So what you need to understand is when you introduce a plan, what would happen? The cost would increase. So you'll have a past service cost. If you withdraw a plan, what would happen? The obligation would come down, so there will be a kind of a gain. Okay, we still will denote it as past service cost, but denote it as a negative number. Then if you amend the plan, for example, instead of 15 days salary, you say 1 month salary, right? That is an amendment to the plan. Now because of this, if there is a change in the present value of defined benefit obligation, we call it past service cost. And apart from that, it can also arise out of a curtailment. What is the meaning of curtailment? You are changing the plan in a way that the number of employees covered by the plan have reduced significantly. For example, as I told you earlier, we said entitlement for gratuity is after 5 years of service. Now we are saying entitlement for gratuity is after 7 years of service. Now what will happen because of this change? After this change, the number of employees covered by the plan would reduce, right? All of this would result in changes in present value of defined benefit obligation, and that is called a past service cost. If it is an increase in obligation, it will be an expense item, otherwise it will be a gain item, which you will denote it as a negative number, right? So just to finally summarize, what is service cost? Service cost comprises of current service cost, past service cost, and any gain or loss on settlement. Right, current service cost we have already understood in detail. What is past service cost? Past service cost is the change in the present value of defined benefit obligation because of either introduction of a plan, withdrawal of a plan, amendment to a plan, or because of curtailment. And then finally we have net gain or loss on settlement. All of these put together is called the service cost. Now in examination, what you need to keep in mind is, if the question asks you service cost, then you have to include all of these three. If the question asks you only current service cost, and then you have to calculate only the first component or the first part. So let's have a look at the definition of actual gains and losses. Actual gains and losses are changes in the present value of defined benefit obligation. So here also there is a change in defined benefit obligation. Why? Resulting because of experience adjustments, that is effect of differences between the previous actual assumptions and what has actually occurred, and the effects of changes in actuarial assumptions. Now here changes are happening because of experience adjustments and changes in actuarial assumptions. What is the meaning of experience adjustment? We initially would have estimated something. Let us say the salary increment on an average would be 5%. That is what we had estimated. But actually salary increased by 6%. So because of this, whatever is the change in the obligation is a part of actuarial gains and losses. And now if the actuarial assumption changes itself, then even that is a part of actuarial gains and losses. Now if you recollect all of these things, everywhere we are talking about changes in the present value of defined benefit obligation. Meaning to say, there is some defined benefit obligation, and the present value of that at the end of the period for services already rendered, we will calculate that present value of defined benefit obligation. This obligation will change because of multiple reasons. The first thing which causes the change in the present value of defined benefit obligation is the current service cost. That is, because the employee has rendered services in one period, because of that the present value of defined benefit obligation is changing. That is called current service cost. Then we had something called interest cost. Here also present value of defined benefit obligation is changed because of passage of time, right? As time passes, the present value of defined benefit obligation would increase, and interest cost is that component which results in increase in the present value of defined benefit obligation because of passage of time. Then there could be an impact of past service cost. Again here there is a change in the defined benefit obligation because of maybe either introduction of plan, withdrawal, amendment or curtailment. There is a change in the present value of defined benefit obligation. That is called past service cost. Then we had actuarial gains or losses. Even because of actuarial gains or losses, there could be a change in the present value of the defined benefit obligation. The current service cost and past service cost are a part of the service cost. Interest cost is separate and actuarial gains and losses are separate. Now let's understand both this changes in actuarial assumptions and how does it impact our calculation, as well as what happens when there is a change in the plan which results in a past service cost. Now you may not be tested on calculations in the examination, but I believe that to understand the fundamental difference and the way it impacts the computation is necessary, right? Just by reading the definitions and memorizing few stuff will not actually help us to appreciate how things actually work. So we'll take the same example that we have taken earlier in our working, salary at 10,000, annual increment, initial estimates. Okay, whatever these are written here, these are initial estimates. So these are all initial estimates. 7% of salary increase, and accordingly we arrived at the salary at year 5 as 13,108, and we did this calculation as per our previous working, and then we prepared a schedule and calculated what will be the service cost, what will be the interest cost, and what will be this closing obligation. Now this closing balance is nothing but your present value of DBO for completed years. So basically 89.47 represents present value of 131 for 1 year of service which is completed, right? Accordingly each of these represent, if I say 196.84, this is present value of defined benefit obligation pertaining to these 2 years. So if you have to cross check, I think we did it in the illustration as well, but if you have to cross check, let us say we are looking at something at end of year 4. I'm looking at something at end of year 4. So we are looking at end of year 4. What is the total obligation? Obligation will be 131 multiplied by 4, right? That is 524. That is the total obligation, not discounted. What will be the present value? Because we are at the end of year 4, we will have to move forward by 1 year. So the present value factor relevant will be 1 year. So present value at 10% for 1 year will be 1 divided by 1.1. You get 0.9091. So what is the present value? Present value is 524. Multiplied by 0.9091, 476.36. Now this is one concept which you have to be thorough with, because unless you understand this, other concepts will appear to be in Greek and Latin, and you will end up just memorizing how to do problems rather than understanding what is happening. So when I say 476, this 476 represents present value of this 524, the cumulative benefit obligation, and because it will be settled after 1 year, we are calculating for a 1 year period and we get this, right? So this is one thing what I wanted you to understand. Now, say for a moment that we had initially estimated, the salary would increase by 7% every year, and accordingly we did the calculation. But for a moment, assume that in the 4th year, the salary increase was not 7%, but it was 10%. For whatever reason, salary increase was 10%, and now it is estimated that in the future period also, the salary increment will be 10%. So what will happen to the salary in that case? Let's write down here. So you have estimated salary increase to be revised, which will be 10% in year 4 and 5. So instead of the annual increment what we had initially estimated, which is 7%, now we are saying it will be 10% in year 4 and year 5. So let us note down what will be the salary, years salary, okay, 1, 2, 3, 2, 3, 4 and 5, right. What is the salary? Salary was 10,000 beginning, that is the same. Then year 2 7% increase, 1.07. Then year 3 also 7% increase, 1.07, right, 11449. Now this is 7% increase, 7%. Then this is also 7% increase. This is 10% increase, and this also is 10% increase. Now what happens if there is a 10% increase? This multiplied by 1.1, it is 1259.3.9, and now it is 13853.29. Now suddenly from 13100 what we had calculated earlier here, 13108, it has now become 13853. What will be 1% of salary? 1% of salary will be 13853 multiplied by 1%, that comes to 138.53. Let me round it off to 139. Okay. Now because of this, what will be the benefit payable? The benefit payable will be 139 multiplied by 5, it has now become 695. From what? From your initial estimate of 655, now it has increased to 695. Now, this change has happened because of what? This change has happened because of changes in actuarial assumption. Because we have changed the assumption, right? From 7% it has become 10%. This has resulted in change in actuarial assumption. Now, because you have changed your actuarial assumption, you will also have to change your benefit obligation, and you will also have to change your current service cost, because earlier you were calculating current service cost considering 131. Now you have to calculate current service cost for 139. Now, in year 4 and year 5, you can calculate considering year 139, because these are not yet passed. But what do we do for things that have already happened in year 1, 2 and 3? Now that part will be considered as actuarial gains and losses, and it will be added to the obligation, right? In this case, because there is an increase, it will be added to the obligation. Please note, this is not a past service cost, because we have not changed the plan. Plan is same. Our estimate of salary increase has changed, right? So if you prepare this table again from year 1 to year 5, let me just copy it down. Now revised table. Revised table will be considering what? Will be considering 139. Will be considering 139 every period. Okay. And your present value will also change automatically. Now here please understand, for year 1, 2 and 3, the changes in present value will be treated as actuarial gains, or in this case it will be an actuarial loss. And for year 4 and year 5, you will revise the service cost based on the revised calculation. So if I pick it up again, this part of calculating of interest cost and obligation. So now let us see how do we update this table. Now as I told you, service cost for this period, that is year 4 and year 5, these two have to be updated with the revised number, and the cumulative impact for the previous period will be treated as actuarial gains or losses. So this 119 and 131 will actually now be 126.36 and 139. So this will be 126.36 and this will be 139. Okay. Now, after considering 126.36 as the current service cost, what is the closing balance? 483.64. But what should have been the closing balance, or what is the ideal closing balance? Closing balance at end of year 4 considering revised assumption. What should that be? We know we are looking at year 4. So, for 4-year period. So, 139 multiplied by 4. Why 139? Because for each year the employee is entitled to 139. 139 multiplied by 4 and we have to discount it by 1 period because we are at the end of year 4. So, that will be basically divided by 1.1. You get 505.45. If you are finding it difficult to follow, benefit obligation for 4 years is 139 multiplied by 4, this multiplied by this, 556. Present value factor for 1 year at 10%. Why 1 year at 10%? Because we are at end of year 4, this amount would be payable at end of year 5, we have to discount it by 1 year. So, there will be 1 divided by 1.1, you get 0.9091 and 556 multiplied by 0.9091, you get 505.45. Now, this 505.45 is the should have been the closing balance, but what is the closing balance? 483.64. So, you have to increase the obligation. That increase in obligation is nothing but your actuarial loss. So closing balance as per existing computation worked out to how much? 483.64. Correct? So, loss. Actuarial loss is 505.45 minus 483.64, which is 21.81. Now, what do I do with this 21.81? This 21.81 will be added here. So, I will create a column called actuarial loss. How much? 21.81. Okay, and accordingly update the balance. You will add that 21.81 and now your balance is 505.45 and next period once you add 139 you get 695 and that is what is payable, right. I hope now you understood what is the meaning of this actuarial loss and why are we accounted in year 4, because originally service costs were accounted as 98, 89, 98 and 108, whereas it should have been 94, 104 and 114. And on this, there will also be an interest cost impact. Okay, considering both of these, the final difference comes to 21.81, which is the actuarial loss. Right? So, this is how we calculate actuarial loss. Accounting aspect of actuarial loss, we will come to it slightly later once we understand in detail as to what are the various components which impact the actuarial losses, what are the various kinds of actuarial assumptions. After considering all of them, we will understand the accounting aspect. Right? Now, this one is actuarial assumption changes. Now, using the same example that we have taken earlier, we will see by making an amendment how do we calculate past service cost. Now, considering the same example that we took earlier, right, now let us say it was again annual increment of 7% and that holds good and we have final salary at as 131.08 and benefit is payable at 1% per year. Based on that, we are calculating the service cost and the interest cost. Let us assume benefit payable changed to 2% for every year. Okay, and this change happened at the end of year 4. Now, what does this mean? This means that employee who completes 5 years of service will get 2% of the salary as benefit for every completed year of service. Okay. Now, is this 2% only for year 4 and year 5 or right from year 1 to year 5? This is a retrospective change or this is a kind of change in which the employee would get benefit also for the past year. So, for the entire 5 years, the employee would now get 2% of salary instead of 1% of salary. So, what is the revised thing? So, just note the revised benefit. Revised benefit is what? 2% of salary. Okay. Now, what is salary? End of year 5 estimated is how much? 13,108, right? 13,108. Now, salary at the end of year 5 is 13,108. Okay. On this 2% of salary. So, benefit for each year is how much? 2% multiplied by 131.08, that comes to 262.16. We'll round it off to 262. Now, instead of 131, we are saying we will pay 262. We are actually doubling up the benefit. Okay. The extra benefit is attributable to all years of service. It is not for year 4 and year 5 only. from year 1 till year 5 you will have to pay extra benefit. Now for year 4 and year 5, whatever is the extra benefit attributable, we will include that as a part of current service cost. But for whatever has happened in the past, for whatever is the services which are rendered in the past, for that period, the benefit that is attributable will be treated as a past service cost. Something like a prior period item, not exactly a prior period item, something like prior period item. Whatever is the impact for the current period, we will say current service cost. Whatever is the impact for the previous period, we will say past service cost. Okay, so now the benefit is revised benefit. Now the revised benefit if we do is 262. Correct. So like this, if you do 262, your cumulative benefit also doubled up, and this 238 and 262, this will be the current service cost only, and whatever is the difference and interest impact on that from the previous periods, that will be treated as a past service cost. So how your table would look like is, here your current service cost will be 238. So basically this revised amount 238 and 262 will be considered as a part of your current service cost. Okay, so I'll just write it here. This is current service cost. Current service cost, this is not a service cost, current service cost, and whatever pertains to the previous period will be treated as the past service cost. So you'll have a past service cost. Okay, so you'll not be just update that. The thing that we need to understand is what should be the closing balance at the end of year 4 after considering amendment. So closing balance at end of year 4 considering amendment. How much should that be? Again, like we did earlier, for 4 years of service multiplied by each year is now entitled to 262 divided by 1.1. So it should have been 952.73. What is closing balance? As computed above, what is the closing balance? It is 595.45. So past service cost is the difference between these two, 952 minus 595, which is 357.27. So 595.45, I'll do it manually, 357.28. Okay, so 357.28 if you adjust as past service cost, then you can see that this gets added as past service cost and you have a closing balance of 952, and next period 262 gets added and the closing balance is 1310, which is nothing but your obligation, right? Now what does this 357 represent? This 357 represents the earlier cost which was not recognized and now we are recognizing. Now if you just want to have a look at the difference for first 3 years, we can consider what is the original present value and revised present value. So original present value we had calculated earlier is 89, 98 and 108. Okay. Present value revised. What is the revised present value? 178.95, 196.84 and 216.53. Okay, these three. Now, what is the difference? Difference is 178 minus 89.74, 89.74, 98.42 and 108.26. Basically, it has doubled up. Now, if you simply sum this up, you will see the difference is 296, but here we are saying 357. Why? Because of the interest cost factor. The reason being, this is end of year 1, change is happening at the end of year 4. So 3 years of interest cost also needs to be factored in. So these are the differences which are at the end of respective year. We have to include the interest component also. So basically we will have to calculate what would this 89.47 be at the end of year 4. So future value we can consider. Now when we calculate the future value, it is 89.47 and we have to move this by 3 years, end of year 1 to end of year 2, end of year 3 and end of year 4. So this will be multiplied by 1.1 to the power of 3, this one will be to the power of 2 and this one will be to the power of 1, and if you sum this up you get 357.27, which is nothing but your past service cost. So basically what are we doing is, whatever is the difference which is attributable to previous period including interest component, we are calculating and arriving at 357.27. The other way to look at this is, I am giving you one more angle to look at this. What is the incremental benefit per year? It is 131. Incremental benefit per year is 131. Number of years passed is 3. Okay. Benefits attributable 131 multiplied by 3, you get 393.393. Okay. Now 393 is the benefit which is attributable, undiscounted value for the previous period. Now how many years are left when we are doing this recalculation? 1 year is left. So discount factor at 10% for 1 year. is 1 divided by 1.1, right? And if you multiply this with this, you get 357.27. Okay. Now, don't get overwhelmed with this calculation. I have just tried to explain it to you how the numbers impact your ultimate calculation. Finally, what you need to understand, and let me tell you, Institute will not be asking you how to calculate all of these things. This is purely for your understanding. That is, if I change the plan in a particular year, how does it impact my final settlement? How do I calculate the past service cost? That is what we are trying to understand here. You will not be tested this in the examination, but your concepts must be clear as to what should be considered as a past service cost and what should be considered as a actuarial gains or losses. Now, in the examples that we took so far, we calculated the final benefit obligation and attributed the benefit obligation to each period of service. This method is called projected unit credit method. No need to worry about the name, that is the single method which is prescribed by Ind AS 19. Now, what is the meaning of this projected unit credit method? It simply has an assumption that each unit of service period, that is each year of service, will result to some kind of benefit which is payable in the future. So, you will have to estimate the benefit and attribute that to each unit of service, right? So, that is what is called projected unit credit method. So, for each unit of service, you will have to credit some form of obligation or credit some form of benefit, right? That is what is called the projected unit credit method. Now, before we move further, let us understand two important concepts, that is vested benefits and non-vested benefits. Okay. Now, don't get confused between the vesting absences and non-vesting absences that we discussed earlier. There, vesting was which can be encashed, non-vesting was which cannot be encashed. Now, here, vested benefits and non-vested benefits is what we need to understand. Now, going back to the same example of our gratuity, I joined an organization in year 1. And if I complete 5 years of service, I will be entitled to gratuity. But what if I leave the organization in the 3rd year? If I leave the organization after completing 3 years, will I get gratuity? I will not get gratuity, because gratuity entitlement is only after I complete 5 years of service. Now, if I leave the organization after 7 years of service, then will I get gratuity? Yes, I will get gratuity. Now, here what you need to understand is gratuity as a benefit vests on the employee at the conclusion of the 5th year. Till that time, it is called to be a non-vested benefit. It is called a non-vested benefit, meaning to say, if a benefit is vested, then employee is not required to fulfill any further condition to get that particular benefit. That is, if I complete 5 years of service, am I required to work even for 1 day extra to get the gratuity benefit? I am not required to work even 1 day extra. At the end of 5th year, the benefits have vested on me and I am not required to fulfill any further condition to get that particular benefit. Such benefits are called vested benefits. Till the time a benefit is vested, it is treated as a non-vested benefit. So, if an employee works for 2 years or 3 years or 4 years, the benefit would not vest on the employee. Now, you might be wondering, sir, if the benefit doesn't vest on the employee, then why are we creating, obligations? Why are we calculating this present value of defined benefit obligation? Why are we computing the benefit for the 5-year period and attributing to each year of service? Now, here where the role of actuary comes into play. For all the employees, we will not be saying that, they'll work for 5 years. The actuary will assume that so many number of employees will work for, let us say, 1 year, some will work for 3 years, some for 5 years, some for 10 years. And based on these estimates, we will calculate the benefit obligation. Okay. We took the example of one employee for understanding, but it is not done on an employee basis. They will take the entire set of employees in the organization, say for example 10,000, and actuary maybe makes an estimate that 70% of these employees would complete 5 years of service. Then for the 70% of employee is what we will calculate the defined benefit obligation, the service cost and other related items. For the 30% who are not expected to work for 5 years, will not be providing for any kind of such obligation or will not be charging any kind of service cost in the P&L, right? So, what you need to understand is benefits may vest at the conclusion of 5 years. That does not mean that you will not account for the benefit expense in the respective period. You will have to make an estimate. There will be probability related estimates. You will have to see what is the expectation that some employees will complete 5 years of service, 10 years of service. What will be the average life of the employee in the organization? You have to do all of these estimations. You have to attach probabilities and then calculate the benefit obligation. And again, thankfully, we don't have to do those calculations. It will be given by an actuary. Let's now take few scenarios and understand how would the benefits vest and how would the benefits be attributable to each year of service. Now, one thing that you need to understand is even if the benefits do not vest immediately, even if they vest after a few years of service or 5 years of service or 10 years of service, the entity has to make estimates. They have to make estimates using probability as to how much of those benefits would eventually vest, and accordingly they'll have to compute the current service cost and the present value of defined benefit obligation. You can't say that, because the benefit is vesting after 5 years, will not make any provision now. That is not the right approach. You have to consider actuarial assumptions, and you will have to provide for the service cost, and you will have to calculate the benefit obligation. Let's look at few scenarios. A plan pays a benefit of 150 for each year of service. The benefits vest after 10 years of service. Compute the benefit to be attributed to each year. Now, what is the benefit payable? 150 per year of service. Okay. Now, even here it is a defined benefit plan because we do not know the number of years of service that the employee will render. And when will this benefit vest? The benefit will vest after 10 years. The benefit will vest after 10 years. It will not vest immediately. So, how much of benefit is attributable to each year? 150 is attributable to each year. Now, do we say that 150 multiplied by the number of employees will be the benefit attributable? No, that is not how it is done. We'll have to see out of the total number of employees, what is the probability that some number of employees would complete the 10 year of service. We'll have to estimate that, okay, 70% of employees will complete 10 year of service. Okay, and accordingly for 70% of the employees, considering 150 per year, you will calculate the benefit obligation. A plan pays a benefit of 150 for each year of service, excluding service before the age of 25. The benefits vest immediately. Compute the benefit to be attributed each year. Now, what is the case here? Here is a case where 150 per year is attributable after the employee completes 25 years of service. So, let us say after completing 25 years, the employee worked for 2 years. Then, let us say the employee joined 2 years back and he completed 25 years now, and he worked for 3 years after completing the age of 25. Now, how much of benefit would be payable at the end of 3 years after he has completed age of 25? 150 multiplied by 3, 450. Now, is this 450 attributable to only 3-year period or a total of 5-year period? It is attributable only to the 3-year period. It is not attributable to the prior 2-year period because no benefit is payable for the service rendered before the employee completes age of 25. Okay, so you cannot say that 450 divided by 5. No, it is 450 divided by 3 only. That is one aspect. Second, do we need to make estimates of probability here after the employee completes age of 25? No, because once he completes the age of 25, then he is entitled to 150 per every year of service completed. So, there is no need to make probability estimates after the benefits have vested. Only if the benefits have not yet vested. For example, we say after 25 years, he has to work for another 5 years and then he will be entitled. In that case, you will have to factor in the probability estimates. Let's have a look at another example to understand how do we attribute benefits to the years of service. A plan pays a lump sum retirement benefit of 4,000 to all employees who are still employed at the age of 55 after 20 years of service, or who are still employed at the age of 65 regardless of their length of service. So, there are two categories. One, you are employed at the age of 55 and you have completed 20 years of service. Means what? That person would have joined at the age of 35 or maybe even prior to that. Okay. So, if you join before the age of 35 or at the age of 35 and you complete 20 years of service, you get 4,000 rupees of benefit. Now, let us say someone has joined at the age of 20. For that person also, he has to work till the age of 55 to be able to get this 4,000 rupees of benefit. Right? That is the first category. Second category is someone who has worked till the age of 65 years irrespective of when he has joined. So, he might have joined at the age of 55, 56, he might have joined at the age of 40. At any age, if he has joined and he has completed 65 years of age, he gets benefit of 4,000. Now, tell me one thing, if someone has joined at the age of 20 and let us say he works till the age of 65, which benefit will he get? Will he get the benefit after reaching 55 years or will he get the benefit after reaching 65 years? See, someone who has joined at the age of 20, once he reaches 55 years of age, he would have completed that 20 years of service criteria, and at 55 years of age, he will get that 4,000 of benefit. So, we will have to segregate the employees into two categories. First category is employees who have joined on or before attaining the age of 35, because for them, the first trigger would be 55 years of age. So, that is one category. The other category is who have joined after the age of 35. Let us say someone has joined at the age of 40. They will not be entitled to benefit at 55. They will be entitled to benefit at the age of 65 only. Now, in the first category, when we say 20 years of service, which service period is relevant? Service period from 35 to 55 is relevant. Even if someone joins at 20, he will get the benefit only when he is reaching 55 years of age, right? And if you look at someone who is attended 55 years of age, the 20 years of service that he has rendered, which makes entitled to the benefit, begins from 35 years. So, for someone who has joined before completing 35 years of service, for them, the period between 35 years to 55 years, that 20 years of service gives them the benefit of 4,000. For someone who has joined after the age of 35, for them, from the age of joining till 65 years, that period gives them the benefit. So, if someone has joined, let us say at the age of 20, 25, 30, for them, the service period to which the benefit is attributable is 35 years to 55 years, that is 20-year period. You divide that 4,000 by 20, each year you will attribute 200. Okay, that is how you will attribute the benefit. In the other category, someone joining after 35, let us say at 40. Now, if someone joins at 40, what is the service period to which the benefit is attributable? From 40 till 65, that is 25 years. So, 4,000 if you divide by 25, you get 160. So, each year you will attribute 160. Now, here you will have to factor in the probability that employees may not reach the age of 55 or 65, right? And accordingly, the current service cost and the defined benefit obligation should reflect that probability. Amra Private Limited has a plan for its employees where it has decided to pay a lump sum benefit of 2,000 that will vest after 10 years of service. That plan will provide no further benefit for subsequent service. Compute the benefit attributed for 10 years of service and the period of service after 10 years. A very simple example in fact. Now, what is the benefit? After you complete 10 years of service, you will get a lump sum payment of 2,000. Now, this 2,000 is attributable to which period? It is attributable to the period from the date of joining till the completion of 10 years period, because after 10 years of service, you are not getting anything extra. So, the entire 2,000 is attributable to first 10 years of service, that is 200 per year. After 10 years of service, there is no further entitlement and hence no benefit is attributable to after 10 years of service. Now again here, when we are estimating, we have to check the probability that the employee would complete 10 years of service, right? And accordingly, we will have to calculate the current service cost and the defined benefit obligation. Let's have a look at another example. Sanat Private Limited has a plan for the employees where employees are entitled to a benefit of 5% of final salary for each year of service before the age of 55. Compute the benefit attributable up to the age of 55 years and after the age of 55 years. Now, how will you attribute the benefits in this case? See, the final benefit payment is 5% of the salary, right? Now, this 5% of salary will be payable for the services which are rendered up to the age of 55 years. So, let us say an employee has joined at the age of 40 and he has worked till the age of 55 and today has completed 55 years. Now, for this 15 years, for each year we will attribute 5% of the final salary. Now, if he works till 65, like for example, if he continues to work till the age of 65, will we attribute any benefit after the 55th year? We will not do that. Why? Because the question says, employees are entitled to benefit for each year of service before the age of 55. So, till the age of 55, for every year you will make an estimate and say 5% of the final salary will be paid. Now, this final salary will be the salary at the time of retirement. Let us say he retires at the age of 65, then based on that salary you will attribute the benefit for years of service till the age of 55 years. After that, you will not attribute any benefit. Now, so far in all the examples, if you would have understood, what we did was, we classified the period of service into two categories, into two parts. The first part was the period in which the benefits get attributed or the period of service which results in benefit to the employees. That is the first part. And the second part was the period for which no additional benefits are available to the employee other than by salary increase. Now, what do I mean by that? In the example that we just now took, we said till 55 years of age, for every year of service is entitled to 5% of the final salary, right? Now, after that period, is he entitled to any additional benefit? He is not entitled to any additional benefit other than the benefit that will arise because of salary increase. Now, what do I mean by that? Say at the age of 55, his salary is 10,000, okay? So, 5% of 10,000 works out to how much? 5% of 10,000 works out to 500. But his estimated salary at the age of 65 is, let us say, 20,000. Now, if his estimated salary at the age of 65 is 20,000, the benefit will be computed based on 5% of 20,000, which is 1,000. So, the additional benefit that the employee is getting is not because of extra service, but it is because of the salary increase. It is because of the salary increase. So, we say that no material additional benefit is available from the age of 55 till the age of 65 other than by salary increases. So, The extra benefit that the employee gets is only because of salary increase and not because of the service that he has rendered. So, we will attribute the benefit only till the age of 55 years. Let's have a look at another example. A post-employment medical plan reimburses 40% of an employee's post-employment medical cost if the employee leaves after 10 years of service but less than 20 years of service, and 50% of those costs if the employee leaves after 20 or more years of service. How will the benefit be attributed to the years of service? Now here what's happening, there are two parts to the benefit. The first part is, once you complete 10 years of service, the employee would be entitled to reimbursement of 40% of the medical cost post retirement. So whatever is the medical cost post retirement, if the employee leaves by completing 10 years of service up to 20 years of service, meaning to say if you complete 10 years or 11 years or 12 years or 15 years, you get 40% of the medical cost which are reimbursed. And the other category is if the employee completes 20 years of service, then in that case the employee would be entitled to 50% of reimbursement. So, first category is 40% of reimbursement, second category is 50% of reimbursement. Now, how should the benefit be attributed? Now, here what the standard says is, if the benefit in the subsequent period is of a materially higher level, then in that case, for the entire period, you have to do a straight line method basis allocation. That is to say, if the benefit after completing 20 years of service is materially higher than after completing 10 years of service, then for the entire period, you will attribute the benefit on a straight line basis. Now, in this case, from 40% to 50% is not materially higher, right? It's just a 10% extra reimbursement, and hence, for each period, we will separately allocate the benefit attributable. So, once the employee completes 10 years of service, what is the benefit that is attributable? 40%, right? So, 40% of the estimated medical cost, right, should be attributed to each of the 10 years. Obviously, you will do the present value calculation as well. So, in other words, each year you will attribute how much? 4%, 40% divided by 10. For the first 10 years, each year you will attribute 4% of the medical cost as expected benefit. For the next 10 years, how much will you attribute? See, if you work for extra 10 years, you will get additional 10% reimbursement. That is, for each year, you will get 1% of extra benefit. So, for the first 10 years, 4% of benefit. For the next 10 years, 1% of benefit. Now, say for example, if an employee leaves within 5 years, right now for that again you will have to calculate the probability, and for such employees, no benefit would be attributable, right? So, based on the expected probability of employees completing 10 years of service, you will attribute 4% for each year. After 10 years of service till 20 years of service, then you will attribute 1% per year. Now, what if the employee provides 30 years of service? Now, what you need to understand is, after an employee completes 20 years of service, how many number of years he works in addition to that does not change the benefit payable. That is, if the employee works for 20 years also, he will get 50% reimbursement. Even if he works for 25 years also, he will get 50% reimbursement. So, is there an increase in the benefit if the employee works after 20 years? There is no additional benefit. That is why the benefit is attributable to the first 10 years and the next 10 years only. Will not attribute any benefit after 20 years of service, because post 20 years there is no extra benefit payable, right? So, this is what you need to understand when we have to attribute benefit. Let us just slightly change the example, and let us say for completing 10 years of service, the employee is entitled to 10% of benefit, and for completing 20 years of service, the employee is entitled to 50% of reimbursement. Now, what happened here? The completion of first 10 years entitles only 10% of reimbursement, but if the employee completes 20 years of service, he is entitled to 50% of reimbursement. What does this mean? This means that the benefit that is payable is materially higher, right? The employee gets entitled to a materially higher level of benefit. Now, in such a case, what the standard says is, if the subsequent period results in a materially higher period, then the way you should allocate the benefit is, take the total benefit, that is 50%, and allocate that till the period after which no materially higher level benefit would be attributable. Now, in this case, from day of joining till 20 years, that is for the 20 years period, you will attribute the entire 50%, that is 2.5% per year, right? So, this is what you need to understand. In the earlier case, we segregated the employee service into two parts and attributed 4% per year to the first part and 1% per year to the second part. But if the subsequent service leads to a materially higher level of benefit, then you will do a straight line basis allocation and not period specific allocation. So, in this case, because it is from 10% to 50%, that is materially higher, you will allocate 2.5% for each year till the age of 20. And why no benefit after 20 years? because there is no additional benefit after completing 20 years of service. Now, just to compare the treatment that you have given in both the cases, if employees are expected to leave within 10 years, then no benefit is attributable to those employees. Now, for employees who are expected to complete 10 years of service and are not expected to complete 20 years of service, for them, the benefit which is attributable is 4% per year in the first case and 1% per year in the second case. Now, why 1%? Because these employees will leave without completing 20 years of service. So, in that case, you will attribute only 1% per year. Then, for employees who are expected to complete 20 years of service, for them, what you do is, you will attribute 4% per year for the first 10 years and 1% per year for the subsequent 10 years, right? That is how you will do the allocation. But in the second case, what you do is, you would attribute 2.5% per year on a straight line basis for the entire 20 years period. Now, you may say, sir, even when you do 2.5% also for 20 years, you get 50. In the first case also, you will get 50%. How does it make a difference? See, when you calculate present value, you calculate current service cost. That is where it would make a difference. Let's have a look at another question. ICAI Limited is a listed company engaged in the business of manufacturing. Okay, the company has various branches and has 1000 employees. Okay, now see, in examination also, if you get these kind of questions with text which is not relevant, you should learn how to ignore those things. Okay, here so far, if at all anything is important, is 1000 employees. Other than that, nothing else is important. Okay, because that will save time. Don't get unnecessary into okay, this manufacturing this, manufacturing that, pronouncing the name of the company. These are just time wasters and distractors. Okay. As per the statutory requirements, gratuity shall be payable to an employee on the termination of his or her employment after he has rendered continuous service for not less than 5 years. Okay, so 5 years of service has to be completed, and when does it happen? On his superannuation, on his retirement or resignation, and on his death or disablement due to an accident or disease. So, in each of these three cases, if the employee has completed 5 years of continuous service, then gratuity will be payable. The completion of continuous service of 5 years shall not be necessary where the termination of the employment of any employee is due to death or disablement, right? So, generally, there are rules which say, if there is a death or disablement during the course of employment, then that 5 years of continuous service is not required to be fulfilled. So, it may be possible that if an employee, say for example, is, becomes disabled due to an accident during the working hours in the factory premise, then in that case, even though he has completed 3 years of service, he will be entitled to gratuity, right? But the gratuity will be payable only for the years completed, not for the entire 5 years period, okay? The amount payable is determined by a formula linked to the number of years of service and the last drawn salary. We have been taking this example. The amount payable to an employee shall not exceed 10 lakhs. Compute the amount of employee benefit, if any, attributed to each year of service. Now, here actually, though the material says compute, we cannot actually compute because we do not have information. The question should have been, how should the amount of employee benefit be attributed to each year of service? Okay, that is how you have to read this. So, let me just change that. How should the amount of employee benefit, if any, be attributed to each year of service? Okay, because we cannot compute it, right? Computation information are not. Now, the question is, how will we compute the amount of benefit attributed to each year of service? Now, here again, we will have to make a lot of actuarial assumptions. Now, what are those assumptions? How many employees will complete 5 years of service? Okay, then what will be the average age of service of those employees? Okay, then what is the probability of, what would be the mortality rate or disablement rate during the course of employment? Because see, if someone dies or becomes disabled during employment, then even though the person does not complete 5 years of service, we will have to make payment of gratuity, right? So, we will have to make assumptions around these factors. That is the first aspect. Then, after considering the assumptions, we will have to determine how many number of employees will be entitled to gratuity, and for them on an average how many years of service will they render. Okay, based on that, we will have to calculate the defined benefit obligation and attribute the benefit to each year of service. That is one aspect. Second, based on the mortality rate or disablement rate assumption, how many employees are likely to be paid gratuity because of an event like that happening. For them, we will have to make a separate estimation. We will have to group them separately. Okay. Then the maximum ceiling, the question says that the maximum amount which is payable to an employee shall not exceed 10 lakhs. Now, if you look at the maximum amount that is payable, which is 10 lakhs as gratuity, say for example, an employee has worked for 15 years or an employee is expected to work for 15 years and his last drawn salary would be, for argument's sake, 1 lakh. Now, tell me one thing, Will he be entitled to 15 lakhs of gratuity or 10 lakhs of gratuity? He will be entitled to 10 lakhs of gratuity. He will not get 15 lakhs of gratuity. Now, in such a case, what should we do with this 15 lakhs? Should we attribute this 15 lakhs as 1 lakh every year for 15 years of service, or because the maximum amount of gratuity itself is 10 lakhs, which means the gratuity payable is attributable only to the first 10 years of service. So, the second approach is what is to be followed. That is, you have to see what is the maximum gratuity which is payable. Now, in this case, it has come out to 10 lakhs. Now, how many years of service would the employee need to earn those 10 lakhs? He would need only 10 years of service. Though he has worked for 15 years of service, the benefit after 10 years is not getting accrued. He is not getting any additional benefit by working more than 10 years. So, in that case, what we need to do is, we have to allocate 1 lakh every year for first 10 years, because the remaining 5 years does not entitle the employee for any additional benefit, right? So, that is how we will have to do the allocation. But let us say an employee is expected to work for 15 years and he is entitled to 50,000 for every completed year of service. Then in that case, for each of the 15 years, we will attribute 50,000. Okay. So, this is how we will do the allocation of benefit attributable to each year of service. Let's have a look at another question. OPQ Limited is a listed company having its corporate office at Nagpur, branch in Chennai, and operating in Indian market for 10 years. Again, as I told you, irrelevant information, right? So, let's come to the main part. The company operates a pension plan that provides a pension of 2.5% of the final salary for each year of service. The benefits become vested after 7 years of service. On 1st April of year 8, the company increased the pension to 3% of the final salary for each year of service starting from 1st April of year 1. On the date of improvement, the present value of the additional benefits for the service from 1st April of year 1 to year 8 are as follows. Employees with more than 7 years of service as on January 1st of year 8, 275,000, 2,75,000. Employees with less than 7 years of service, 2,21,000, that is average of 4 years to go. Now, the question here is, what should be the treatment for this particular plan amendment? Now, here there is a plan amendment. It is not a change in actual assumption. It is a change in the plan itself. Now, because of the change in plan, what has happened? There is an increase in benefit, means the obligation on the employer would increase, and when the obligation increases, the service cost also increases. Now, here the question says, the present value of additional benefits for service between 1st April of year 1 to 1st April of year 8 are as follows. So, employees are entitled to pension after 7 years of service, and now because we have increased the benefit, an additional benefit has to be paid for services already completed, right? Now, for services already completed, there are two categories. One, employees who have completed 7 years of service, and second, employees who have not yet completed 7 years of service. Meaning to say, in the first category, employees who have completed 7 years of services, the pension has already vested. Vested meaning, even if they don't provide any further service, they will get that additional benefit. And second, on these employees, the benefits have not yet vested, right? What is the present value? 2,75,000 and 2,21,000. Now, what does this present value represent? This present value represents the additional benefit that is payable for services already rendered. So, the employer has to treat this as a past service cost and provide for it accordingly. So, you will debit the past service cost by 275 and 221, and you will credit the defined benefit obligation by the same amount, that is 275 plus 221, 4,96,000. Now, you may have a question, sir, for the first part it is clear that, because it is already vested, we are making a provision for this, we are adding it to the liability, but the second part is not yet vested. Why are we adding that to the liability? Please understand, even though the pension has not yet vested, this 2,21,000 pertains to the period of service already rendered. Now, for example, if these employees complete 7 years of service, then they would also be entitled to this additional 2,21,000 in present value terms. Of course, they will be entitled to this benefit once the benefit vested. So, the accounting does not work like, only after the benefit gets vested, we will do the accounting. It doesn't work that way. We will have to make an estimate that on what percentage of employees would the pension benefit vest, right? So, that is what we need to calculate. So, even though the pension benefits have not yet vested, we will have to provide for both current service cost as well as the past service cost, right? So, don't make a mistake in the examination saying that only 275 has to be provided and 221 need not be provided. You will have to provide for both these components as past service cost. Now, so far we have understood the meaning of a benefit obligation and how do we calculate the defined benefit obligation and how do we calculate the present value of that. Then we also understood about the service cost, and service cost had components like current service cost, past service cost, gains or loss on settlement. Then we also understood how to calculate interest cost, and we also saw what are actuarial gains or losses. Now, if you have to look at the liability, please understand we are looking at the liability from the employer's point of view. The employer has a liability to give certain benefits to the employee based on some formula, right? Now, what we need to understand is what would result in increase of this liability and what would result in decrease of this liability. See, again, if this concept is clear, the calculation part and the accounting part becomes much easier, right? Now, we are saying there is an employer, the employer has an obligation or the employer has a liability. Now, when would the liability increase? If an employee provides a year of service, because of the current service cost, the liability would increase. And if at all the employer makes a change in the plan, he amends the plan which results in increase in obligation, which results in increase in the benefit to be paid, then in that case also the obligation would increase. So, if there is a plan amendment which results in higher benefit, then because of that past service cost, also the obligation would increase. That is the second component, right? The reverse would be true. If there is a plan amendment which reduces the benefit, then the obligation would come down, right? Then coming to the next aspect, interest cost. As time passes, the obligation increases, right? So, that is another thing which you need to keep in mind. Then the other aspect is when settlements happen. Settlement meaning we are actually paying the employee their share of benefits. So, let us say an employee resigns or employee retires, we pay him gratuity. Now, that payment of gratuity is nothing but settlement. Once an obligation is settled, what would happen to the liability? Will it increase or will it reduce? It will reduce. So, whenever there is a settlement, it would result in reduction of the liability. Then, the next component is actuarial gains or losses. If at all there is an actuarial loss, means what? The obligation has increased, the benefit payable has increased, hence the obligation would increase. Then, if there is an actuarial gain, the obligation would actually reduce, right? So, if you are clear with this, what results in increase in obligation, what results in reduction in obligation, to calculate the ending obligation or ending defined benefit obligation would not be difficult for you. So, generally you would start with the opening balance of the defined benefit obligation. To that you will add the current service cost. To that you will add or reduce the past service cost depending on whether there is an extra benefit or a reduction in benefit. To that you will add actuarial losses, you will reduce the actuarial gains. To that you will add interest cost, and from that you will reduce any settlements which are made, right? So, all of these, once you do the adjustments, you arrive at something called the ending defined benefit obligation or the closing balance of the benefit obligation, which is the liability. As we were discussing defined benefit obligation, the service cost, the current service cost, the discounting factor, we touched upon a concept called actuarial assumptions. What are these actuarial assumptions? Actuarial assumptions are an entity's best estimates of the variables that will determine the ultimate cost of providing post-employment benefits. Now, what does that mean? What is the cost of providing the post-employment benefits is dependent on certain variables, right? We talked about number of years of service, we talked about salary increment, we talked about discount factor. All of these, there are many more such variables which will impact the final post-employment benefit that will be paid to the employee or the cost that the employer would be incurring, right? For these variables, we make certain assumptions which are called actuarial assumptions. Now, when we talk about actuarial assumptions, these are broadly categorized into two types. The first one is demographic assumption and the second one is financial assumption. What is this demographic assumption? Demographic is something to do with people or population. So, when I say demographic assumptions, it could be average age of the employee, assumptions related to mortality, that is death of an employee or disablement, right? And then assumptions related to how many dependents would be entitled to benefit, assumptions related to generally what kind of benefits do the employee choose, do they choose a lump sum payment or do they choose a staggered payment, right? And there could be assumptions with relation to how many number of years will the employee work in the organization, right? All of these assumptions which have to do with the employees or the person are called demographic assumptions. The other assumptions are financial assumptions. What are these financial assumptions? What could be the discount rate? What could be the average salary increment over the years of service? What could be the inflation rate, right? Something to do with the financial numbers or financial information is called financial assumptions. So, we make both demographic assumptions as well as the financial assumptions to arrive at the estimated benefit obligation that would be paid to the employees or that would be incurred by the employer, right? Whenever an entity makes these assumptions, both demographic as well as financials, those assumptions must be compatible with one another. Now, what do I mean by that? Say for example, assumption regarding inflation is that on an average, the inflation would be 10%. Now, if inflation is 10%, generally the expectation would be that salary would also increase by 10%. But let us say we assume that the salary would increase by only 5%. Then in that case, the assumptions are not compatible. Or let us say we estimate that the employee would work in the organization on an average for 15 years, but salary increment we are considering only for 10 years, right? So again, those are not compatible assumptions. Whatever assumptions we make should be compatible. Then other important thing that we need to keep in mind is the assumptions that we make should be reasonable and they should be unbiased, and they should not be too conservative or too imprudent. What do we mean by the assumptions being too conservative or too imprudent? Now, when we say too conservative, say on an average an employee works in an organization for 7 years, but the entity, the employer, they follow this conservatism principle so much that they estimate that the employee would work for 10 years or 15 years. Okay, that is being too conservative, and the other one is being too imprudent. Like, instead of saying 7 years, we will say, no, most of the employees leave within 3 years. So, only some part of the employees would work for 7 years. We'll consider, most of the employees will retire within 3 years. So, there we are being imprudent. So, you should not be too conservative, you should not be too imprudent. Based on the circumstances, based on the past experiences, we'll have to make an unbiased assumption as to what would be the various assumptions for demographic aspects as well as the financial aspects. Let's now understand one of the very important actuarial assumption, which is the discount rate assumptions. And friends, please note, the discount rate will determine your current service cost. The discount rate will determine your interest cost. It will determine the present value of your obligation. Everything is dependent on the discount rate that you choose. So, the discount rate has to be determined properly. How do we determine the discount rate? Discount rate is determined by referring to market yields of government securities. So, you will have to refer to the market yields of government securities for a similar tenure, and you will have to determine the discount rate. Similar tenure means, say the benefit obligation is payable after 25 years. So, you will have to look at the yield for government securities having a balance maturity of 25 years, right? So, whenever we are discounting, the rate to be used is determined by referring to government securities of an appropriate tenure, right? It is not appropriate to use, let us say, a 10-year yield to discount a 25-year obligation. Now, in some cases, maybe there are branches or there are divisions or there are subsidiaries, joint ventures which are not located in India, they are located outside India. Now, in such cases, how do we determine the discount rate? There, the first choice is market yields of high quality or high grade corporate bonds. If that is not available, then the market yield of government bonds of that particular country, right? If it is a foreign subsidiary, let us say an Indian company has a US subsidiary and US subsidiary has employees there, you will have to make benefit plans payment as per the rules and regulations in US, and currency will also be US. Then you will have to see for a US corporate bond which is of high quality or high grade, what is the market yield? Based on that, you will determine the discount rate. If that is not available, you will refer to the yields of the government securities which are issued by maybe US Treasury. Now, while determining the discount rates, we are not factoring any of those actuarial risk or investment risk. Okay, so we are not considering all of that, and hence you may generally use a single weighted average discount rate to apply to the benefit obligation. Another thing that we need to keep in mind is, if at all the discount rate for our maturity is not available, let us say benefit obligation is payable after 30 years on an average, but there is no corresponding deep market for a 30-year government bond, right? Generally, it is not likely the case, but let us say we don't have a market for that. Then, now in that case, what we need to do is, if 30 years is not available, we have to check if 10 year or 15 year or 20 years is available. Let us say 15 years yield is available. Then, you will consider that 15-year yield, and using that yield, you will discount the obligations pertaining to the 15-year period. And beyond that, how will we discount? Referring to this 15-year yield and the future yield curve, you will estimate what will be the discount rate for the future period, and accordingly, we will do the discounting. Now, what is the relevance of this discount rate that is computed? Discount rate will be used to discount the benefit obligation pertaining to a specific period to arrive at the current service cost, and interest cost is also arrived at by using this discount rate. So, whatever is the opening balance of obligation, to that you will apply this discount rate to arrive at the interest cost for the period, right? That is where it will be used. Now, in the examination, you are not expected to determine the discount rate. Please keep that in mind. You will be given the discount rate and you will have to use that discount rate and do the calculations. Let's now understand few other aspects related to actuarial assumptions, specific actuarial assumptions. Now, one important actuarial assumption is related to salary, right? We'll have to estimate what will be the salary levels of the employees at the end of their employment. Now, how do we estimate the salary levels? We will see what are the current salary levels, what are the various seniority positions, we will group the employees accordingly, and based on that, what would be the average increment, what will be the impact of inflation on the increment, what will be the impact of demand and supply of employees in the market, right? So, if let us say there is a lot of demand of tech professionals, salary levels would increase by a higher amount, correct? So, we will have to consider all of these factors to estimate the salary levels of the employees at the time of either resignation or the retirement or end of employment, right? Apart from this, we will also need to estimate the benefits payable. Now, how will we estimate the benefits payable? One, we will consider the formula given under the plan. Then we will consider other variables like estimated salary levels, estimated years of service. Considering that, we will estimate what would be the benefit payable. Then there could be some cases where the benefit payable is linked to some other state sponsored benefit. For example, reimbursement of medical cost would be done in line with the reimbursement of medical cost which is done for state employees or central government employees, right? If such is the kind of benefit, then we will have to monitor what are the changes to the benefits which are made in the state plans or the central government plans, right? That could be another aspect which we have to look at. Then, now when we look at the benefit payable, we will also need to see, is there any constructive obligation arising from the past history? For example, historically, the company is providing additional benefits based on inflation trends, okay? If that is the case historically, then in future also such benefit may have to be increased considering the inflation, right? So, that is another aspect which the company has to consider while determining the benefits payable. Apart from this, the entity also will have to make estimates of medical cost. See, in some post-employment benefit plans, the employer or the entity agrees to reimburse medical cost or take care of medical cost. Now, if that is to be the case, the entity has to estimate what will be the estimated medical cost after the end of the employment for that particular for the employees, right? Now, it would depend on multiple factors like what is the current health cost, how are the health and medical costs expected to increase in the future, then what would be the age of employees when they actually complete their employment, right? Because once age increases, the medical cost also increases. Medical cost for someone who is 30 years old would be less as compared to medical cost for someone who is 60 years old. So, accordingly, we will have to make the estimates. Then, we'll also need to consider how many dependents are there, how many dependents would be covered for the medical cost. That aspect needs to be seen. Then, we have to see what would be the employer share and what would be the employee share in the future medical cost. That aspect needs to be seen. Then, if some insurance is being taken, how much of cost will be covered by those insurance policies. By considering all of these things, the entity will have to make estimates of medical cost. Now, whatever I have discussed so far, right, relating to actuarial assumptions, as far as your exams are concerned, don't spend too much of time in bothering about and remembering these things. If you have a broad understanding of what are actuarial assumptions and how do actuarial assumption changes impact the obligations, that itself is sufficient, okay? So, don't spend too much of time in remembering or going deep into these aspects, because this is not our area of expertise. This is just a general understanding of how do actuarial assumptions work. Before we move further, let us quickly summarize the accounting treatment that has to be done for each of these components. See, whatever we have done so far, we understood the concept part of it, right? What is the meaning of current service cost, what is the meaning of interest cost, and all of those aspects. Now, let us understand what should be the accounting treatment. It is not very complicated. If you are comfortable with this accounting treatment, if you are able to remember this accounting treatment, then most of the questions related to employee benefit obligation you will be able to handle, okay? In examination, you will not be asked to explain the concepts. Most likely you will be given certain numbers and you will be tested on how will those numbers be accounted for, right? So, when it comes to accounting, what are the various things that we have discussed so far? We understood what is current service cost. Now, as far as current service cost is concerned, whatever is that cost, that will be recognized in the P&L in the same period. So, current service cost for a particular period is recognized in the statement of P&L in the same period. There is no confusion in that, right? Then, we spoke about something called as interest cost. Now, again, interest cost also will be recognized in the P&L in the same period. So, current service cost and interest cost will be recognized in the same period. Then, we also spoke about something called as past service cost. Now, past service cost arise because of, maybe amendment to the plan, introduction to a plan, curtailments and all of those things. So, whenever there is a past service cost, then even that past service cost is recognized in the statement of P&L. Now, past service cost may lead to increase in obligation. In that case, it will be an item of expense. Otherwise, if it leads to reduction in obligation, it will be a negative item or you will reduce it from the expense. But again, past service cost will also be recognized in the P&L. Now, as far as gain or losses on settlement is concerned, those gain or losses on settlement are also recognized in the P&L in the same period in which settlement is done or in which settlement becomes due. It may be possible that settlement is due in the current period, but for some reason it has not been paid. Okay, that is also possible. So, whenever the liability to settle arises in that period, whatever is the gain or loss, you will recognize it in the statement of P&L. Then we understood about something called as actuarial gains or losses. Now, as far as actuarial gains or losses are concerned, these actuarial gains or losses are not recognized in P&L. Please keep this in mind. These are not recognized in P&L. These are accumulated under other comprehensive income. And the reason being, these are assumptions which keep on changing frequently, right? So, if you take this item to the P&L, it may result in fluctuation in the income reported. For that reason, actuarial gains or losses are recognized in other comprehensive income, right? Now, amongst all of these components, if you look at this past service cost, sometimes past service cost may result in a huge expense being recognized in the P&L. Say for example, there was no defined benefit plan at all. Suddenly, after 5 years of existence, the company introduced a defined benefit plan. And it said all employees who have worked in the organization for 5 years are eligible for this kind of benefit. Then suddenly in the 5th year when the plan was introduced, there will be a huge burden on the enterprise. There will be a huge amount of liability which the entity has to recognize, right? An obligation would exist, a defined benefit obligation has to be calculated, and it would result in recognition of a very large amount of a past service cost. See, current service cost is smoothened. Every year you will have similar amounts, right? But past service cost may result in a sudden increase in expense in the P&L. But even if that is the case, you are not allowed to defer that expense or amortize that expense over remaining life of the employees or over a period of time. That is not allowed under Ind AS 19. Under AS 15, which is the equivalent GAAP under accounting standards, or even under the US GAAP, you are allowed to amortize those past service costs. But under Ind AS 19, you cannot amortize the past service cost. So please keep this in mind. Whatever is the past service cost, whatever is the gain or loss on settlement, the current service cost, the interest cost, everything will be recognized in the P&L in the same period. There is no concept of deferment. As far as actual gains or losses are concerned, they are accumulated in other comprehensive income. Now, if you have understanding of this accounting treatment, let me tell you, you have understood almost half of the standard as far as Ind AS 19 is concerned. Now, few important things that you need to keep in mind when we are dealing with different components of this employee benefits, right? Now, we understood in detail about what is a past service cost, and there was also a concept of actuarial gains or losses. Please understand that whenever we say there is a past service cost, it arises either because a new plan has been introduced or an existing plan has been withdrawn, or there is some amendment to the plan, or there is some form of curtailment, right? In these scenarios would lead rise to past service cost. Actual assumption changes do not lead rise to past service cost. What do I mean by that? If future salary increases, earlier we thought it will increase by 5%, now we think that it will increase by 8%, or the discounting factor changes, or the number of employees will be entitled to the benefit, the estimate of that changes. If that happens, then that is an item of actuarial assumption, and any gain or losses arising out of that will form part of actuarial gain or loss. Don't get confused between what is an actual gain or loss and what is an item of past service cost. Okay, if for example the employer changes the plan and says instead of 3 years of service you are now required to complete only 2 years of service for the benefit, that is a plan amendment. Whereas if the assumption changes, initially we thought 60% of the employees would complete 3 years of service, now we feel that only 50% will complete 3 years of service. That is a change in actual assumption. Okay, now this distinction is also important because past service cost will be recognized immediately in the P&L. Actual gains or losses will be accumulated in OCI. And then we also understood the concept of service cost. Service cost comprises of current service cost, past service cost, and net gain or loss on settlement, right? Actual gains or losses do not form part of current service cost, right? That is why this distinction is very, very important. Now the next thing that we need to understand is when do we recognize this past service cost, right? We said past service cost will be recognized in P&L immediately. What is that immediate? Now, when we say it has to be recognized in the P&L immediately, we have to see 2 dates. What are those 2 dates? First is, what was the date of plan amendment or introduction or withdrawal, all of those aspects. On which date did we introduce a new plan? the second thing is, if at all there are employee restructuring related liability or termination benefit related liability being recognized, what is that date? So one date is we have actually introduced the plan or amended the plan. Other date is we have created a liability for restructuring as per maybe Ind AS 37. Earlier of these two dates is the date on which you should recognize the past service cost. So if the plan has been introduced or if a plan has been withdrawn or amended, then on that date you will have to recognize the past service cost, or even before the withdrawal of a plan or introduction of a plan, we have created a liability for restructuring expenses. Now in that case, on that date we will have to recognize for the past service cost. Now what is the logic behind this? Say for example, an entity has created a provision for restructuring. They have created a liability for restructuring because some employees will have to be terminated as a result of the restructuring plan. Now they have already recognized the liability. They may not have introduced or changed the plan. They may not have amended the plan, but the entity knows that they will amend the plan in the future or they will withdraw the employee benefit plan in the future when on the date on which the liability for restructuring is created, or the date on which liability for termination benefits has been created. Based on that, the employee will have to recognize the past service cost. Okay, that is the underlying logic, but what you need to remember is it has to be earlier of either the plan amendment date or the date on which liability for restructuring or termination benefits has been created as per Ind AS 37. Take these two dates, whichever is earlier, on that date you will recognize the past service cost. Now let us understand the linkage between the restructuring cost and the past service cost with an example. Say there is an entity which has decided to close one of its location on 1st of June of year 1 and it has been communicated to the employees, and based on that the employer also has created a liability for restructuring as per Ind AS 37. Now because we are asking employees to leave the organization because of restructuring, what the entity said is, for those employees who are leaving because of this restructuring activity, there is no need to complete specified number of years of service for the employee benefit plan. That is, if gratuity is payable, for example, after 5 years of service, but we are asking the employees to leave, because of this restructuring, then irrespective of number of years completed, employees will be entitled to gratuity. Now what is this? This is a plan amendment, and maybe the plan amendment will be made at a later date, let us say on 30th of June or 31st of July. On that date the plan amendment is done, but when did the restructuring happen? When did we recognize the liability for restructuring? On 1st of June. So what the standard says is, take the plan amendment date, take the date on which you have created the restructuring liability. Earlier of these two dates is the date on which you will have to recognize the past service cost. Now in this example I have taken the same year, but in some cases these may fall in two different financial years. In that case you will have to take the earlier of those two dates and recognize the past service cost. Now we have understood how to account for various components of the service cost. Now in some cases what can happen is, the plan amendment or maybe a curtailment and settlement can happen at the same time. Like we spoke about restructuring related activity. Maybe in that case there is a curtailment as well as settlement happening at the same time. So because of curtailment there will be an element of past service cost, and because of settlement there could be a gain or loss on settlement. What the standard says is, if these things are happening at the same time, if the plan amendment or curtailment or withdrawal of a plan and a settlement, if they are happening at the same time, you are not required to distinguish between the past service cost and gain or loss on settlement, right? You need not distinguish it. But if at all the plan amendment happens first and then the settlement happens, then for the plan amendment or for the curtailment you will have to recognize for a past service cost separately and for gains and losses on settlement separately. Now if at all the plan amendment and settlement happens at the same time, then whatever is the loss or gain on account of amendment and settlement, all of that you will consider as gain or losses on settlement itself. You are not required to separate the past service cost portion and gain or loss on settlement related portion, right? So that is one thing which you need to keep in mind when the amendments and settlements happen at the same time. Now sometimes what entities can do is, they can terminate a plan and they can introduce a similar plan which is substantially the same, which does not materially differ from the earlier plan. In such a case, the termination of a plan does not mean that the plan is being settled, okay? If a new plan is being introduced which is similar to the plan which existed earlier, in that case we do not say that a settlement has happened. So you will not consider an introduction of a new plan in place of an existing plan as a settlement if the new plan is materially same as the earlier plan. Now we have understood various aspects related to expenses, gains, losses, settlement and all of those items. Let us understand how do each of these items impact our defined benefit obligation. Now friends, if you remember, we calculate defined benefit obligation. Out of that defined benefit obligation, we attribute a portion of that benefit to each year of service using the projected unit credit method and accordingly calculate the current service cost, interest cost and related items. Now, how does each of these items impact the defined benefit obligation? And please note, in each balance sheet, we will show something called as the defined benefit obligation, which is nothing but the liabilities. See, whenever we are talking about a defined benefit plan, what are we talking about? That a benefit would be paid to the employees at the end of it and at the end of his or her employment, correct? That is what is a defined benefit plan. Now when we talk about a defined benefit plan, what are we saying? Employees would be entitled to some form of benefit, and for that benefit we are recognizing expense in each period, and corresponding to that expense we also are recognizing a liability, which is nothing but your defined benefit obligation, right? Now whenever we look at this defined benefit obligation, you will have obviously the opening balance of defined benefit obligation. That is one item which you would already have. Now, to this, what will be the impact of current service cost? So, if I am recognizing a current service cost, what will be the impact on defined benefit obligation? The defined benefit obligation would increase, correct? If I am recognizing a current service cost, defined benefit obligation would increase. So, opening balance of defined benefit obligation, to this you will add current service cost. You will add current service cost. Why? Because of the current service cost, my present value of defined benefit obligation is increasing. And what will be the journal entry for this? Current service cost debit or employee benefit debit to defined benefit obligation, right? This item will increase my defined benefit obligation. Then the other component that we saw was the interest cost. What is the meaning of interest cost? Interest cost results in increase in the present value of defined benefit obligation due to passage of time. So here also interest cost would increase the defined benefit obligations. You will add interest cost to the defined benefit obligation opening balance. What will be the entry? Interest cost debit to defined benefit obligation, right? Interest cost also increases the defined benefit obligation. Then we understood something about past service cost. Now what is the past service cost? The change in present value of defined benefit obligation because of past service. The change can result in increase in obligation or reduction in obligation. So plus or minus past service cost, depending on whether it is an increase in obligation or reduction in obligation. If it is an increase in obligation, you will debit the past service cost and credit the defined benefit obligation. If it is a reduction in benefit obligation, then you will debit the defined benefit obligation and credit the past service cost. Though we are using this term past service cost, it includes both an item of expense as well as income, right? Though we are referring it to as cost, it includes both the negative item and the positive item. Then we understood about actuarial gains and losses. Now what is the impact of actual gains and losses on defined benefit obligation? If it is an actuarial gain, it will reduce the obligation. If it is an actuarial loss, it will increase the obligation. So you will add or less the actuarial gains or losses depending on whether it is a loss or a gain. If it is a loss, you will add. If it is a gain, you will reduce. What will be the entry for that? You will debit actuarial losses and credit the defined benefit obligation. And if it is a case of gain, you will debit the defined benefit obligation and credit the actuarial gains. Now these actuarial gains or actuarial losses will be taken to OCI. They are not P&L items. Please keep that in mind. Then we also understood that there could be benefit payments. When I am saying I am making a benefit payment, for example, I have paid gratuity to an employee who has resigned from the organization. Now when I am making this benefit payment, what will happen to my obligation? My obligation would come down, right? Because I am making a benefit payment to the employee. So my obligation or my liability would come down. Same is the case with settlement also. Settlement will understand separately, but whatever benefits payment we are making, it will reduce the liability. So you will debit the defined benefit obligation and you will credit bank for the benefit which are being paid, and in your computation you will reduce any benefit payments to calculate the balance of defined benefit obligation. Then there could be a case of settlement as well. Now when we are settling, two things are happening. There is a payment that will happen that will be treated similar to the way in which you have treated the benefit payment, and there would be a gain or loss on settlement, right? Now, if there is a gain on settlement, meaning to say what? We have paid less than what we were supposed to pay. To that extent, our obligation would come down. So, any gain on settlement will be reduced, any loss on settlement would be added to the defined benefit obligation. Now, if you do all this computation, what you get is closing balance of defined benefit obligation. This represents the present value of defined benefit obligation attributed to the services which have been already completed by the employee. Now, this table, if you are able to understand logically, no need to by heart, please don't by heart. Whatever points come in the examination, just think of it. What will be the impact of this cost on my obligation? Will it increase my obligation or will it reduce my obligation? If there is a benefit payment, will it increase my obligation or will it reduce my obligation? Ask yourself that question and then solve the illustration. A lot of students, what they do is they try to by heart this table. Now, when you get into by hearting this table, you will tend to forget, okay? It is not something to be by hearted, it is something to be understood logically, right? Based on this, you will be able to calculate the closing balance of defined benefit obligation. This represents the liability on the employer as at the end of a particular period. Now, so far we have understood various aspects around defined benefit obligation, the calculation of present value of that, how to calculate current service cost, interest cost, past service cost, actual gains or losses. All of these items we have discussed in detail. Let us now move on to another aspect which is very important and closely related to defined benefit obligation, which is called plan assets. Let me give you an example before we actually jump into what is the meaning of plan asset. So, we have an entity, that is the employer, we have employees, and under a defined benefit plan, the employer is required to make certain benefit payments to the employees. Now, that payment may happen after 5 years, 10 years, 15 years, we don't know when would that payment happen. But there is an obligation on the employer or on the entity to make those benefit payments. Now, generally, when we have an obligation, consider your own homes or your own families, whenever there is an obligation, say, funding a marriage expense or funding an educational expense, what we try to do is, we try to keep some amount aside separately so that whenever that event occurs, at that point in time, we can use the amounts that we have kept aside for the specific purpose. Similarly, when we talk about defined benefit plans, these are huge obligations on the employer, and employer would not want to face a risk that at the time of settlement of employee benefit payments, money is not available or assets are not available. So, what generally employers tend to do is, they keep some amount aside, they invest that amount into a separate fund, to take care of benefit payments to the employee. See, please note one thing, employer, if they keep some amount aside in a separate bank account, that is not what is called a plan asset, because even if the employer keeps that amount in a separate bank account, whenever there is urgency, whenever there is a need to use that particular amount, they can access that amount and use it for the purpose of their business. When we say we are creating plan assets, that is for a defined benefit plan, whenever we are creating a plan asset, what employers do is, they contribute some amount to a separate entity. We can name this entity as a fund. They contribute some amount or they invest some amount into a separate fund or into a separate entity which will take care of benefit payments to the employees. Okay. Now, this investment into this particular fund, the contribution by the employer into this particular fund is an example of a plan asset. Now, please don't get confused between a defined contribution plan and this contribution to this fund or a separate entity. In defined contribution plan, employer will calculate and contribute an amount to the fund. Under a defined benefit plan, there may be a requirement to contribute or there may not be any requirement to contribute. What the employer is doing is, for his own comfort, keeping some amount aside in a separate fund so that that particular amount can be used to make employee benefit payments. Now, say for example, employer is regularly contributing amount to the funds, and when the time comes to make the benefit payment to the employees, the fund does not have sufficient money. In that case, who is liable to make good the shortfall? Who is liable to make the payment of shortfall to the employees? It is the employer. So, the liability does not get transferred. It is just that we are creating a separate asset by contributing it to a separate fund, and that fund would make some other investments, make certain purchases of government securities, maybe some amount in the stock market, whatever is the charter of that particular trust or the fund or the entity, they will make those investments. But employer is creating that fund, is creating that asset to make employee benefit payments under a defined benefit plan to the employees. Okay, that is one way to create plan assets. Now please note, we can consider an investment or contribution to a fund as a plan asset only if the employer no longer has access to those funds. Meaning to say, you have contributed an amount to the fund. After I made that contribution to the fund, employer cannot ask back the money from that particular fund. Even if the entity becomes bankrupt, even if the entity goes into liquidation, the fund cannot be touched. Only then you can call it a plan asset. But if the employer has created something like a separate fixed deposit account, we cannot call it a plan asset, because at the time of bankruptcy, fixed deposit will come within the overall pool of assets in the organization. So only those assets which are created separately, held by a separate entity, to which the employer does not have any access. So it should not be a case that employer has created a fund and whenever the employer needs money, it can ask the fund to pay back the amount to the employer. That should not be the case. Once you have contributed, the money is with the fund, the money is outside the organization, it is with the separate entity, and it cannot be mixed with the other assets of the enterprise. Then only we can call it a plan asset. But there could be definitely some exceptions. One exception could be that due to some reasons, let us say because of a bank holiday or because of unavailability of some signatories of the fund could not make an employee benefit payment to the employees. In that case, what the employer did was, employer made that payment to the employees on behalf of the fund. So say 1 lakh was to be paid to the employees. The fund could not make that payment for whatever reasons. So the employer made that benefit payment of 1 lakh to the employees. Now in that case, employer can ask for reimbursement of that amount. That is permissible. But otherwise you cannot ask for the money back from the fund. There could be another situation also. Say the fund has surplus assets. Surplus assets meaning after providing for all the obligations, after making all the benefit payments, considering future obligation, surplus is left within the fund. Now that surplus can be withdrawn by the employer. That is permissible. But otherwise, once a contribution is made, that cannot be withdrawn by the employer. Only then it would qualify as a plan asset. Another example of a plan asset is a qualifying insurance policy. Now what do I mean by insurance policy? Say we have to make certain pension benefit payments to the employees. After retirement, every month you have to make pension payments. Now one option is employer creates a fund, creates an asset, and that fund starts making employee benefit payments. Another option is employer approaches an insurance company. So these insurance companies, they do provide schemes like group pension scheme. Now what happens in case of an insurance policy? Employer will regularly make some payment to the insurance company. And whenever an employee retires or whenever an employee becomes eligible for pension payments, that insurance company will make payment to the employees. Now this insurance policy is also a plan asset, right? So basically what is this plan asset? Employer is keeping aside some amount either by contributing it to a separate fund or by buying certain qualifying insurance policies to take care of employee benefit payments in the future. Now please note, if at all there is any shortfall, the shortfall will be made good by the employer. Just because the employer has contributed amount to a fund does not mean that the employer can escape from his liability. That is what is a plan asset. Now, why is it important to understand this plan asset? Because on one side we spoke about defined benefit obligation, which is a liability. The other side we have something called as plan asset. So whenever we are presenting this in the balance sheet, we will see how much is the liability. From that we will reduce the plan assets and then we will show the net liability only. Why only net liability? Because a portion of the liability is covered by the plan assets which is created by the entity. Let us have a look at the definition of plan assets. Plan assets comprise assets held by long-term employee benefit fund. So it has to be a separate entity, please keep that in mind, and qualifying insurance policy. These are the two things which are covered under plan assets. What is this assets held by a long-term employee benefit fund? These are the assets other than non-transferable financial instruments issued by the reporting entity. So what should be excluded from these assets? What should be excluded? If the fund holds certain financial instruments which are non-transferable and are issued by the reporting entity. That means the company or the employer or the sponsor, you can call it, that has to be excluded. Apart from that, any assets which are held by a long-term employee benefit fund that are held by an entity, a fund that is legally separate from the reporting entity and exists solely to pay or fund employee benefits. Now, we have created a separate fund. Think of it as a trust. Think of it as a trust. that trust is a separate legal entity. It is not the same as the company. Okay, that is one aspect. Second thing is that trust or that fund is created only for the purpose of making employee benefit payments. If you look at larger organizations, you will see that they have their own trust which takes care of employee benefit payments. For example, I was working with BPCL. BPCL had its own trust. Now, what did that trust do? Both the defined contribution plan and also the defined benefit plan was managed by the trust. Okay, so you would have heard of this term, right? Recognized provident fund. Recognized provident fund, not a statutory provident fund. So, it was a recognized provident fund. So, the company would make a contribution to that trust, but the company cannot ask back money from that particular trust, right? So, this entity has to be legally separate from the reporting entity, more importantly, and the assets which are held are available to be used only to pay or fund employee benefits and are not available to the reporting entity's own creditors even in case of bankruptcy and cannot be returned to the reporting entity. As I told you earlier, employer, the trust, separate legal entity. Once the contribution is made, that contribution is not returned back to the employer or not returned back to the reporting entity. Even in case of a bankruptcy, the creditors do not have right on this particular trust. Why? Because this is employees' money. This is employees' money and outsiders cannot touch it. Even the company, if it wants, if it wants, let us say instead of taking loan from the market, it says, let me take money back from the trust, that is not allowed. Okay. Otherwise, what companies would do is, they would transfer money to the trust saying that we have transferred, take the money back from the trust, and employees would not get anything. So, generally this trust provide protection to the employees saying that, okay, the money which is belonging to you will not be paid back to the company or is not under the control of the company. So, the fund is legally separate from the reporting entity and it exists solely to pay or fund employee benefits, that's the first aspect, and the assets are available to be used only to pay or fund employee benefits and they are not available to reporting entities creditors even in case of bankruptcy, except in two situations. What are those two situations? First, the remaining assets of the fund are sufficient to meet all the related employee benefit obligations of the plan or the reporting entity. That is if there is some surplus. So, let us say the total plan assets is 1,50,000, but the present value of defined benefit obligation as computed comes to only 1,20,000. So, 1,20,000 is sufficient to meet the defined benefit obligation. Hence, that surplus of 30,000 can be taken back by the company because it was the company who had created or contributed to that plan. That is the first situation. Or second situation is assets are returned to the reporting entity to reimburse it for employee benefits already paid. As I gave you an example, if the employer makes the employee benefit payment on behalf of the fund or on behalf of the trust, then the employer can ask for reimbursement. In these two situations, the money can come back to the employer. Otherwise, it will not come back to the employer. Let's have a look at the definition of a qualifying insurance policy. A qualifying insurance policy is an insurance policy issued by an insurer that is not a related party of the reporting entity. Okay. So, the qualifying insurance policy should be issued by an insurer who is not a related party of the reporting entity. If it is issued by a related party of the reporting entity, then it is not a qualifying insurance policy, right? And if the proceeds of the policy, the conditions are similar to the one which we have just discussed under assets held by a fund, the same conditions are applicable here also. The first condition is the proceeds of the policy can be used only to pay or fund employee benefits under the defined benefit plan and are not available to the reporting entity's own creditors even in bankruptcy and cannot be paid to the reporting entity. So, again similar condition, right? First, it will be used to make employee benefit payments only. Second, the money cannot be returned back to the reporting entity unless, of course, if there is a surplus or it is a part of the reimbursement. So, if these conditions are satisfied, it is called a qualifying insurance policy, right? Now, as far as we are concerned, we are not required to get into too much of depth of how these plan assets function, how this qualifying insurance policy function. For us, what we need to understand is what is a plan asset. So, plan assets are assets held by a long-term employee benefit fund and qualifying insurance policy. This is what are plan assets. What we need to bother is how do we need to do the accounting of these plan assets. Now, let me ask you a very simple question. Say you have to make a payment of 1 lakh to someone after 1 year. I come to you today and say that please keep aside some amount so that you are able to meet that liability of 1 lakh after 1 year. Now, if I ask you this question, what will be your answer? Will you say that I will set aside entire 1 lakh today, or will you ask me that what is the interest or what is the income that I will earn on the amount that I set aside today, so that the amount plus interest will be used to settle the liability. In other words, what I am trying to tell you is, if you have a liability of 1 lakh after 1 year, you will not keep 1 lakh aside. You will keep a lesser amount aside, assuming that you will earn some income on that particular amount, and that principal plus income, whatever you earn, you will use that to make the settlement of the liability. For example, assume for a moment that the interest rate is 15% for argument's sake. Okay, you have to make a payment of 1 lakh after 1 year. So if you have to make a payment of 1 lakh after 1 year, today what is the amount that you should set aside? 1 lakh divided by 1.15, right? We have discussed this multiple times, how to calculate the present value. So 1 lakh divided by 1.15, how much do I get? 86,956. So let us round it off to 86,960. Okay. So if you set aside 86,960 today, on that, how much is the interest you will get? 86,960 multiplied by 15%, you will get 13,044 as the interest, and if you total that, you get 1 lakh 4 rupees at the end of 1 year. That amount you can use to settle the liability, right? Same logic work in the case of plan asset as well. You may have some obligation to be paid after few years. Does not mean that the entire amount you will set aside as contribution to a plan asset. You will decide that each year what should be the amount you should contribute to a plan asset, so that that plan asset plus interest, whatever is earned on that plan asset, will be sufficient to meet the liability. And friends, please note, in some cases it is not mandatory to set aside an amount and create a plan asset. For example, gratuity payment. There is no legal requirement that for a gratuity payment you have to create a separate plan asset. It is as a matter of prudence, as a matter of company practice, they would create plan assets so that whatever is the amount which is contributed to that plan asset plus whatever is the income that is earned on those plan assets minus any expenses that is incurred by that specific plan or the fund, that amount will be used to settle the liability. That is the whole idea of creating these plan assets. When we are creating plan assets, we are factoring that the plan assets will earn income, will not keep those plan assets idle. Now, how will the plan assets earn income? The plan assets will earn income maybe by way of interest if you are investing in government bonds, maybe by way of dividends if you are investing in stock market, maybe there are some capital gains, that is also a form of return. And there would be some expenses of the plan. See, when a trust is managing a corpus of funds, definitely there would be some asset management related expenses, expenses related to brokerage, expenses related to administrative salaries, salaries of those who are managing the assets, who are taking the investment decisions. All of those also have certain costs. So what you need to understand is, whatever is the amount that an employer contributes to a fund to create a plan asset, that plan asset will generate income. It will generate income by way of interest or dividends. There would be some expenses of that particular plan. There may be some tax impact also. For example, for argument's sake, let us say whatever is the income earned by the trust, the tax is 30%. So if the interest income is 10%, out of that 3% would go off in tax. So what is left over is only 7%, right? So this is what would be the income on those plan assets. Now please understand, we have the employer and we have the employee. Employer has an obligation to make defined benefits payment to this particular employee. For that, what the employer has done, employer has created plan assets, and those plan assets will generate income. Those plan assets will generate income. Now, when assets generate income, what will happen to the asset balance? The asset balance would increase. So, whatever is the interest income earned by the plan assets or generated by the plan assets, it will result in increase in the value or the balance of plan assets. Now, another thing that you need to keep in mind is, this interest income which is earned on the plan assets may not be constant year on year basis. Now here also actuarial assumptions plays a very important role. So the actuary will say that this is the estimated return on the plan assets. This is the estimated return on the plan assets, and based on that we will calculate what is the interest income on the plan assets. Now if you have to bring both the obligation and assets as well as the cost and the income on the same page, how does it look like? See, on one side we have obligation, and how is that obligation created? That obligation is created by charging all of these costs. What are those costs? Current service cost, interest cost, past service cost, gains or losses on settlement, right? Considering all of these things, we have an item of expense. We have an item of expense, and correspondingly we have certain assets on which income is being generated or there is a return on those assets. Now this return on those assets would go on and reduce the net employee benefit expense. Now what do I mean by that? See, on one side we are saying there is an interest cost. Now that interest cost, is it not an expense? Yes, it is an expense. This interest income or the return on plan asset will offset the interest cost. Now it is not always necessary that interest cost will be equal to the return on plan asset. Say for example, interest cost is 10,000. Return on plan asset is 9,000. So your net interest cost is 10,000 minus 9,000, which is 1,000. So whatever is the return that is generated on plan asset will reduce the employee benefit expense. So what will increase the employee benefit expense? Your current service cost, your past service cost, your gain or loss on settlement, your actual gains or losses, your past service cost, all of these will increase the employee benefit expense. And what will reduce the employee benefit expense? The return on plan assets, right? Similarly, if there is any gain on settlement, that will also reduce the employee benefit expense. If there are actuarial gains, that will also reduce the employee benefit expense. Let's now summarize and have a look at what are the items that will go into P&L and how those items will impact the P&L. Then what are those items that will go to the OCI, how will they impact the OCI, and what would be the balance that would be going, that would be a part of your balance sheet presentation, right? Now coming to the P&L aspect, in P&L you will recognize the current service cost, the past service cost, the interest cost, the net gain or loss on settlement of employee benefits, right? All of these are recognized in the statement of P&L, right? Now also note that if there is any return on plan asset, that return on plan asset will be reduced from this expense that is recognized in the P&L. And if there are any gains on account of past service cost, that will be a negative item. Then if there are any gain on settlement, that will also be a negative item. That is how you will compute the expense to be recognized in the P&L. As far as actual gains and losses are concerned, they will be accumulated in the other comprehensive income. See, though they are a part of overall employee benefit related expense, but some part will be shown in the P&L and actual gains or losses will be shown in the OCI. And please note, these actual gains or losses which are shown in the OCI are never transferred to the P&L. You will continue to show them in the OCI or other comprehensive income. Then, when it comes to the balance sheet presentation, you have two items. One, the defined benefit obligation. Then second, you have those plan assets. Now what you need to do is you have to see what is the defined benefit obligation. From that, you will reduce the plan assets. Whatever is the net balance, that net balance will be shown in the balance sheet. Now, there may be a possibility that assets are more than the obligation or the liability. In that case, you will call it an overfunded plan. In other cases, there may be a possibility that assets are less than the liability, you will call them underfunded plan. But they will be presented as a net asset or a net liability in the balance sheet. In most of the cases, it will be a case of a net liability because no one would want to contribute more than what is required, right? So, you will represent net asset or a net liability in the balance sheet. Apart from that, obviously, you will also present the other comprehensive income related aspect. Now, when we are calculating the deficit or surplus in a plan, what we do is we compare the present value of defined benefit obligation with the fair value of plan assets. If the present value of defined benefit obligation is higher than the fair value of plan assets, then there is a deficit which results in a net liability. If the present value of defined benefit obligation is less than the fair value of plan assets, then there is a surplus which results in a net asset. Consider a situation where the present value of defined benefit obligation is 1 lakh and the fair value of plan asset is 1,20,000. Means what? There is a surplus of 20,000. So, ideally this 20,000 belongs to the employer because the employer can ask back any excess asset lying with the fund. But say for a moment that the structure is such that this 20,000 will not be refunded to the employer immediately. What the fund says is, we understand there is an excess of 20,000. So, instead of that, what you do is, the next 4 years contribution, let us say 5,000 every year. Let us say 5,000 every year. The next 4 years contribution, you don't make it to us. We will take care from this surplus asset. So, what is happening? The 20,000 of surplus asset is not being returned to the employer immediately. Instead, what they are saying is, Mr. Employer, for the next 4 years, the 5,000 of annual contribution that you are required to make, you do not make those contribution. We will adjust it from this particular surplus. Now, look at it from the point of view of employer. Is he getting that 20,000 of benefit immediately? He is not getting that benefit immediately. The benefit to the employer is flowing by way of reduction in contribution for the future. So, in each of the next 4 years, the contribution is reduced by 5,000. So, if you see, the benefit to the employer is not entirely 20,000, but the present value of this reduced contribution for the next 4 years. Because I have assumed that it is 5,000 every year, it would be obviously less than the 20,000 amount. So, what the standard says is, whatever is the net asset, for that you have to fix a ceiling. What is that ceiling? The ceiling is present value of economic benefits that will flow to the entity either because of a refund or because of reduction in contribution in the future. So, don't take entirely 20,000 as your net asset. You calculate what is the present value of economic benefit that is flowing to the entity because of this 20,000. So, all of these 5,000 amounts that I spoke about arrive at the present value. Whatever is that amount, that will be the maximum amount of your net asset. You cannot show the net asset at a higher amount than that. Assume for a moment, let's say there is a discount rate of 10%. So, if I have to calculate the present value annuity factor, 1 divided by 1.1 once, twice, thrice and 4 times, if I do a grand total, it is 3.1698. Now, if I multiply 5,000 with 3.1698, the present value comes to 15,849, round it up to 15,850. So, though the surplus is 20,000, I will restrict the net asset to 15,849 or 15,850. This is called asset ceiling. This is called asset ceiling because the present value of the economic benefits from the surplus asset to the entity is 15,850. So, the asset ceiling is the present value of any economic benefits available in the form of refunds from the plan or reduction in future contributions to the plan. That is what is called the asset ceiling, and that is the maximum value at which you can show the net asset. So, what is the net liability or net asset? The net defined benefit liability or asset is the deficit or surplus. If there is a deficit, it is a net liability. If there is a surplus, it is a net asset, adjusted for any effect of limiting a net defined benefit asset to the asset ceiling. So, it is either the deficit or the surplus. What is this deficit or the surplus? The deficit or surplus is the present value of the defined benefit obligation less the fair value of plan assets, if any. So, it is not always necessary that you will have plan asset. And what is this? What is the meaning of adjusting for any effect of limiting a net defined benefit asset to asset ceiling? It basically means the surplus or the net asset cannot be more than the asset ceiling. And what is the asset ceiling? It is the present value of the economic benefits that will flow to the entity because of the surplus in the plan assets, right? With this, we have understood what is the meaning of plan assets, right? Now, once you have understood the meaning of plan assets, please understand that in the balance sheet, the presentation is on the basis of net liability or net assets, and correspondingly we also understood what are the component that will be considered as an expense in the P&L and what part would go to other comprehensive income, that is a part of actual gains or losses. Now that we have understood concepts around what are benefit obligations, what are plan assets, also the items related to cost, let us have a look at few examples and illustrations to understand these concepts better and see how do we approach such problems in the exams or in real life scenarios, right? And let me tell you one thing, this is one standard which needs a lot of elaborate disclosures in the notes to financial statements, right? And you also need to understand how does each item impact the P&L and the balance sheet, right? So let's have a look at one question. RK Private Limited is an old company established in 1900s. The company started with a small capital base and all of this. So, please note in examination, right, these kind of additional information is not necessary. I don't know why, they want to build up this scenario and, call it a case study based question. Just by giving those 6 extra lines, it doesn't add any additional information to the given context, okay. So, you have to be sharp enough and smart enough to exclude those lines. So, by the time you read this, you should figure out that no, this is not something which is relevant for me to read in the examination. Don't waste your time in those 6 lines. So, then again it says, it has a large employee base, okay, it's fine. So, these are not numbers which will impact your calculations. The company provided, now from here is the main question. The company provided a defined benefit plan to its employees. Following is the information relating to the balances of the fund's assets and liabilities as on 1st of April of year 1 and 31st of March of year 2. Okay. Now, it says that there is a defined benefit plan and there is a fund balance of assets and liabilities. Now, please note that we have employees, we have employer, and there is an independent entity which is the fund. Okay. Now, the fund assets are for the benefit of the employees. The fund assets are for the benefit of the employees. But how will the employer present that in the balance sheet? Because the employer would have contributed some amount to that particular fund. Now, whatever is the contribution, the fair value of those plan assets would be shown as assets in the employer's balance sheet. Okay. So, please keep this in mind that even though the assets are held separately by an entity which is a fund or a third party or a trust, right, employer will still be showing the fair value of plan assets and the present value of defined benefit obligation in its balance sheet. Okay. As and when settlements are happening from the fund to the employees, the employer would reduce the value of those plan assets, because using those plan assets, the fund is paying those benefit to the employees, right? So, just don't think that because employer has already contributed, employer will not have anything in the balance sheet. Now, as far as the employer is concerned, whatever is the fair value of those plan assets, it would be shown as an asset in the balance sheet. Okay. So, don't think that there will be no asset in the books of employer. The plan or the fund will have its own assets, have liabilities, that is one aspect. Whatever is the portion of plan asset which will be used to settle the employee benefits, the fair value of those plan assets will be shown by the employer, and also whatever is the liability, the defined benefit obligation that we spoke about, that liability would also be shown in the books of the employer, right? So, though we say that the fund has assets and liabilities, these would actually be reflected in the books of the employer. So, we have present value of benefit obligation, opening balance is 1400, closing balance is 1580. Okay. Now, to quickly recap, what could be the various reasons because of which this balance would increase? It could increase because of the current service cost, it could increase because of the past service cost, it would increase because of the interest cost, it could increase because of actuarial losses, right? So, those items would result in increase of benefit obligation, and fair value of plan assets is 1140 and 1275. So, even here, let us say employer makes some contribution or there is a return on plan assets, because of that it results in this particular increase. Okay. For the financial year ended 31st March year 2, service cost was 55 lakhs. So, from 1400 to 1580, 55 lakhs of increment is because of service cost. Now, this is the current service cost. Then the company made a contribution of an amount of rupees 111 lakhs to the plan. So, from 1140, we made another contribution of 111 lakhs or 111 lakhs to the plan, and obviously there will be some interest as well. No benefits were paid during the year. So, when we say no benefits was paid during the year, nothing out of the plan asset was used to make any benefit payment to the employees, and hence there is no reduction in obligation also because of any benefit payment. Consider a discount rate of 8%. So, discounting factor or return on assets or for the benefit obligation, you have to consider it to be 8%. You are required to compute the balances of the company to be included in its balance sheet as on 31st of March of year 2, and amount to be recognized in the statement of profit and loss and other comprehensive income for the year ended 31st of March of year 2. Give the journal entries in respect of the amounts to be recognized. A very simple question, nothing to be worried. And we know that actual gains or losses, if at all there are any, that would be taken to other comprehensive income. It would not be a part of your P&L, right? Apart from that, other items would be impacting the P&L, and we will have to accordingly compute the balances in the balance sheet. Now, let us have a look at how do we approach this particular question, right? Now, if you see the question, we have been given the balances of present value of obligation, that is the liability opening and closing, and fair value of plan assets opening and closing. Now, you might be wondering, if they have already given us the closing balance, what is there for us to calculate in respect of balance sheet? See, what we need to calculate is, this is the opening balance 1400. To that we have added some current service cost. There would be some portion of interest cost. Using that we will arrive at the estimated closing balance, and that we will have to compare with the actual closing balance, and whatever is the difference, for that we have to give certain accounting treatments. Okay. So, let us have a look at that. Particulars, obligation, plan assets, right. So, we have opening balance when as on 1st of April. What is the opening balance? 1400 and 1140. 1400 and 1140. Now, on this, what is the expected return or what is the relevant discount factor that has been given in the question? They have said 8%. So, whatever is the opening balance, the first thing that you need to do is you need to compute what will be the interest on that particular component of opening balance, right. So, add interest cost or return at the rate of 8%. Okay. Now, when I say a return, this is expected return. Okay, this is expected return at 8%. Actual return might be different. That actual return might be different, which we will be handling separately. Expected interest cost on opening obligation is at 8%, which comes to 112, and on plan assets it comes to 91.20. Right? This is what is expected. Now, apart from this, what will increase the obligation? One is interest cost, that will increase the obligation. The other thing that will increase the obligation is your service cost. So please think of it logically as to what are the items which will result in increase in the obligation and what are the items which will result in decrease in obligation. So the service cost will result in increase in obligation. So add service cost. How much is the service cost given in the question? 55 lakhs. So this 55 lakhs will add to the balance of obligation. Okay. Now please note, this obligation of 55 lakhs that we have created is generally assumed to be at the end of the period. So there will not be any interest cost on that. Okay. Then is there anything else? There are no settlements. Okay. The question has not mentioned about actuarial gains or losses, which we actually need to indirectly calculate. Okay. So if you consider this, what will be the closing balance? Opening balance plus interest plus service cost. Closing balance should be 1567. So this is expected closing balance on 31st of March. How much? 1567. How much is the actual closing balance? The actual closing balance is 1580. Now, how did we arrive at this 1580, or who gives this 1580 number? This 1580 number is given by our actuary. The actuary will say, as on 31st of March, the present value of a defined benefit obligation works out to 1580. Now, when we calculated, we got only 1567. Now, what is this difference? This difference is generally the difference because of changes in actuarial assumptions. Maybe there are certain changes in actuarial assumptions because of which now the actuary says your liability is higher. Your liability is higher. Now, when liability is higher, what is it? Is it not a kind of a loss or an expense to us? Yes, it is a kind of loss or an expense to us, but this is not an item which will go into P&L. This is an item of actuarial gain or losses which will be taken to other comprehensive income. So, actuarial gains or losses here will be 1567 minus 1580, 13 is the actuarial loss. On what? On defined benefit obligation. Similar exercise we will have to do for plan assets as well. Now, if you look at plan assets, here you will not add service cost, you will add contribution. Okay, how much is the contribution? 111. So, what is the expected closing balance? Opening balance plus interest plus contribution. Expected closing balance is 1342. What is the actual closing balance? Again, let's look at the question. It says 1275. 1275. Now, here also you expected that the plan asset should be having a closing balance of 1342, whereas it has only a closing balance of 1275. Now, what could be the reason of this difference? The reason of this difference could be multiple. One is your actual gains and losses, that is very much possible. And one important aspect is, we expected that the plan would generate a return of 8%. Even the actuary would have expected that the plan would generate a return of 8%, whereas the actual return might be less. Actual return might be less. Why? Because the value of investments may have fallen down. That is also possible, right? So, because of that, the balances differ. So, what we need to do is, we need to again remeasure the expected closing balance and bring it down to the actual closing balance. Now, this actual closing balance actually represents your fair value of plan assets. This 1275 represents fair value of plan assets. This is what we have expected. So, we have to remeasure the expected plan assets and we have to bring it down to or bring it up to the fair value of plan assets. Now, if your assets balance come down, what is it? Is it a loss or a gain? It is a loss. Now, here the reduction in balance of assets is nothing but your loss, which is attributable to actuarial gains or losses, right? Now, this difference between 1342.2 that we expected to be the closing balance and the actual closing balance of 1275, this difference is called loss or gain due to remeasurement. Now, in this case, it is a loss. Why remeasurement? We expected the closing balance to be 1342. Actual fair value of plan asset is only 1275. So we'll have to remeasure these plan assets. We have to remeasure these plan assets, and this remeasurement of plan assets can result in loss or gain. Now what do we do with this loss or gain arising out of remeasurement? This also has to be taken to OCI. This has to also be taken to OCI in the same lines as we take actuarial gains or losses on defined benefit obligation. So here you see the difference, 1275 minus 1342, it is 67.2. Okay. Now this is, I'll put a separate line, plan assets. So this is this minus this 67.2. Okay, right. Now what is the total OCI then? OCI means other comprehensive income. The total loss would be your 13 plus 67.2, which comes out to 80.2, right. Now there is another way to understand this 67.2, that is, what is my opening balance plus contribution? My opening balance of investment is 1140. My opening balance of investment is 1140 plus contribution I made is 111, that is 1251. Think of it in a way that you had investments of 1140 at the beginning, you made further investments of 111, so your investment should be ideally be at 1251, that is the total value of your investment. But what is the actual closing balance? Actual closing balance is 1275. Now can I say that the difference is the actual return on plan assets? See, my investments, my opening balance of investments plus my further contribution is 1251. My closing balance is 1275. Now this difference is nothing but my return, right? So this is actual return on plan assets, that is 1275 minus 1251. Now what is the expected return on plan asset? Expected return on plan asset is 91.2. So the difference between this 91.2 and 24 is nothing but your loss on remeasurement of 67.2. Okay, that is another way to understand the loss or gain on remeasurement, and this item will also be taken to OCI in line with actuarial gains or losses. Now let us look at the requirements of the question. Compute the balances of a company to be included in its balance sheet as on 31st of March. So when they say balances to be included in the balance sheet, it means whether it will be a net liability or a net asset, that is what you have to compute, and amounts to be recognized in the statement of P&L and other comprehensive income, right. So we have already done the calculation of any gains or losses which have to be recognized in OCI. Using that, we can show the amounts to be reflected in the P&L, amounts to be reflected in the P&L as well as in the OCI. So now when it comes to presentation in the balance sheet, what we need to see is how much is the liability and how much is the asset, and the net amount is presented. The net amount is presented. Now here, what is the closing balance? Closing balance is 1580 and 1275, right. This is what is the closing balance, 1580 and 1275. So we will not show like 1275 of asset and 1580 of liability. We will show a net number. Net number means if liability is more than asset, we will show a net liability. If asset balance is more than liability, we will show a net asset. So here, what will be there? What will be shown? Net liability, because liability is higher. So net defined benefit liability, and how will we get that? Your 1580 minus 1275, that's it. So 305 will be presented in the balance sheet. You can just note it down, 1580 minus 1275. This is what will be presented in the balance sheet. Now coming to P&L and OCI. Now coming to P&L and OCI, what will you present? In P&L, we have to present the employee benefit cost. So now what will this employee benefit cost comprise of? It will comprise of current service cost and interest cost, right. Now again here, what you need to keep in mind is when we talk about interest cost, it will be the net interest cost. If you are getting confused, what you can also do is interest cost on DBO and return on plan assets. You can present it separately for your understanding. So current service cost, we know it is 55. Interest cost on defined benefit obligation was how much? We had calculated 112. Return on plan asset is a negative item, so which is minus 91.2, right. Apart from that, do we have anything which will go to the P&L? Now as far as the actual gains or losses are concerned and return on plan asset and the remeasurement related loss are concerned, they would be shown in the under the other comprehensive section. So here the total would be 75.80, and when it comes to other comprehensive income, what do we have under other comprehensive income? Actuarial losses and loss on plan assets, right? How much is that? Actuarial losses we calculated was 13, right? It is 13 and 67.2. So 13 here and 67.2, the total comes to 80.2, right? So please note, this will go to OCI, this will be shown in OCI, this will be shown under your employee benefit cost. So what will be the total? Total would be 80.2 plus 75.8, the total comes to 156, right? This is what will be shown in the P&L and other comprehensive income, right? Then the question has also asked us to pass journal entries. Now when you pass the journal entries, now when it comes to journal entry, what we can do is, see, because we are presenting it on a net basis, see the opening balance also, if you see 1400 minus 1140, this is the net opening balance. And if you see the closing balance, this is 1580 minus 1275, this is the net closing balance. Then 112 minus 91.2 is the net income. So this 20.8 also can be calculated as 260, which is the net liability, multiplied by 8%. If you do, you get 20.8. So you can do it on a net basis also, and when we are passing journal entries, we will pass it on a net basis, right? So 20.8 will be the net interest cost which will be debited. Then you have the current service cost 55, and then you have a contribution for this also, there will be an entry, and for this actual gains or losses and loss on remeasurement, there will be an entry, right? So once you understand what item results in increase in the liability or increase in asset, what item leads to reduction in liability or reduction in an asset, then passing journal entry will not be difficult. So let's pick up each of these item and pass the journal entries. Journal entries. Now when it comes to journal entries, what we'll do is, what is the portion of employee benefit cost to be debited to P&L? So we have to debit 55, 112 minus 91 on a net basis, you will debit that to P&L. So profit and loss debit by how much? We have already calculated here 75.80, that is one item of debit. Now this is one debit. Then now this 75.8 includes both your current service cost, interest cost on DBO minus return on plan assets. Okay, it includes all of those things. Then that is one item of debit. Apart from that, what is the other item of debit? We are debiting this item of 80.2 to other comprehensive income. So OCI debit by how much? By 80.2. Then we have contributed 111 to the plan, means we have paid 111 to the plan. Now when we pay 111 to the plan, what does that mean? There is an outflow, so we will credit bank account to bank 111, right? To bank 111. Then where will the balance sit? Now if you see here, now where will the balance go? If you see here, the net increase, if you see 305 and 260, what is the net increase? The net increase on liability is 45. So to net DBO, to net defined benefit liability 45. So if you total it up, 156 and 156. Now this is the net entry that you would pass. But if I have to break down this entry, and see what will be the impact on the liability independently and what will be the impact on the asset independently, if I break it down, let us see how does it look like, right? So coming to the DBO side, what will increase the DBO? Your current service cost debit 55, interest on DBO, that will increase the defined benefit obligation, which was 112, and there is also an actuarial loss of 13, right? So OCI debit 13 and credit what? To DBO you get 180. Now what does this 180 represent? This 180 represents basically your increase in obligation from 1400 to 1580. So what I have done is I have actually reconciled this 1400 to 1580 by breaking down the journal entry. That is the first component. Then similarly for assets, what have we done on asset side? One, there is a contribution. Second, there is a return on plan assets. There is a return on plan assets, that is one aspect. And third, there is a loss on remeasurement. So three components are there. So when we make a contribution, what would we say? We would say to bank 111. This is what's first thing. Now first thing is contribution to bank 111. Apart from that, there is a return on plan asset, means there is an income on plan asset. When there is an income, what do? You credit income and you debit the plan asset. So you will say to return on plan assets, it was 91.2. Then there is a loss on remeasurement which will debit to OCI, debit, which is remeasurement loss. How much was the loss? The remeasurement loss was 67.2. You will debit that, right? Then the balance is to plan assets. How much is that? 111 plus 91.2 minus 67.2, which is 135. So basically we are saying plan assets have increased by 135. Now what does this 135 comprise of? This 135 comprises of 111 of contribution and 24 of actual return, right? So this is how you can split the entries, but in examination what you are expected to do is to pass a net entry. Now how do we pass a net entry? See, DBO increased by 180, liability increased by 180. What is the net value? 180 minus 135 plan assets, you get 45. So net increase in defined benefit liability is 45. Then current service cost is an expense item debited to P&L, 55, plus interest on DBO is debited to P&L minus return on plan assets, which is expected. So 75.8 is your this item. Then OCI 13 plus OCI 67.2, it is 80.20, which is debited here, and this 111 is credited here, right? So what I have done is actually I have shown you how do we break down the components of that specific journal entry so that you can understand. Now in a nutshell, if I have to summarize how do you approach this kind of problem, is that first see the movements in DBO and plan asset. Based on that, calculate if there are any gains or losses. On DBO it could be because of actual gains or losses, and on plan assets it will be on account of remeasurement, right? And based on that you will pass the journal entries. When you pass the journal entries, you will pass it on the net basis, meaning to say what is the net increase in liability and asset. For that you will pass a single entry. For that you will record an item. Then the interest cost on a net basis. Now when you have to calculate it on a net basis, as I showed you earlier, you can directly do 260 multiplied by 8%. That is also perfectly fine. Okay, that will be your net cost. Then whatever has to be debited to OCI, that will be a single item. Whatever is the contribution, it will be a single item to bank. So based on that, you can pass this particular entry, right? I hope it is clear. One more thing. To calculate gains or losses, you can also prepare a ledger account. Now how do you prepare a ledger account? Let me quickly do that for you. Let us say DBO, right? Now in DBO we have opening balance, so by balance carried down a liability. How much is the opening balance? Opening balance is 1400. So here you will say 1400 opening balance. Okay. Then what is the closing balance? We have the closing balance to balance carried down. Sorry, here it has to be balance brought down. So by balance brought down 1400 to balance carried down, how much is the DBO? 1580. Okay. Now we know that this obligation will increase because of current service cost and interest cost. So by service cost, how much was the service cost? 55. Then by interest cost is 1400 multiplied by 8%, 112, that is the interest cost, right? Apart from that, do we have anything else? We do not have anything else. Now if you see this, the total comes to 1567, whereas the actual balance carried down is 1580. Okay, so the balancing figure, that is the loss, will be debited to OCI, by OCI, which is 1580 minus sum of this is 13. Okay, so the total here is 1580 and total here is also 1580, right? So this is how you can do. This OCI is nothing but your balancing figure. is the balancing figure of loss. Similarly, for plan assets, you can have two balance carried down. How much is the balance? 1140 and 1275. So 1140 to balance brought down 1140 by balance carried down 1275. Right, now here also to bank. Why to bank? Because we are making a contribution, it will increase your plan assets. So you will debit plan asset and credit bank 111. Then to expected return on opening balance 1140 multiplied by 8%, which is 91.20, right. So how much does the total come to? Now the total of the debits is 1342.20, the closing balance is 1275. The difference between these two is a loss, you will debit to OCI. So by OCI, loss will be how much? 1342.20 minus 1275. This is the loss, which is 67.2, right. So if you total it up this side, you will get 1342.2, right. Now on a net basis, if you see 91.2 minus 67.2 is what is the return on plan assets, right. So by preparing a ledger also you can calculate the gain or loss and arrive at the loss or gain on remeasurement. You can approach in either of these two ways. What I would prefer is a statement format because it helps you understand the logical flow of movement in balances. Let's have a look at another question. SA Private Limited is engaged in the business of retail, having 100 retail outlets across the country. The company head office is in Chennai. SA Private Limited is a subsidiary of SAG Limited and SAG Limited is listed on National Stock Exchange. Now this information is given just to tell you that Ind AS is applicable to this company being a subsidiary of a listed company. Okay. When we reach to applicability and non-applicability of Ind AS, we will understand that in detail out there. Right now we are building concepts as to how do we handle different situations when it comes to accounting, right. Then following information is available for SA Private Limited, plan assets. So for plan assets related information, as on 1st April, fair value of the plan assets was 10,000. So on 1st April, fair value of plan asset is 10,000. Contribution to the plan asset done on 31st of March of year 2 is 3,000. Amount paid on 31st of March of year 2 is 300. Now what is the meaning of amount paid on 31st of March of year 2? This means that so much of amount has been paid as a benefit payment to the beneficiaries. Then on 31st March, the fair value of plan asset was 14,700 and actual return on plan asset was rupees 2,000. So they have given us multiple different information relating to what is the opening balance, what is the contribution, what is the amount paid, what is the fair value and the return on plan asset. Similarly, for defined benefit obligation, on 1st April, present value of defined benefit obligation is 12,000. 31st March, the balance is 15,500. Actual losses on the obligation was 100. Current service cost 2,500. Benefit paid 300. See, I told you, right? Benefit paid 300. This is nothing but this part. This benefit paid. This is what it relates to. So, when we say benefit is paid, your liability also comes down. The asset balance also comes down. Discount rate used to calculate defined benefit liability is 10%. The question is, as per Ind AS 19, please suggest if there is any amount based on the above mentioned information that would be taken to other comprehensive income with workings and also compute net interest on the net defined benefit liability or an asset. Now again here, like we did in the earlier question, we have to see what is the opening balance, what are the changes, what is the expected closing balance, and the difference would be gain or loss which will be taken to OCI, right. With that understanding, let us get into solving this question. Now like we did in the earlier problem, here also we will do a detailed working and then I will tell you how you can quickly compute these information in the examination, right. You have to build your concepts right because a lot of students get scared in this standard, whereas this standard is not difficult, this standard is not tricky. It is just that it has a lot of theory involved and calculation or numericals are pretty simple and straightforward, right. You just need to take opening balance, whatever are the movements, calculate the expected closing balance, with that closing balance calculate the actual closing balance and find out the difference. That is it about a lot of illustrations in this standard, right. So again, now here again in this question we will follow the similar approach what you have taken in the previous example. It is slightly detailed but that helps you build an understanding of the underlying concept. A lot of students unnecessarily get scared of this standard, whereas this standard is all about simple logical treatment of balances, right. There is nothing complicated. The institute is not asking us to calculate or make actuarial assumptions. They are giving us the numbers. We just need to figure out how much is the gain, how much is the loss, and what should be the treatment. Because we think this standard is lengthy and it has so many concepts, we get unnecessarily scared. Don't do that. Just understand the logic. And once you follow a stepwise process, it will be definitely easy for you, right? Now again, as we did earlier, so let us do the opening balance. What is the opening balance? Opening balance of obligation is 12,000 and opening balance of plan asset is 10,000. Okay, so what is the net? Net is a liability 12,000 minus 10,000. It is a net liability of 2,000, right? Now to this opening balance, what will we add? The interest cost will increase the obligation. Return on plan asset, expected return on plan asset will increase the plan asset value, right? So add interest cost or expected return. Okay, and what is the discount rate given in the question? They said 10%. So 12,000 multiplied by 10% and 10,000 multiplied by 10%, you get 1,200 and 1,000. And if you see the net balance, which is 12,000 of cost minus 10,000 of return, net is 200. Okay, so this is the meaning of the question when it says calculate the net interest on the net defined benefit liability or asset. Now here it is a net defined benefit liability. Why? Because liability is more than asset. So 200 is the net cost. 200 is the net cost, right? Then apart from this, what will increase the obligation? The service cost will increase the obligation. And do we have anything else? We don't have anything else. So current service cost will increase the obligation. So add current service cost. And the question says current service cost is 2,500. Okay. Now what will increase the plan assets? Contribution. Contribution. How much is the contribution made? As per the question, contributions made are 3,000. Okay, this one will increase the obligation, the other will increase the plan asset. Then less. Now what is this benefits paid? Now when we say benefits paid, this is basically out of the obligation we are paying some benefit to the employees. Now tell me one thing, whenever we have a liability and asset in the balance sheet, when we use an asset to pay the liability, what will happen? The liability would come down, simultaneously the asset balance would also come down, correct? Because on one side you will debit the liability and on the other side you will credit the asset, both of them will come down. Same thing here also, 300 is the benefit payment. So what will happen? You will reduce 300 from the asset as well as the liability. So the net impact here will be nil, okay? So we just have to see the net impact, here it will be nil. Then apart from this, what will impact the balances of obligation and plan assets? Now the question says that there are actuarial losses on the obligation for the year ended 31st March of year 2 is 100 and the present value of the defined benefit obligation is also given. So there is an actuarial loss. Now when there is an actuarial loss, will my liability reduce or will my liability increase? Ask this question, you will get the answer. If I have incurred a loss, my liability would increase because you will debit the loss and credit the liability. So add actuarial losses, how much is that? 100, you just add this, okay. Now expected closing balance, which is opening balance of 1200 plus opening balance of 12,000 plus 1200 plus 2,500 minus 300 plus 100, it is 15,500. And what is given in the question? The actual balance is also 15,500. Now, if we have to slightly step back and what we did in the previous problem, what we did there was, here we calculated expected closing balance. How much was the expected closing balance? 15,400. What is the actual closing balance? Actual closing balance is 15,500. So if your actual obligation is more than the obligation in your books, the difference represents actuarial losses, right? So this is another way in which you can arrive at the actual gain or loss. Now, are we required to do all of this in the examination? No, because this actuarial loss of 100 is given to you in the question. This 15,500 of closing balance is also given to you in the question. I am just showing this for your understanding as to how the balances are moving, okay. So I will just delete this part. Then coming to the asset side, what is the expected balance? 10,000 plus 1,000, 11,000 plus 3,000, 13,000 minus 300, 10,000 plus 1,000, 11,000 plus 3,000, 14,000 minus 300, it gives you 13,700. What is the actual closing balance? Actual closing balance on plan assets is 14,700. Okay, now we had expected 13,700. Actually, it is 14,700. That is the fair value. This again is fair value. Okay, please keep this in mind. This is fair value. Now, what does this mean? This means that there is a gain. What is the gain? Actual closing balance of asset is higher, 14,700 minus 13,700. There is a gain of 1,000. Now, how do I relate this information back to the question? My expected return is 1,000. My actual return, so this actual losses and gain on remeasurement. Okay. Now, if you look at the information, my expected return is 1,000 and I have a gain on remeasurement 1,000. If I sum this up, 1,000 plus 1,000, what do I get? 2,000. What was this? This was actual return on plan assets. This is 2,000, right? So, this is how you can understand the information given in the question. Now, am I required to do all of this computation in the exams? No. What is the question asking us? The question says, what is the amount, if there is any amount based on the above information that would be taken to other comprehensive income, and you have to show this with working. Now, what is the amount that we need to take to the other comprehensive income? We have to just take these actual losses of 100 and this gain on remeasurement of 1,000. Now, you may have a doubt that, sir, how will we quickly get to know about this information in the examination? What you can do is amount to be taken to OCI. Now, here we have obligation, on obligation and on assets, right? What is the amount to be taken? Now, here we will take actual losses. Now, actual losses is already given to us in the question. So, 100 you can take directly. This is a loss. Now, on asset, how do we take? On asset, what you do is you say what is the actual return. How much is the actual return? 2,000. Right? This is what is given in the question. What is the expected return? Expected return is 1,000. How did I get 1,000? 10,000 multiplied by 1. Okay. So, because my actual return is more than my expected return, there will be a gain on remeasurement. So, gain on remeasurement is 2,000 minus 1,000, which is 1,000. So, net on one side there is a loss, let me put it in negative number, and this side there is a gain. So, net amount to be credited to OCI will be how much? 1,000 minus 100, which is 900. This is the amount to be taken to OCI. And the other part of the question says, compute the net interest. Compute the net interest means what? Take the net balance, multiply that with the interest rate, which is 10%, 200 is the net interest. This is what is required by the question. This table is purely for your understanding purpose, right? So, with this we come to the end of this problem. Let's move on to the next one. Let's now have a look at another question. Friends, in this particular standard, you will see some questions to be extensively lengthy, but what is important is to identify the key points and the key amounts and then do the solution. Solution will be simple, but you need to be patient enough to figure out what are the key information, read the question carefully, and then once you figure out the relevant information, finding the answer or arriving at the solution would not be a challenge. A Limited prepares its financial statements to 31st March each year. It operates a defined benefit retirement benefit plan on behalf of current and former employees. Basically, it has a defined benefit plan. A Limited receives advice from the actuaries regarding contribution levels and overall liabilities. This is a known thing, so nothing great information there. So you can just ignore this part. This part you can simply in the examination also no need to come back again. Then on 1st April of year 1, the actuary advised that the present value of the defined benefit obligation was 6 crores. On the same date, the fair value of the assets of the defined benefit plan was 5.2 crores, right? So, this is what is the information given by actuary with regards to the opening balance, right? So, as we read the question, I will just note down the information simultaneously and then we will see what is asked by the question. Opening balance, and let me put rupees in lakhs. It'll save us some time, okay. Defined benefit obligation is 6 crores, that is 600 lakhs. And plan assets, the fair value of plan assets is 5.2 crores, which is 520 lakhs. Now, First thing, is it a net liability or net asset? It is a net liability. So 600 minus 520, this is a net liability. Okay, net liability. 80 lakhs is the net liability opening balance. Then on 1st April of year 1, the annual market yield on government bond was 5%. So on 1st of April of year 1, the annual market yield on government was 5%, which means now this information is given to us so that we can consider this 5% for our discount rate and also for our return on plan assets, right? Now on 1st April of year 1, the annual market yield on government bonds was 5%. What does that mean? The interest cost has to be computed considering 5% and the return on plan assets will also be computed considering 5%. So same thing we can write here, interest cost and return on plan assets. Okay, how much is that? 5%. So 600 multiplied by 5% is 30 and 520 multiplied by 5%, which is 26. Now friends, please note this calculation is done based on the opening balance. Okay, and in examination, instead of preparing two columns, you can do it on a net basis also. You can directly say 80 multiplied by 5%, you get 4. So that is also perfectly fine. Now what will this interest cost and return on plan asset do? Interest cost will increase the obligation, that's why it's a positive number. Plan asset, return on plan assets will increase the value of plan assets, right? Then during the year ended 31st March of year 2, A Limited made contributions of rupees 70 lakhs into the plan and the plan paid out benefits of rupees 42 lakhs to the retired members. Both these payments were made on 31st March of year 2. Now, first thing, contributions of 70 lakh is made. Now, when an employer makes a contribution to the plan, does it change the liability? It does not change the liability. It impacts only the asset side. That is the first thing. Okay. Now, second thing, when a benefit payment is made to the employees, then in that case, the liabilities also come down, the assets also come down simultaneously. So, add contributions. How much is the contribution to plan asset? The question says 70 lakhs. Okay. Now, this is a contribution to plan asset. When you make some contribution to plan asset, what will happen? Your asset balance will increase. Your asset balance will increase. So, what will happen to the net liability? The net liability will come down. Please understand, if I just contribute asset, if I just increase the asset, what will happen to my net liability? My net liability will come down. So, this will be liability minus assets. If I do, I get negative of 70. Why negative of 70? Because the employer has made the contribution, assets value have increased, and because assets value have increased, the net liability has come down. Then the question says benefit payments of 42 lakhs. Now, because of this benefit payments, your asset value will also come down, your obligation will also come down. This we have discussed in earlier two problems as well. So, less benefits paid. How much is that? 42 lakhs and 42 lakhs. Now, the impact of this is 0 on the overall net liability position. Then, the actuaries advised that the current service cost for the year ended 31st March of year 2 was rupees 62 lakh. Now, what will happen because of this current service cost? The current service cost will increase your obligation. The current service cost will increase your obligation. So, what will you do? You will add this to the liability. Add current service cost. How much is the current service cost? Current service cost is 62 lakhs. So, 62 lakhs here. Will it change my asset? The current service cost will not change my asset. So, I will not consider there. It is 0. The net impact there is positive of 62. Then, on 20th February of year 2, the rules of the plan were amended with retrospective effect. So, on a particular date, that is on 20th of February of year 2, the rules of the plan were amended with retrospective effect. These amendments meant that the present value of the defined benefit obligation was increased by 15 lakhs from that day. What does that mean? On 20th February, there was an amendment. The moment you hear this term amendment, what comes to your mind? Past service cost. So, there is a past service cost, and please see here, it says that the present value of DBO increased by 15 lakhs from that date. So, with effect from 28th of February, the present value of defined benefit obligation has increased by 15 lakhs. If obligation increases, what happens? Your liability will increase. Will the asset change? The asset will not change. So, this item will have an impact only on the liability. Add past service cost, right? Now, how much is the past service cost? They have mentioned it to be 15 lakhs. Now, some of you may get a doubt that this change has happened with effect from 20th of February. Does it mean that we have to consider 1 month interest here? We will not consider 1 month interest here. All the interest related computation is done on the beginning balance. Then how will we factor in the impact of interest cost for this particular item which has appeared on 20th February? It will get adjusted in the remeasurement aspect or actual gains or losses aspect, right? So here you will not again do a interest cost calculation on something which has changed during the period. All interest cost calculation, your discount calculation, all of that will happen considering the opening balance, right? So this will also increase my liability by how much? This will increase my liability by 15 lakhs. Then during the year ended 31st March of year 2, A Limited was in negotiation with employee representatives, generally the unions, regarding planned redundancies. Now, what is the meaning of planned redundancies? Redundancies mean that the entity is considering reducing the employee strength. That is what is called redundancy. Now, when redundancy happens, what kind of negotiation would be there? There will be some kind of settlement related aspect, right? Because if you are asking employees to leave, you may have to settle some amount to the employees. You may have to pay some amount to the employees. Okay. The negotiations were completed shortly before the year end and redundancy packages were agreed. So, they have agreed upon what will be the redundancy package. The impact of these redundancies was to reduce the present value of the defined benefit obligation by 80 lakhs. So, because of the redundancy, the present value of defined benefit obligation will be reduced by 80 lakhs. Means you will reduce the liability by 80 lakhs and A Limited made payments of rupees 75 lakhs to the employees affected by the redundancies in compensation for the curtailment of their benefits. So, this aspect you need to understand slightly better. What has happened here? On one side, we have reduced the defined benefit obligation by 80 lakhs. So, we told the employees that 80 lakhs worth of benefit will be removed from this defined benefit plan, and in settlement of that 80 lakhs, the entity has paid 75 lakhs to the employee. So, basically think of it in a way where a liability of 80 lakhs is settled by a payment of 75 lakhs. So, we are basically doing a settlement. Now, when we are doing this settlement, do we have a gain or a loss? Here we have a gain because something worth 80 lakhs is now being settled for 75 lakhs. So, on one side, your liability has come down by 80 lakhs and on the other side, your assets have come down by 75 lakhs only. So, there is a gain of 5 lakhs. Now, if there is a gain of 5 lakhs, what will be the impact on the overall net liability? The overall net liability would reduce by 5 lakhs, right? So, when we settle, we reduce the liability by 80 lakhs, we will reduce the asset by 75 lakhs, the net impact on the liability is 5 lakhs. This 5 lakhs, if you remember, is nothing but your gain on settlement. Then, the question is, these payments were made out of the assets of the retirement benefits plan. So, that is how the settlement will be happening. That is how the settlement would be done. On 31st March of year 2, the actuaries advised that the present value of the defined benefit obligation was rupees 6.8 crores. On the same date, the fair value of the assets of the defined benefit plan was 5.6 crores. Examine and present how the above event would be reported in the financial statement of A Limited for the year ended 31st March of year 2. Now, before we take the actual, let us take the expected. What is the expected closing balance? I will do very slowly one by one, considering each line item. Now, while calculating the expected closing balance, we will take each item and see what we need to add, what we need to reduce again, so that you are absolutely clear regarding the treatment of the DBO and the plan assets. So, what is the expected closing balance? 600 plus interest cost will increase the liability 30 plus contribution to plan assets will not have an impact on obligation. Benefits paid will reduce the liability. You will reduce 42 minus 42. I have written in brackets, so the Excel automatically would calculate it as a negative number. Then current service cost will increase the liability. Then past service cost will also increase the liability, and settlement will reduce the liability. You will do minus 80. So, what is this? 585. Similarly, coming to the asset side, 520 plus 26 is the return on plan assets, it will get added. Please note, this 26 is expected return on plan asset. 26 is expected return on plan asset. Actual return may be different. The difference will be nothing but gain or loss on remeasurement of plan assets. Okay. So, 26 plus contribution, it will increase 70 minus 42 benefits paid minus 75 settlement paid 499. So what is the net closing balance? 585 minus 495. 86 is the net liability. What is the actual closing balance? Actual closing balance is 6.8 crores, which is 680, and 5.6 crores, which is 560. So what is the actual closing balance? 120 is the actual closing balance. So what is the difference? 120 minus 86, 34 lakhs. Now what is this 34 lakhs? Is it a gain on remeasurement or a loss on remeasurement? See, we expected our liability will be 86. Now actually the net liability comes to 120. Our liability has increased. If our liability has increased, it is a loss. So loss on remeasurement is 34. Okay. So there will be a loss on remeasurement, which is 86 minus 120, 34. That is the loss on remeasurement. Now if you look at each of the individual liabilities, this is 585 minus 680. 95 is the loss on remeasurement on the obligation side, and 560 minus 499, 61 is the gain on remeasurement of plan assets, right? So 61 is the gain and 95 is the loss. Net loss comes to 34 lakhs. This is your balancing figure, right? Now in examination you can do just this column, the net liability column, and when you do the net liability column, this benefits paid will, the impact will be 0, right? Apart from that, all the items will be relevant. The final amount, which is 34 lakhs that you have got here, is the loss on remeasurement. Now if you look at the question says examine and present how the above event would be reported in the financial statement. So we have to see for each item how would the reporting be done. Now let us see how will we present each of these items in the financial statements, right? When it comes to presentation in the financial statements, there will be presentation in the P&L and in the balance sheet. Balance sheet is pretty simple. What will be the presentation in the balance sheet? You will take the actual closing balance, that is the present value of defined benefit obligation, and you will compare that with the fair value of plan assets, and whatever is the difference, if there is a surplus, you will show it as a net asset. If there is a deficit, you will show it as a net defined benefit liability. Now in this case, the entity will report net liability of 1.2 crores, right? So this will be taken to your balance sheet. So this 120 will be presented in your balance sheet. I'll just note it down by P. Okay, 120 will be the net defined benefit liability presented in the balance sheet. Now coming to P&L, what all will go into P&L? Your current service cost 62 will go into P&L. This will be presented in the P&L. Then interest, net interest cost on defined benefit liability 4, that will go to P&L. Then past service cost, it will go to P&L. Please note, in examination you may get questions like the entity wants to amortize the past service cost over the remaining useful life. That is not permitted under Ind AS 19. So you will not amortize it, you will directly take it to the P&L. Then settlement, there is a gain on settlement, right? So this gain on settlement will also be recognized in P&L of 5 lakhs. Then this difference of 34 lakhs, where will that go? That will go to OCI. So please note, both actual gains and losses and loss or gain on remeasurement, that will be taken to the OCI. Now here this 95 and this 61, which represents the loss or gain on remeasurement, that will be taken to OCI. On a net basis, 34 lakhs will be debited to OCI. So this is how you will present the numbers in the P&L and in the balance sheet. Now again I am repeating, friends, once you understand this flow of information, right, what should be added, what should be deducted, based on that you can easily arrive at the closing balances. Now as we move ahead, we will not do in a random manner, we will follow some order, like first we will take maybe current service cost, then past service cost, then settlement, then we will take the benefits, then contribution, and then maybe interest. Based on that we will do it, we will improvise that presentation, but firstly it is important for you to understand the underlying logic. We are simply taking a liability, what are the changes to the liability? We are taking an asset, what are the changes to the asset? And on a net basis, we will be taking the impact in the P&L. And in the examination, as I told you earlier also, you can just prepare this column, net liability, and do the calculations. Let's have a look at another question, pretty similar to the ones that we have discussed so far, but we are doing more problems so that you get comfort on this topic, because this is the type of numericals that will be tested in the examination, and it is a 5 out of 5 or 8 out of 8 marks question. You cannot make mistakes and lose marks in these kind of straightforward questions, right? So let's have a look at it. On 1st April of year 1, the fair value of assets of XYZ Limited DBP, defined benefit plan, were valued at 20 lakhs 40,000, and the present value of defined obligation was rupees 21 lakhs 25,000. Okay, and if I just see the requirements, it says provide a reconciliation from the opening balance to the closing balance for plan assets and defined benefit obligations. So basically, take the opening balance, provide a reconciliation, means what are the items which has caused increase in these balances. What are the items which has caused decrease in these balances? Identify all of those items and prepare a reconciliation statement. That is what is the requirement, right? And also show how much amount should be recognized in the statement of P&L, OCI and the balance sheet. That's a simple one. That's a simpler one. So again, similar to the way that we have done earlier, fair value of plan assets of DBP were valued at 20,40,000. Please note this is a fair value of plan assets and the present value of defined benefit obligation is 2125. So just let me write down. I will delete this. Opening balance of obligation is 2125,123 and opening balance of plan asset, that is the fair value of plan assets, is given to be 20,40,000. Okay. So what will it be? A net liability or a net asset? Again, this information is not asked in the question. We are just doing it for our practice purpose, right? So obligation is more, liability is more. So your net liability is 85,000. That is the opening balance. Then on 31st March of year 2, the plan received contributions from XYZ Limited amounting to 425 and paid out benefits of 255. Now when contributions are received, what will happen? Asset balance will increase. So 425 you add it to the contribution on assets, 4,25,000 and benefits paid is 2,55,000. This will reduce the liability and please note this will also reduce the asset. So minus 2,55,000. Okay. Then let me just copy this formula. I am just doing asset minus liability, right? Then the current service cost for the financial year ending 31st March of year 2 is 5,10,000. This current service cost will increase my liability balance. So I will add it. So add current service cost which is 5,10,000, right? Then an interest rate of 5% is to be applied to the plan asset and obligation. What does that mean? The opening balance will result in an interest cost at 5%. So this multiplied by 5% and the plan assets will return 5%. So this multiplied by 5%. Okay. Then the fair value of plan asset as of 31st March of year 2 was 2380 and the present value of the defined benefit obligation was 2720. Now what will we do is there is no settlement. So let me just delete this part. There is no past service cost. Let me just delete this part. So there are two ways to prepare the reconciliation. One, you can figure out what is the expected balance. 2486,250, which is nothing but 2125 plus 106,2550 plus 5,10,000 minus 2,55,000, 2486,250 and here it is 23,12,000 which is 20,40,000 plus 1,02,000 plus 4,25,000 minus 2,55,000, right, which is 23,12,000. So what is the net balance? The net liability is 1,74,250. Now what is the actual closing balance? Actual closing balance of plan asset is 2380 and this is 2720. So obligation is 2720 and asset is 2380, right, 2380. So what is the net liability now? 3,40,000. Now what is the loss or gain on remeasurement? Expected obligation is 24, actual obligation or actual closing balance is 2720. So there is a loss, whereas on asset side there is a gain. So what we can do is gain, whereas on the asset side 2380 minus 2312 there is a gain. So what we can do is gain or loss. Loss is represented by a negative number on remeasurement. The net amount comes to, see, this is the expected net liability balance, this is the actual closing balance. So the loss comes to 174,250 minus 34 which gives you 1,65,750. This is the net loss. This is the net loss on remeasurement. Now this is largely attributable to your actuarial. This is largely attributable to your actuarial and this is your remeasurement, right? And this is the net amount which will be impacting the P&L on account of remeasurement. Now what is the question apart from that? The question also asked us how much amount should be recognized in the statement of P&L, OCI and balance sheet. Okay, so a statement of P&L. In the statement of P&L, what will you recognize? You will recognize this item 4250, current service cost, contribution to plan asset. Is it a P&L item? It is not a P&L item, so it will not be impacted. So 4250 and this one current service cost 5,10,000. These two will be taken to P&L, right? P&L item are this and this. So these two put together we will take it to the statement of P&L which is 5,10,000 plus 4250. That will be recognized in P&L. Then OCI, what will be recognized in OCI? In OCI we will recognize this net amount of loss and gain on remeasurement. So OCI will be 165,750 Negative means this is the debit to OCI because it's a net loss. Then balance sheet. In balance sheet we will have net liability of how much? Net liability of 3,40,000, right. So these are the amount that will be recognized in the P&L, OCI and the balance sheet. Let me clarify a few things before we move further. In the examples that we discussed so far, we split the calculation between the obligation part, the asset part, and we also did the calculation based on net liability. In the examination, it is sufficient if you take up the net liability or the net asset and carry out the computation till the time you understand what is the impact of each of the items on the final balance. For example, let us say the opening balance is a net liability. Then we get something called the current service cost. Now, what will be the impact of current service cost on the net liability? It will increase the net liability. Similarly, past service cost will increase the net liability. Net interest cost will increase the net liability. So, like this you will have to understand which balance will increase the net liability and which balance will reduce the net liability. If you start with asset, you have to see which item will increase the net asset balance and which item will reduce the net asset balance. The net asset scenario will be very few, and I don't think that will be tested in the examination. What will be tested is the net liability. So what you need to understand is the impact of each item on the net liability. Say there is a contribution to the plan. Now if there is a contribution to the plan, then asset balance increases, meaning to say net liability is reduced. If there is a past service cost, net liability increases. If there are benefits paid, both asset is reduced as well as the liability is reduced, and hence there will be no impact on the net liability, right. So if you understand using this approach that what will be the impact of each item on the net liability or on the net asset, then scoring marks in these type of questions will not be difficult in the examination. Now if the question itself asks that show separately the defined benefit obligation part and the plan asset part, in that case you can choose to prepare them separately. Otherwise also there is no harm in presenting them separately, but just to save time you can do it on a net basis as well, right. So that is how you will be approaching questions in the examination. That is the first part. Second part is sometimes the question may give you discount rate and expected return on plan asset. Now as far as Ind AS 19 is concerned, we will only consider a singular discount rate. Expected return on plan asset will not be considered for calculating return on plan assets. Please keep that in mind. You will only use the discount rate. Though I have been telling you in the earlier problems that this is the return on plan asset, this is the discount rate. Both the rates are same. Both the rates to be considered are same. Now you may ask a question, sir, what if the actual return on plan asset is different or the expected return on plan asset is also different? In that case, whatever is the difference will be ultimately captured as the remeasurement gain or loss. So you need not worry about that. You will take a single discount rate. So you will take the single discount rate, apply that to the net liability to arrive at the net interest cost. Now having understood this, let us have a look at few definitions and then we will elaborate upon some concepts that we have already seen in the problem solved so far. Let's have a look at the definition of net interest on the net defined benefit liability or asset. So the standard says net interest on the net defined benefit liability or asset. So it can be interest on net defined benefit liability or interest on net defined benefit asset is the change during the period in the net defined benefit liability or asset that arises from passage of time. Now in examination, what you will do, you will take the opening net balance, to that you will apply the discount rate to arrive at the net interest cost or the net return. The next definition is on remeasurement. Remeasurement of the net defined benefit liability or asset comprises of. Now what is this remeasurement? Comparing the expected and actual, whatever is the difference, we consider them to be remeasurement. So remeasurement comprises of three things. One, actuarial gains and losses. So whatever is the actuarial gains or losses on the defined benefit obligation, that is considered as remeasurement. Then second, the return on plan assets excluding the amounts included in net interest on the net defined benefit liability asset. Now what does this mean? Take total return on plan assets or actual return on plan assets. From that, subtract the return which you have already considered while calculating the net interest. So basically, if actual return is 100 and out of that 100 you have already considered 80 when you are calculating the net interest amount, the balance 20 will be considered as remeasurement. And we have seen enough problems on this as to how do we calculate that remeasurement. That is the second component. And the third component is any change in the effect of the asset ceiling excluding amounts included in net interest on the net defined benefit liability and asset. So we understood the concept of asset ceiling, right? If there is a change in asset ceiling, then that will also be considered as remeasurement. But here also you will not consider that part of interest which you have considered while calculating the net defined benefit liability. In other words, to put it very simply, and in most of the cases, what you will be getting is actual gains and losses and the actual return minus the return already considered, right? Return already considered meaning discount rate multiplied by net assets. So whatever is that portion, that will be remeasurement of assets, and actual gains and losses will take care of your remeasurement of obligations. Now, in the problems that we have solved so far, we have seen that there are components of service cost which is recognized in P&L. What are the components of service cost? Your current service cost, your past service cost, and any loss or gain on settlement, right? These are the items of defined benefit cost which is recognized in P&L. So, defined benefit cost comprises of your service cost. Then second component is the net interest cost, the net interest cost which is also recognized in P&L, and loss or gain on remeasurement which is recognized in OCI. All these three put together is what we understand as defined benefit cost. So, defined benefit cost comprises of your service cost again comprises of your current service cost, past service cost, gain or loss on settlement. Then the defined benefit cost also comprises of the net interest cost and gains or losses on remeasurement. Gains and losses on remeasurement comprises of your actual gains and losses and return on plan assets which are not considered while calculating the net defined benefit liability or asset, right? Now, these three comprise of defined benefit cost. So, if in the examination they ask you calculate the defined benefit cost, you are expected to calculate all of these three items. The next component is net interest on net defined benefit liability or asset. And how do we compute that? We will take the opening net balance, that is opening net liability or net asset. To that we will apply the discount rate and arrive at the net interest. Now, what the standard also says is you have to take the opening balance, but if there is a remeasurement during the accounting period, then for the balance part of the period, you will consider the remeasured net liability or net asset and you will multiply that with the discount rate used to arrive at the revised net liability or net asset. So, if at all there is a remeasurement, then for the balance period you will use revised net liability or net asset and the new discount rate. Okay. Generally the institute would not try to complicate things by asking such kind of questions where there is a change in the rate and change in the liability, but if still a question is asked, you can consider the revised balance and revised discount rate for the balance period. Now, to summarize the overall approach in handling questions related to defined benefit plan, what we need to do is we need to first determine whether there is a deficit or surplus. Deficit or surplus meaning which is more, whether the obligation is more or the assets are more. If the obligation is more, then we say there is a deficit. If the assets are higher, then we say there is a surplus. Generally, you will get a question based on deficit. If it is a deficit, then you will consider it to be a net liability. If it is a surplus, you will consider it to be a net asset, right? Net asset is obviously subject to something called as the asset ceiling. Now, once you have arrived at the net liability and net asset, what is the next step? You will calculate the various costs like current service cost, past service cost, interest cost, then gain or loss on settlement. All of these things you would calculate and you will arrive at the expected closing balance of the net liability or net asset. Okay. Now, once you arrive at the net liability or net asset balance, then you will see what is the actual net liability or net asset closing balance. Basically, the difference between the DBO and the fair value of plan asset at the end of the period. Once you arrive at that, whatever is the difference will be loss or gain on remeasurement, which will comprise of three aspects: your actual gains and losses, the return on plan asset which are not included in the net interest, and the impact of asset ceiling which is not included in the net interest cost. These three components comprise your gain or loss on remeasurement, right? As far as the items are concerned, the current service cost, the past service cost, the interest cost, the gain or loss on settlement, all of these will go to the P&L. Remeasurement losses or gain will be taken to OCI, and in the balance sheet you will just show the net liability and net asset, which is nothing but the difference between the present value of DBO, or that is the defined benefit obligation, and the fair value of plan assets. Another important thing that you need to keep in mind is the net asset cannot be greater than asset ceiling. We have taken an example to understand that defined benefit obligation is 200 and fair value of plan asset is 250, but the asset ceiling is 40. In that case, though the net asset is 50, you will restrict the net asset to an amount of 40, which is the asset ceiling. Now, we have understood how do we calculate various items for DBO and plan assets. Let us quickly summarize the journal entries that would be passed for each of those items. Now, in the examination, if they ask you to pass journal entries, you can pass a single combined entries that we have understood in one of the problems. But still, for each of the items, let us see what will be the debit and what will be the credit. Now, when it comes to defined benefit obligation, the first and the most important item would be your current service cost, and sometimes there could also be a past service cost. Please note, under Ind AS 19, you cannot defer the past service cost. They have to be taken to P&L in the period in which they arise, right? Now, for both current service cost and past service cost, what would be the entry? See, both of these items would lead to rise in the defined benefit obligation. So, you will debit employee benefit cost and you will credit defined benefit obligation. The employee benefit cost will be taken to P&L. Now, please note, in some cases, the past service cost, it can be negative. If it is negative, or if instead of being a cost, it is actually a gain, then you will debit defined benefit obligation and credit the employee benefit cost. And the simple reason being, this past service cost and the current service cost, they impact your DBO, that is a defined benefit obligation. Then the next item is your interest. Now, interest is on two items, interest on defined benefit obligation and return on plan assets, right? For both of these, we'll use the single discount rate. We will not use the expected return for the calculation purpose. So, for interest on defined benefit obligation, again you will debit the employee benefit cost, in bracket you can write interest, to defined benefit obligation, and for return on plan assets, you will debit the plan assets and credit employee benefit cost with the return amount, right? Now, instead of doing this, you can pass a net entry, that is, if it is a net interest cost, you will debit employee benefit cost and you will credit the net defined benefit liability. If it is otherwise, that is, if it is a net income, then you will reverse the entry. In that case, you will credit the employee benefit cost and you will debit the net defined benefit liability, right? Now, instead of liability, it can be asset also, but that is very rare circumstance. So, largely we will focus on liability aspect. Then, there could be a case where the employer is contributing some amount to the fund. Now, when the contribution happens, what would be the entry? From the employer's point of view, money is going out. So, you will credit bank and you will debit what? You will debit plan assets, because the contributions would increase the plan assets, right? So, that is the aspect related to contribution. Now, there could be a case where the fund has made benefit payments to the employees. Now, in that case, what should be the entry in the books of employer? Now, please note, when the fund is making the payment, it is the fund's bank account balance which would come down. As far as the employer is concerned, from employer's pocket, no cash is going out to the employee. So, as far as the employer is concerned, there will be no entry related to cash or bank. But there will be an entry related to reduction of both plan assets and the defined benefit obligation. And why is that so? Because employer had some plan assets with the fund. From that fund, the plan assets have moved out to the employee, because the fund would sell those plan assets and make benefit payments to the employee. So, overall, the plan assets would reduce. At the same time, a part of obligation is settled, so the obligation would also reduce. So, what would you do? You would say defined benefit obligation debit to plan assets. You will credit the plan assets, right? So, if you recollect, in the problems also, the impact of a benefit payment has zero effect on the net defined benefit liability, because both the plan assets as well as the liability are coming down by the same amount. That is another entry which may come up in the defined benefit plan. Then there could be a case where there is a gain or loss on settlement. That gain or loss on settlement, depending on whether it is a gain or a loss, you will pass the entry. Say if it is a loss on settlement, you will debit the employee benefit cost and you will credit the net defined benefit liability or the asset, as the case may be. If it is a gain, you will just reverse this particular entry. Then there could be actuarial gains or losses, or there could be gain or loss on remeasurement. For both of these, how would you pass the entry? If it is an actuarial gain, meaning to say the liability has come down, then what would you do? You would debit the obligation, defined benefit obligation debit, to OCI, other comprehensive income. This item will not go to P&L. Similarly, for losses or gain on remeasurement, what would you do? Let's say there is a loss on remeasurement. Then in that case, you will debit the loss. So, debit the loss meaning debit OCI and credit the plan assets. If it is a case of a gain, you will just reverse the entry, right? Now, this covers the entries that you would be required to pass in case of defined benefit plans. In the examination, as I told you, you can pass a net entry. You need not pass individual entries. As we did a combined entry in one of the illustrations, you can do that. Let us now understand various types of the defined contribution or defined benefit plan. Now, these are categorized into four broad categories. The first one is a state plan. The second one is a multi-employer plan. Then we have a group administration plan, and lastly we have insured benefits. Now let us take each one of these. The first one being state plan. Now state here means a government or a government organization or a government body. Now as the name itself suggests, when we say it's a state plan, it is nothing but a plan which is run, which is managed, which is administered by the government. It could be a state government, it could be the central government, it could be an autonomous organization or entity which is created by the government. Any of those things would fit under this particular plan, that is the state plan. Now what could be the example of a state plan? Your employee provident fund organization, that is the statutory provident fund, right? That fits into the category of a state plan. Similarly, the NPS, that also fits into your state plan. Now what happens in case of a state plan? There is an employer, there is an employee, and there is a state plan. Let us say the EPFO, that is the Provident Fund Organization. Now employer would contribute an amount to the EPFO, and when the employee retires or resigns or leaves the employment or meets certain conditions, then the fund would settle the amount to the employees, right? This is one way in which a state plan could be structured. Generally speaking, in most of the cases, state plans are defined contribution plan, meaning to say once the employer makes a contribution to the PF authorities, then it is the PF authorities who have to settle the amount to the employees. The employer will have no role to play in it, okay. Generally, it is a defined contribution plan because the contribution is defined, but in some cases, employer may assume additional liability, stating that, say the return that you get from the fund is less than 8%, then we will pay the balance amount to the employee. If that kind of conditions are kept, then it would also be a defined benefit plan, right? But largely, it would be a defined contribution plan. Now, let me ask you one question. Say there is an employer and there is an employee, okay? The employer has created a trust which is an independent entity, and what the employer has told the employees is, the benefit that you will get out of this particular benefit plan or the contribution plan will be similar to a state plan. Meaning to say, if the provident fund is paying 9% interest, then we will also pay 9% interest. If the provident fund requires 12% contribution, we will also contribute 12%. In such a case, is this trust a state plan or not a state plan? That is what we need to understand. See, when it is a state plan, it has to be administered by one of the governments or the local authorities or government bodies. Now here, though the plan is similar to the one which is provided by the state, but administration is not done by the state. So such plans are not called as state plans, right? Those plans will not be called as state plans. So what are state plans? State plans are nothing but the plans which are run, which are administered, which are managed by government or government authorities or government entities, and mostly they would be a defined contribution plan, but in some cases they could also be defined benefit plan. Now how will the entity account for it? The entity will account for it depending upon whether it is a defined contribution plan or a defined benefit plan. Let's now have a look at the other kind of plan, which is a multi-employer plan. Now by looking at the name itself, you would have understood that when we say multi-employer plan, it involves more than one employer. So say for example, we have 3 employers, we have the Tatas, we have the Birlas, we have the Ambanis, and let us say each of them were having their own in-house trust which would manage the employee benefit plans. And because there are 3 different trusts, each of them would be paying the expenses, administration would be, there would be administration costs, a lot of costs are involved. Once when these 3 met at one of the conferences, what they thought was, instead of having a single plan for each of us, if we combine the plans together and have a single plan for all 3 of us, then we'll save a lot of cost on administration. It'll be easy to manage funds, and as the fund becomes larger, we'll get efficiencies of scale and all of those things. So when these 3 decided that we'll have a combined plan, we'll have a single plan which will take care of all of our employees, then such kind of plan is a multi-employer plan. Now you may get it out, sir, what if they, instead of creating a single plan, they thought that they will contribute to a state plan? Please note, a state plan is not a multi-employer plan. A state plan is not a multi-employer plan. If it is a state plan, you have to classify it as a state plan, because even in case of a state plan, more than one employer would do the contribution. Now when it comes to multi-employer plan, you will have defined set of employers who will be making contribution to the plan and which will be making benefit payments to the employees. Now, when the benefit payments are made to the employees, it will not be identified that, okay, this person is from Tata, so he will get more benefit. This person is from Reliance, then he will get less benefit. That identification for benefit payment would not be done. Okay. Obviously, the number of years of service, the last run salary, all of those things would be based on each of the employers, but the benefit payment is defined for all the employees as a whole. For example, 15 days of salary. It should not be like, if it is a Tata employee, he'll get more benefit. If it is a Reliance employee, he'll get less employee. Such kind of distinction are not made. So basically, you will not identify the benefits payment based on the employer. So that identification would be lost. So generally, when more than one employer, they create a single plan, and that single plan would take care of benefit payments to the employees. That is called a multi-employer plan. Now, will it be a defined benefit plan or a defined contribution plan? It would be a defined contribution plan or a defined benefit plan depending on what is defined. If the contribution is defined, then a defined contribution plan. If the benefit is defined and the employer bears the actuarial risk, then it is a defined benefit plan. So let's have a look at the definition of a multi-employer plan. Multi-employer plans are plans other than state plans. It can be either defined contribution or defined benefit, but they are plans other than state plans that pool the assets contributed by various entities that are not under common control. So first thing that you need to understand is these companies should not be under common control. For example, it should not be like Tata Motors, Tata Steel, Tata Consultancy. When these three companies, they pool the resources together, then it is not a multi-employer plan. Why? Because these entities are under common control of the Tata. So when we are talking about multi-employer plan, the employers should not be under common control. That's why I gave an example of Tata, Birla and Reliance, maybe one of those companies, okay, or maybe the ultimate group company. They come together and then they create a multi-employer plan. So the first thing is they pool the assets contributed by various entities, that is the employer, and they are not under common control. And the second condition is they use those assets to provide benefits to employees of more than one entity. So obviously when you have more than one employer contributing, the benefits also would be paid to the employees of more than one entity on the basis that contribution and benefits level are determined without regard to the identity of the entity that employs the employee. So the benefit, as I told you, is not based on whose employee are you. The benefit would be based on what are the number of years of service and how much is the last run salary and all of the conditions of those plans without having any partiality as to which employer is employing you, right? This is what is called a multi-employer plan. Let's now understand how do we account for multi-employer plans. Now, in case of a multi-employer plan, first you have to decide whether it is a defined benefit plan or a defined contribution plan. Now, in case of a defined benefit plan, we know that the actuarial risk of any shortfall is borne by the entity. So, if the entity decides that this is a defined benefit plan, though they are making contributions, the ultimate actuarial risk of the funds not being sufficient to pay up the employees, then the entity bears the liability. That is a defined benefit plan. Now, in case of a defined benefit plan, how will we do the accounting? The entity will recognize a proportionate share in the plan assets, in the defined benefit obligation and the cost associated with the plan. So basically, let us say the defined benefit obligation is 100. The entity's share in those obligation is 25%. So 25% of that will be recognized as an obligation, as a defined benefit obligation by the entity. Similarly, from plan assets, 25% would be recognized. From the service cost or from the cost associated with the plan, 25% would be recognized in the P&L, right? Now that would depend on the terms and conditions, the way the plan is structured and related aspects, but proportionate share in all the three items, that is the liability, which is the obligation, the asset, which are the plan assets, and the cost are recognized by the entity. Now, we also need to provide disclosures for that, which we will be understanding slightly later. Now, coming to the other category, which is the defined contribution plan. Now, as far as defined contribution plan is concerned, then it's a very simple and straightforward accounting. Like we do the accounting for other defined contribution plan, we will be doing the accounting for these as well. So, whatever is the contribution which is made to the multi-employer plan, that will be recognized as an expense in the books of the entity, right? So, contribution plan is simpler. For benefit plan, we will have to take the proportionate share and accordingly do the accounting. Now, one more thing that you need to understand is because it is a multi-employer plan, there may be a possibility that shortfall arising out of one entity has to be borne by other entities. Maybe when they decided, they thought that a specific amount of contribution from each of the entities would be sufficient. But due to some reason, let us say the employees did not resign as expected from one of the organization, then In that case, the excess obligation would fall upon other employers because the ultimate benefit payment is done regardless of the entity who is employing those employees, right? So, there may be a possibility that the shortfall in the plan arising out of one entity or because of one entity may have to be borne by other entities. So, even in that case, you will classify that as defined benefit plan. Now, sometimes what can happen is sufficient information regarding the obligation or the assets or the cost may not be available to the entity, or there may be a case that the entity is exposed to actuarial risk of other employers. So, say for example, there are 3 employers, Ambani, Tata and Birla, and the actuarial risk of employees of Birla has to be borne by other 2 entities, right? Now, in such a case, the information may not be sufficiently reliable to account for it as a defined benefit plan. Now, in that case, what the standard says is you account for it as if it is a defined contribution plan, because if the cost of extracting information is too high, it does not make sense to spend so much of time and efforts and cost to account for it as a defined benefit plan. In that case, as a practical expedient, you can account for it as a defined contribution plan. Let's have a look at an example. Paras Private Limited does not have sufficient information about a defined benefit plan and thus accounts for the plan as if it were a defined contribution plan. So, though it is a defined benefit plan, the company does not have information and hence it is recognized or it is accounted for as if it is a defined contribution plan. In the plan, there is a contractual agreement between Paras Private Limited and its participants to share the deficit amongst all. So, if at all there is any deficit, now the deficit may arise from any of those employers or the entities, but the deficit will be shared by all. The funding valuation shows a deficit of 500 million in the plan. The plan has agreed under contract a schedule of contribution with the participating employers in the plan that will eliminate the deficit over the 10-year period. So, there is a deficit of 500 million and how will this deficit be made good? This deficit will be made good by contribution over a 10-year period. The entity's total contribution under the contract are 30 million. So, out of the 500 million of deficit that has been estimated, the entity will have to contribute 30 million. Say for example, 3 million each year for the next 10 years. Then, how should the entity account for this particular deficit? See, there is a liability. There is a liability. Liability of what? 3 million per year over the next 10 years. So, the entity will have to discount this to the present value, and whatever is the present value, to that extent there will be a liability and corresponding cost will be recognized in the P&L. Let's now look at the other category, which is the group administration plan. Now, group administration plan is slightly different from the multi-employer plan. If you remember, in the multi-employer plan we understood that the identification of employee is lost. You don't identify a specific employee with the entity, right? That is what is under a multi-employer plan. Whereas under the group administration plan, again here there are participating employees, there are single employer plans of multiple entities, they are combined together and that combination is only for administration purpose. Identification of employee is retained. That is to say, let us say Birla, Tata and Ambani's, they come together and they say that we will pool the resources together, but the benefit payout will be dependent on who is the employer. For example, Reliance employees will get a higher benefit, okay. So, that identification of employee is retained, whereas under a multi-employer plan, that identification is not retained. So, then what is the benefit of group administration plan? It is more for only administration purpose. Instead of having 3 different funds to manage the assets, they can consolidate all the funds and manage it together, right? Investments become easier, redemption becomes easier, administrative expenses are reduced. So, that is the advantage. But the identification of each employee is kept separately. The employee and the entity are identified and benefits are paid depending on who is the employer and what kind of benefit does the employer provide. That is what is a group administration plan. Now, again here, how do we do the accounting? You have to see whether it is a defined contribution plan or a defined benefit plan, and accordingly you will do the accounting. And here, the identification of net assets is easy, the identification of the obligation is easy, the share of cost identification, even that is easy. So, there is no significant challenge in handling a group administration plan. Now, we have understood about state plans, multi-employer plans and group administration plan. Now, as far as multi-employer plans are concerned, we understood that entities should not be under common control, right? But if entities are under common control and then there is a single plan, how should we do the accounting for? For example, let us say we have Tata Sons. Tata Sons has created a employee benefit plan and all the Tata Group entities are participating in that particular plan itself. Now, is it a multi-employer plan? It is not a multi-employer plan. Now, why is this distinction necessary? If it is a multi-employer plan, each entity will recognize their share of obligation, share of assets, etc. Whereas, if it is not a multi-employer plan, that is not how the accounting would be done. Okay. When it comes to plan with entities which are under common control, again, if it is a defined contribution plan, it's a simple accounting, just debit the expense and credit the contribution payable. But if it is a defined benefit plan, what the standard says is, if the plan charges the defined benefit cost to each of the entities, that cost should be recognized in the P&L in the individual financial statements. Whereas, if the plan does not charge the net defined benefit cost to the entities, then the entity who is sponsoring the plan will recognize the net defined benefit cost. And what will the respective entities do? Respective entities will recognize cost which is equal to the contribution payable. So, for example, let us say there is a plan and the net defined benefit cost is 1000 crores. And as a policy, the entity charges 25% to Tata Motors, which is 250 crores. So, how much will Tata Motors recognize as an expense? 250 crores. But let us say there is no allocation of net defined benefit cost. What the plan says is, Tata Motors, you have to pay contribution of 200 crores. Is that the net defined benefit cost pertaining to Tata Motors? That is not defined. Only the contribution is asked. Now, in that case, what will happen is, the sponsoring entity will recognize entire 1000 crores of defined benefit cost, and 200 crores of contribution payable by Tata Motors will be recognized as a cost in the books of Tata Motors, right? So, that is how the accounting would be done. Now, you might get a doubt that, is it not double accounting? Tata Sons is also accounting for 1000 crores. The respective entity is accounting for 200 crores. Is it not double accounting? What would happen is, when this contribution is made to the fund, the plan assets would increase. And when the plan assets have increased and when remeasurement happens for plan assets at fair value, there would be a remeasurement gain. To that extent, your benefit cost would automatically come down, right? So, year on year basis, though it appears that there may be a double accounting, it is not actually a double accounting, right? So, the accounting treatment is, if cost is shared, then accordingly expense are booked. If cost is not shared, the sponsoring entity will book the cost and respective entities will book the contribution payable as the cost in the individual or separate financial statements. Let's now have a look at the last category, which is insured benefits. Now, what is the meaning of insured benefits? Say there is an employer, there are employees to which the benefits have to be paid, and then there is an insurance company. Okay. Now, there can be an arrangement that the employer regularly makes some premium payment, say for example to LIC, and LIC will make the benefit payment to the employees. So, say there is a gratuity plan which the employer has taken. Based on the calculation, actuarial assumptions and all of that, LIC will say every year you have to pay so much of premium. And when the employee resigns or retires or or terminates, we will pay gratuity to the employee. We will pay gratuity to the employee. Now here, how do we account for these kind of arrangements? So the question that you need to ask is, who bears the actuarial risk? That is, whether it is a defined contribution plan or a benefit plan. If it is a case like the employer makes premium payments to the insurance company and then there is no further liability on the employer side, whether it is a shortfall, whether it is an excess, all of those risks are taken care by the insurance company. Then in that case, it is a defined contribution plan, and accounting for defined contribution plan is pretty straightforward. If it is not a defined contribution plan but it is a defined benefit plan. Now, when would it be a defined benefit plan? The insurance company may say that to this extent we will do the settlement, but if there is any shortfall, you will have to make the balance payment to the employees, or we will not make the payment to the employees. Insurance company says, we will not make the payment to the employees. We will make a payment to you, you settle the amount to the employees, right? Now, in such cases, it is a defined benefit plan. The premiums which are being paid to the insurance company is as good as creating a plan asset. The insurance policy becomes a plan asset. If you remember, we spoke about qualifying insurance policies. Whatever amount employer contributes to this insurance company as premium and creates a qualifying insurance policy, that would be accounted for as a defined benefit plan, right? Now, when you are accounting for a defined benefit plan, you will recognize the service cost, you will recognize the obligation, and these insurance policies become your plan assets, right? So, ultimately the question that you need to ask is the employer bearing actuarial risk? If yes, then it is a defined benefit plan. If no, then it is a defined contribution plan. If it is a defined benefit plan, the insurance policy becomes a plan asset, and correspondingly obligations and other things would be recognized by the employer, and the entire plan would be accounted for as a defined benefit plan, right? So, examples where the plan becomes a defined benefit plan, first is the shortfall is made good by the employer, then it's a defined benefit plan. Or insurance company does not settle the benefit. Insurance company makes a payment to the employer and employer settles the amount to the employees. Even in that case, it becomes a defined benefit plan. So to quickly summarize the various types of plans and the accounting treatment, we understood various types of plans: state plan, multi-employer plan, group administration plan, and insured benefits. State plan, generally a defined contribution plan, but in some cases it could be a defined benefit plan. When it comes to multi-employer plan, it could be a defined contribution or a defined benefit plan, but if sufficient information is not available, you will categorize that as a defined contribution plan. Group administration plan, again, it can be defined benefit or defined contribution based on whether actual risks are retained by the entity or are not retained by the entity. And lastly, insured benefits, or when the contributions are being made to insurance companies, even there you have to see if the actual risk is shifted to the insurance company, then it is a defined benefit plan. If actual risk is not shifted to the entity, then it is a defined contribution plan. Once you have identified, accounting becomes much easier, right? Now, amongst all of these plans, in case of multi-employer plans, the accounting treatment was slightly tricky, where you have to take proportionate share of obligation, plan assets and the net defined benefit cost. That was one aspect which was slightly different from other defined benefit plans, right? So, entity will have to understand what is the share in assets, obligation and defined benefit cost and accordingly do the accounting for it. If information is not available, then you will categorize that as a defined contribution plan. Now friends, so far we have understood defined contribution plan, defined benefit plan, and how do we calculate various items under those and how do we do the accounting for it. The next important aspect in this standard is presentation and disclosure requirements related to these plans. And let me tell you one thing, the presentation and disclosure requirements is extensive. A lot of disclosure requirements are there as far as Ind AS 19 is concerned, right? Almost for every item of concept that we have learned, that item would be disclosed as a part of the financial statements. It's an extensive list. Because it's a lengthy disclosure, I don't expect you to learn by heart. What you can do is, go through it a couple of times and you can understand, the items, or you can logically build what are the items which are to be disclosed. In case if a question comes up in the examination, you can use your, logic, you can use your concepts and give the disclosure requirements. Now, as we have done in other standards, here also we'll take up an annual report and see the amount of disclosures as required by Ind AS 19. It's actually very long and you will feel that, would it be even possible to remember? So, I am not expecting you to remember, and I don't think even an examiner would expect you to remember everything, but yes, important aspects what are to be disclosed, that is what you need to understand, right? Now, again, I am taking up the financial statements of Tata Motors statement of P&L. Now, here you can see this item, employee benefit expense. Employee benefit expense. Now, employee benefit expense, there is some amount 4,212 crores, okay, and note number 34 that is given. Now, please note, this is the face of the statement of P&L. That means, it's a very important item to be disclosed in the financial statements. So, Ind AS 19 is very, very important, and if you see, apart from operations, your materials, purchases and changes in inventories which are to do with the materials, you have another item which is employee benefit expense. Now, what is to be disclosed here? One is, if you go to note number, so here they have mentioned note number 34, that note gives the breakup of this employee benefit expense. Let us have a look at that. So, here you can see note number 34, employee benefit expense, salary, wages and bonus. These are your normal, short-term benefits. Contribution to provident fund and other funds. So, some contribution which has been made to employee provident fund and other funds, and staff welfare expenses. This has been put together, and here you see the breakup. But this does not give a breakup of what is the current service cost, pension benefits, defined benefit, defined contribution. All of that has been given in a separate note. So, we will have to go to that note to understand the detailed disclosure requirements as required by Ind AS 19. Okay, so let us go to that. So, friends, we have seen employee benefit expense on the face of the P&L, and we have seen that small breakup. Let us also have a look at what is the descriptive policy as far as employee benefit expense is concerned. Let me tell you, once you understand this, once you go through this, you will have a good recalling ability in your examination to understand the questions, right? So, employee benefits, there is an item of gratuity. We have taken enough examples on gratuity. So, Tata Motors Limited and its joint operations have an obligation towards gratuity, a defined benefit retirement plan covering eligible employees. The plan provides for a lump sum payment to vested employees at retirement, death while in employment or in termination of employment of an amount equivalent to 15 to 30 days salary payable for each completed year of service, right? So, what is this? When is it paid? It is paid to vested employees. Vested employees means what? Vested employees means those employees who are entitled to this benefit without any future service condition. So, it says the vesting occurs upon completion of 5 years of service. So, before 5 years the benefit is not vested, or we call it unvested. After 5 years is what we call the benefit is vested. When the benefit is vested, after that the employee does not have any obligation to complete future service. So, after 5 years, even if the employee resigns on the next day, gratuity will be payable. Tata Motors makes annual contribution to gratuity funds established as trusts. Tata Motors account for liability for gratuity payable in the future based on actual valuation. Simple thing. Then superannuation. Tata Motors have two superannuation plans, a defined benefit plan and a defined contribution plan. Now, just to give you a brief perspective, you will be able to relate this when you learn income tax as well. Superannuation plan is basically a pension plan. Okay, so they have two plans. One is a defined benefit plan, one is a defined contribution plan. Defined contribution plan could be something like the NPS. You get the deduction under 80CCD, right? Where the employer contributes a defined amount to that particular NPS scheme, and then NPS scheme would finally pay the pension or commuted pension, whatever it is, to the employee. That is a contribution plan. So, there can be a pension plan or a pension scheme or a superannuation scheme which is a defined contribution plan. The other one is the normal pension scheme where the actual risk is borne by the employer himself, right? So, both the plans are there and employee can choose either of the two plans. An eligible employee on April 1st, 1996, that is the age, could elect to be a member of either plan. So, maybe after some point of time, they would have made it mandatory only to choose one specific plan. Employees who are members of defined benefit superannuation plan are entitled to benefits depending on years of service and salary drawn. Monthly pension benefits after retirement age ranges from 0.75 to 2% of basic salary. So, I will not get into much of that. With effect from April 1, 2003, this plan was amended and benefits earned by covered employees have been protected as at 31st March of year 3. So, what does that mean? On 1st April of 2003, the plan was amended and whatever was the benefit accumulated till that date, it has been crystallized. So, that part of the benefit which has accumulated till 31st March of year 3 will not fall below that level. That is what is the meaning of protected. Employees covered this plan are prospectively entitled to benefit computed on the basis that ensures that annual cost of providing the pension benefits would not exceed 15% of salary. So, some kind of protection. During the year 31st March of 15, the employees covered by this plan were given a one-time option to exit from the plan prospectively. Means whatever has been accumulated, it is accumulated and will be governed by that plan. Then they can exit from that plan, and the employees who opted for exit were given one-time option to withdraw accumulated balance from the superannuation plan. So, some description that okay, if whatever is accumulated you withdraw and maybe you can join the other plan. The company maintains a separate irrevocable trust for employees covered and entitled to benefits. Company contributes 15% or 1,50,000, whichever is lower, of the eligible employee salary to the trust every year. The company recognizes such contribution as an expense when incurred and has no further obligation beyond this contribution. So, there is another plan where you have a contribution plan. A description of that is given. Okay. The reason why I read it out to you is, in the disclosure, there is a requirement to provide description of the plans which are provided to the employees. Okay. Then you have Bhavishya Kalyan Yojana, some other plan. Then you have Provident Fund and family pension. Right. Then under the Provident Fund, if you see, there was this thing called a defined benefit Provident Fund. So, here they mention that they make monthly contribution at a specified percentage of the salary, currently 12% of the salary. The contribution are specified under the law, and then the interest rate payable to the members of the trust shall not be lower than the statutory rate of interest declared by the central government under the EPF Act. And so, what is happening here? Interest rate will not be less than what is paid by the statutory provident fund, and the shortfall, if any, shall be made good by the company. So, that is what you need to understand here. Provident fund, that contribution of 12% is defined, but the interest portion, the actual risk, the actuarial risk on the interest portion is borne by Tata Motors. So, what Tata Motors will do, if at all there is a shortfall in interest payout, then Tata Motors will pay from its own pocket. That is why it is a defined benefit provident fund. Okay. The liability in respect of the shortfall of interest earnings of the fund is determined on the basis of actuarial valuation. So, here there are two components. One, a defined contribution, you account for it as a defined contribution plan. Then, as far as the interest is concerned, take actuarial assumptions, and if at all there is a shortfall, you provide for that as an expense and a liability. Then you have post-retirement Medicare scheme. Okay, then you have compensated absences. So, whatever we have discussed there. Then they have explained about what is the remeasurement gains and losses. Then they have said what is the measurement date of the plans, that has also been given. Then Then under the measurement date, they have said, what is the present value of DBO and the current service cost, past service cost, which method? Projected unit credit method. Okay. Then key assumptions and sensitivities for post-employment benefits obligations are disclosed in note number 47, which we will be reading now, right. So the idea behind the idea behind showing this particular table and disclosures to you is you can relate it to the discussion that we had so far, right. So one thing that you need to keep in mind is it is lengthy, the disclosures are lengthy, but if you have understood the concepts and if you are able to relate the concepts, then it will not be difficult. So here you can see note number 47, employee benefits, and then you can see the first one, defined benefit plan. Okay, just to give you a perspective, see how many pages of disclosure, 1, 2, 3, 4, 5 pages of disclosure. That is what is given. Items are repetitive, so need not worry about that. I'll just take you through what are being disclosed, and once you relate it back to whatever you have learned in the class, it will not be very difficult for you to understand, right. So now here you can see the first disclosure, which talks about defined benefit plans, pension and post-retirement medical plans. So we have not yet come to post-retirement medical plans, which is other long-term benefits. We will come to it later. The following table sets out the funded and unfunded status and the amounts recognized in the financial statement for pension and the post-retirement medical plans in respect of Tata Motors and joint operation. Now what is being given? Now what is the first item being disclosed? Change in defined benefit obligations. What is that? If you remember, when we did problems, we took opening balance of defined benefit obligation and what are those items which are causing changes to the defined benefit obligation. If you remember, the same thing is been given as notes to account. That is why it is important for us to understand the structure in which we should approach a particular standard. Now if you remember that problems that we have solved in the class, understanding this will not be a challenge at all, right. So what is given here? Change in defined benefit obligation, basically a reconciliation between opening benefit obligation and closing benefit obligation, right. What are the items? Defined benefit obligation beginning of the year, the first thing that you start with your opening balance. Then you have current service cost. If you remember, we said current service cost will increase the obligation. So you see there is a positive item, okay. Then interest cost will also increase the obligation. Then remeasurement gains and losses. So what is the first item? Actuarial losses arising from changes in demographic assumptions. Now here, if it is a loss, it will increase my obligation. Now here, because they have given in negative number, where they mention this negative number refers to a gain which will reduce my obligation. So here you have to understand it as actuarial gains or losses. Then actuarial losses arising from changes in financial assumption. If you remember, we understood what are demographic assumptions and what are financial assumptions. So because of those assumption changes, here we have a gain in this year and in the previous year there is a loss, right. Then actuarial gains and losses. So here they have done a slight drafting error. You should not be doing that. Anyways, actuarial gains and losses arising from changes in experience adjustment. What is this experience adjustment? If you remember, experience adjustment means earlier you had made certain assumptions and when those events actually happened, the actual outcome is different, right. That is what is called experience adjustment. So here the gains and losses are because of changes in demographic assumptions like age of service, retirement date, average mortality, medical related expenses and all of that. Then changes in financial assumptions, salary increment, maybe inflation, maybe interest cost. Then changes in experience adjustments means what? Maybe earlier we assumed that employee would work for so many number of years, but actual experience is different. Because of that, there is an actual gains or losses that also needs to be adjusted. So any item of gain will reduce the obligation. Then transfer in or out of liability. Now what does this mean? Sir, we have not discussed about this. So what this means is, the company will have employees moving in, employees moving out. Okay. Now as you start working, you will realize that the balances of funds would be transferred, like provident fund balance can be transferred. Similarly, if there is pension plan, that can be transferred. So such things are possible, right? So this transfer in and out of liability is basically adjustment to the liability because of maybe new employees joining in or employees leaving out, and you are actually transferring that fund balance or transferring the benefit balance to some other trust or some other fund. Okay, maybe within the group, maybe outside the group, depending on the facts and circumstances of the case, right? So that is what is meaning of transfer in and out of liability. Here we are not making benefit payment. So it's like when I was working with, just to give an example, when I was working with BPCL had its own provident fund trust. Okay, whatever amount was being contributed as provident fund was managed by the trust. After some years, I joined Trafigura. Now Trafigura did not have any trust. So Trafigura used to contribute to statutory provident fund. Now what happens to my balance lying in this particular BPCL trust? This balance will be transferred to the trust, that is the statutory provident fund. So that is what is called transfer in or transfer out. So in this case for BPCL it was a transfer out, right? So to that extent your plan assets would have gone out and your liability also would have gone out, right? I gave you a provident fund example just for your understanding. Similar thing can happen in case of maybe some superannuation scheme, if at all the terms of employment provide and if at all the other company agree or the other trust agree that okay, this balance can be transferred, right? So that is just for your understanding that what is the meaning of this transfer in and out of liability. Then benefits paid from plan assets. Benefits paid from plan assets meaning what? Meaning to say what? From plan assets 111.65 crores has been paid, and benefits directly paid by the employer, maybe because there is a shortfall, the employer has directly paid, which is 6.51 crores. So opening balance, all of these movements and the closing balance, right? So this is what is to be disclosed. This is one item of disclosure where you will provide a reconciliation, right? Then moving on, plan assets. Now what is plan assets? Again, opening balance, we have already understood. Interest income will increase my plan assets. Then remeasurement losses. Now what are those remeasurement losses? If you remember, we had remeasurement losses both in liabilities as well as assets. Now what is this? Return on plan assets excluding amount included in net interest expense. Now what is the net interest expense here? Net interest expense is 76 minus 69. If an income is not included in this, basically if income is not included here, then that part is considered here. Okay, so this is what is your remeasurement gain or losses, right? So here this positive number means it is a gain. Okay, then employer's contribution. Employer has contributed 103.09 to the plan assets, and transfer in and out of liability. So because a liability has been transferred, corresponding impact on assets is 6.54. and benefits paid 111.65. So 111.65 here, and you can see 111.65 here as well, right? So with this you get the fair value of plan assets at the end of the year. Very simple reconciliation statement. Then moving on, this says what is the amount recognized in the balance sheet. So basically you have an obligation of 1189.05 and you have fair value of plan assets of 1100. The net balance is disclosed in the financial statements, and also you have to adjust for the item of asset ceiling. So here they have adjusted the item of asset ceiling and the balance 85.92 has been disclosed in the financial statements. Then this 85.92 has to be split between current and non-current. It has to be split between current and non-current. How do we do that? That is not given by Ind AS 19, you have to refer to Ind AS 1. So I will give you a separate example and try to explain it to you. How do we split between current, non-current, both assets and liability? Now if you note, you can see here that net liability is a number 85.92, but liability is recognized at a higher value, and there is a asset also being recognized. This could be possible where you have more than one plan. This could be possible where you have more than one plan. Otherwise, if there is a single plan, it will be a single item of liability, right? There could be possibility that there are more than one plans. That is why it is split between asset and liability. Otherwise, you will have just this single item. Then total amount recognized in other comprehensive income consists of remeasurement gains and losses 105.63. So that is what we have computed at remeasurement gains and losses. It is recognized in what? Other comprehensive income. Then you can see here information for funded plans with a DBO in excess of plan assets. Now what is this funded plan? Funded plan is where an employer is setting aside some amount or contributing some amount to a particular fund to meet the benefit payments. That is what is called a funded plan. Unfunded plan is where the employer does not make any contributions to fund. So for example, if we have an employer and if we have an employee and there is a fund which is created, employer contributes amount to the fund, that is what is called a funded plan. So when there is a funded plan, you have plan assets coming into picture. The information is information for funded plans with DBO in excess of plan assets. DBO in excess of plan assets means what? The obligation is greater than fair value of plan assets. So here they have given that disclosure. And information for funded plan with DBO less than plan assets means plan assets are more than the defined benefit obligation. For that they have given a disclosure. And lastly, you have information for unfunded plans. So when there is unfunded plan, for those plans there is no fund created, so you only have the DBO, which is 132.73. Now, so here we have DBO 132.73, only DBO, only liability, correct? So then moving on, we have net pension and post-retirement medical cost, and the details have been given. So service cost, item of service cost, and we have understood what are the components of service cost, and net interest cost 7.46. Now this 7.46 can, if you just go back here, you would see that interest cost is 76.65 minus 69. So that is what is roughly about 7, whatever is the number, that comes to 7.46. Okay. Then here we have changes in plan assets and benefit obligation recognized in OCI. So basically the remeasurement part, it has been reconciled and given here. So what are the remeasurement items? Return on plan assets which have not been included in the net interest expense, then your actual gains and losses, then asset ceiling. The impact of asset ceiling is also recognized in OCI, right? Please keep that in mind. And actual gains and losses from experience adjustments. All of this put together, what is recognized in the statement of other comprehensive income, that is what is given. Then certain assumptions like what is the discount rate, 6.1% to 6.9%, rate of increase in compensation level of covered employees. So annual increment was expected in the previous year to be 5% to 10%, now it is 5.75% to 10%. So this is a kind of experience adjustment, and also obviously the future assumptions. Then the company's pension plan assets, they have given under different categories: cash and cash equivalents, debt instruments quoted, unquoted, equity instruments quoted, and deposits with insurance company, and they have given percentage of each of these. Now generally these percentages are governed by statutory guidelines, and also the trust, if at all they have created any trust, based on that they have to check that okay, this should be the percentage, 5% in cash, then debt 65%, equity instruments quoted is 5.9% and 22.9%. So that is what it has been given. And below that they have given the policy based on which they have chosen it, so we will just ignore that. Then they also have given on statement where they have mentioned that if there is a change in any of the assumption, then if there is a, let's say, change in assumption, discount rate if we increase by 1%, what will be the impact on defined benefit obligation and what will be the impact on service cost. Okay. Similarly, if salary increases by 1%, what will be the impact on DBO and what will be the impact on your service cost and interest cost, right? Similarly, if there is a change in the healthcare cost, what will happen, right? So that is what is being disclosed. Then we also have another plan which has been discussed, that is provident fund. Generally provident fund are defined contribution plan, but here again they have given defined benefit provident fund plan. So it is a defined benefit plan again here. So for that again similar disclosures, whatever you have seen so far, all those disclosures have been given. Also you can see the company expects to contribute 82.73 crores to the defined benefit provident plan in fiscal 22, meaning to say in the next 1 year how much is expected to be contributed here. Similarly, in the pension plan also they would have disclosed that the company expects to contribute some amount to the particular pension plan. And here you have one more item, company's contribution to defined contribution plan. Defined contribution plan is 78 crores, 78.79 and 77.89 crores respectively, right? So this is the kind of disclosure you are required to give. Now, if you have understood the problems that we have solved earlier, disclosures in the financial statements will not be a challenge, right? That is one thing you need to keep in mind. Another thing that you need to keep in mind here is that here you can see there is an item of non-current asset and non-current liabilities. They have not set off. So for setting off the assets with the liabilities, there are certain rules, there are certain principles that we need to follow. We'll understand that as well. Okay. If it is belonging to the same plan, then obviously we'll net off and show it as a net single item. But if the assets and liabilities belong to different plans, you cannot set off them just like that. Okay. There are some conditions which needs to be fulfilled. That is what we will be understanding. Now that we have run through the financials of a company to understand what are the various disclosures and presentation requirements, let us now run through what is given under the standard. Again, I repeat, don't get bogged down or don't get tensed by the quantum of disclosure which is prescribed by the standard. It is lengthy. It is definitely lengthy, but once you understand, it would become easy for you to retain it. And in the examination, generally what would be asked is the reconciliation item, reconciliation aspect what we have seen in the problems. Okay. So now coming to the presentation aspect, the first thing that we need to understand is when can we offset a liability and an asset. Now here liability means your DBO, which is defined benefit obligation, asset is the plan asset. When can we offset them? See, if it is a single plan or if it is one plan, then the assets and liabilities would be set off and you will anyways present it on a net basis. But if there are more than one plans, let us say an entity has two different plans, okay, one for, let us say, one is a pension plan and another one is a gratuity plan. Now the question is, can the entity set off the assets of, let us say, gratuity plan, liability of gratuity plan with the assets and liabilities of the pension plan. So basically, can we pull all of this together and say that okay, there is a net liability of so much or net asset of so much? To this, what the standard says is, it depends, offset depends on your right. Do you have the right? Is there a legally enforceable right? And is there an intention? If the answer to these both questions is yes, then you can offset it. Otherwise, you cannot offset it. So we saw in the case of Tata Motors, right? There was a net asset being shown and there was a net liability being shown. So you'll have to segregate that if these two conditions are not satisfied. So let us see what the standard says. An asset relating to one plan will be offset against a liability relating to another plan when and only when, or if and only if, the entity, number one, has a legally enforceable right to use a surplus in one plan to settle the obligation under the other plan. So there has to be a right. The entity must have a right. Say for example, in the gratuity plan there is a surplus. In the pension plan there is a deficit. Does the entity have a right to offset these two? Now the question here is, does the entity have a right to use the surplus in gratuity plan to make benefit payments for the pension plan? If the answer is yes, you can offset. If the answer is no, you cannot offset. That is the first thing. And the second condition is, there is an intention. There is an intention means the entity must have an intention either to settle the obligation on a net basis or to realize the surplus in one plan and settle its obligation under the other plan simultaneously. Meaning to say, the entity has an intention that they will anyways be settling those obligations on a net basis. The benefit payments would be settled on a net basis, or the entity will sell off or realize the plan assets from one plan and simultaneously use that assets or use those realization to settle the benefits under the other plan, right? Or the entity has an intention to realize assets from one plan, let us say sell off the assets under the gratuity plan and use that to make benefit payments under the pension plan simultaneously at the same time. If these two conditions are satisfied, then you can show those assets and liabilities on a net basis. So for example, here there is a surplus of 100 crores. Here there is a surplus of 100 crores, net assets of 100 crores. Here there is a net liability of 150 crores. Okay. If there is a right and if there is an intention, then you will net off both of these and show a net defined benefit liability of 50. Okay. Otherwise, you will show the assets of 100 separately and liability of 150 separately. The next aspect is current versus non-current. Now, when we come to current and non-current, Ind AS 19 does not specify whether an entity should distinguish current and non-current portion of assets and liabilities arising from post-employment benefits. So, you will have to look at the normal presentation requirements, and based on that you have to classify the assets between current, non-current and liabilities between current and non-current. It has to be on a plan by plan basis. Okay, it has to be on a plan by plan basis. You have to segregate how much is current and how much is non-current. I'll give you a small example, with few numbers so that you are able to understand how do we set it off that. It is not explained in the material as such, but for your understanding I'll take few numbers and I'll explain it to you. How should we classify the net defined benefit liability or asset as current or non-current? Let's take a very simple example to understand how do we classify the net asset or liability as current or non-current. So, I have taken three plans, plan A, plan B and plan C. The defined benefit obligation under each of the plan at the end of year 1 is 6,000, 6,000, 6,000, that is the liability part, and fair value of plan assets at the end of year 1 is 7,000, 4,500 and 3,500. Now, first we need to identify whether it is a net liability or net asset. How do we identify that? Now, in the first plan, plan A, what is the liability? 6,000. How much is the asset? Fair value of plan asset 7,000. What is more? Assets are more than liability, means there is a surplus. This surplus is the net asset. So, net asset is 7,000 minus 6,000, 1,000. Okay. Then here in the second case, the DBO is 6,000 minus the fair value of plan asset is 4,500, is a net liability of 1,500, and in the third case also there is a net liability of 2,500. Now, the question is, how do we segregate this between current and non-current portion? Now, come to the first part, 1,000 of net asset. Now, what is the benefit obligation at the end of year 1? It is 6,000, right? And how much is expected to be paid in next year? 4,000. Now, what will you do when you have to pay this 4,000? You will realize some of these assets from this 7,000 and pay this 4,000. To that extent, this 4,000 will be settled in the next period. So, this 4,000 technically is like your current liability because you have to pay this 4,000 in the next period. Now, do you have sufficient assets to cover this 4,000? Yes. From this 7,000, you will sell assets worth 4,000 and you will settle the liability. Okay. Now, how much of asset is left with us? 3,000 of asset is left with us. And what is the total balance of net asset? The total balance of net asset is only 1,000, which means this 1,000 will not be realized in the next period, because out of the 7,000, 4,000 is realized. Balance 3,000 will be realized in the next period, not in year 2. That will be for year 3. So whatever is left as asset after making benefit payment of this 4,000, those 3,000 worth of asset will not be utilized in year 2, but they will be utilized in year 3. So the balance 3,000 represents non-current portion, whereas on a net basis our non-current net asset is only 1,000. The reason being, we will have 2,000 of liability for year 3 also. Okay. So how you have to look at it is 3,000 of assets will be left here and 2,000 of liability will be left here. So net asset left after settling year 2 will be 1,000. This 1,000 is not expected to be utilized in year 2, and hence this is a non-current asset. This is a non-current asset. Entire 1,000 will be a non-current asset. Sir, will there be any current liability or current asset? No, because current liability of 4,000 will be settled using assets from this. So the current liability and current asset, they will knock off each other, you will net them off, and hence there will be no current liability, right. Now come to the next part here, plan B. What is the expected benefit payment in year 2? 4,000, and you have plan assets worth 4,500 and you have DBO at 6,000. What is the net liability? Net liability is 1,500. How much of liability is expected to be paid in next year? 4,000. For that, do we have sufficient assets cover? Yes, we have sufficient assets cover, because you can use 4,000 worth of asset and settle this benefit. Okay, you have 4,000 worth of asset and settle this benefit. Then what is left? We are left with the balance 2,000 of liability and 500 of asset. Will that be used in the next year? They will not be used in the next year, and hence entire 1,500 of DBO will be your non-current liability. So the way to understand for you is, how much of liability is expected to be settled in the next year? That is the current liability. Do we have sufficient assets to settle those liability? Now here 4,000 has to be settled. We have assets worth 4,500. So entire current liability has a backup of assets. So to that extent there will not be any current liability, because all this 4,000 will be settled using 4,000 from this. Then we will be left with 500 of assets and 2,000 of liability. All of that pertains to year 3 and not in year 2, and hence they are non-current. Now let us come to the third case. In the third case, we have benefit payment worth 4,000. How much of assets we have? 3,500. So even if you use all the assets fully, you still have a current liability of 500 left, which has to be settled in the next period. So out of this 2,500, 500 will be current. Why is it current? Because of this 4,000 of payment, I have only 3,500 with me. Balance 500, I don't have any assets. So to that extent it is a current liability, and balance 2,000, 2,500 minus 500, 2,000 is a non-current liability. Okay. So this is how we have to distinguish between current liability, non-current liability, and current and non-current assets. Please note, there will not be a case where you have current assets coming up from a net defined benefit asset. Okay. It will only be, if it is an asset, it will always be non-current asset, and if it is a liability, it will be current, non-current, depending on what is the surplus position. So this is how you will segregate it. I thought I'll just give an example so that you have an understanding of this. Let's now have a look at the description of disclosure requirements. Most of these things we have already read when we read the financial statements of Tata Motors, right? So to start with, how should the disclosures be? The disclosure should be such that it enables the users of financial statements to evaluate the nature of its defined benefit plans and the financial effects of changes in those plans during the period. So here we are talking about disclosures of defined benefit plan. This is the general guiding principle. Okay, this is the general guiding principle. The objective should be to meet this guiding principle, that is, the users of the financial statements should be able to evaluate the nature of the defined benefit plan and the financial effect of changes in those plans during the period. So basically, what is the nature of defined benefit plan? What are the risks involved in the defined benefit plan? What is the obligation under the defined benefit plan? What are the assets that are covered under the defined benefit plan? What kind of benefit is provided? How is the benefit computed? Right? All of these things must be disclosed, and what will be the financial effect of changes in those plans during the period. So we saw, right, if there is a change in the assumption, what will be the impact? If there is a change in the plan, then what is the impact? All of those things has to be disclosed. Coming to disclosure requirements now in detail, first one is the general disclosure. Means generally what should the disclosure have? Entity shall disclose information that explains the characteristic of its defined benefit plan and risks associated with them. So if you remember, we saw the description of different defined benefit plans, right? We saw what was the superannuation plan, then we saw what is the provident fund plan, we saw the gratuity plan, right? So you have to give the description, you have to explain what is the plan and what are the risks associated with that plan that has to be disclosed. Then we should also disclose information that explains the amount in its financial statements arising from its defined benefit plan. So basically, how much is the asset, what is the liability, what is the current service cost, net interest cost, the gain or loss on settlement, all of those things have to be disclosed. Then you have to describe how the defined benefit plan may affect the amount, timing and uncertainty of the entity's future cash flow. So basically, how will the amount affect the entity's future cash flow? What the entity might give a aging analysis, right? In the next year, how much is expected to be paid? Then in the future period, how much is expected to be paid? Then if the discount rate changes, what will happen? If the salary increase changes, what will happen? All of those things have to be disclosed so that the amount, timing and uncertainty of the cash flows is clearly explained. This is the general principle. Then the standard also says that if the disclosures provided in accordance with Ind AS 19 and other Ind AS are insufficient to meet the required objective. What is the objective? This is the objective. So after giving the information required under Ind AS 19 and also other Ind AS, maybe Ind AS 1 or related party disclosures, even after that, if it doesn't meet this objective, additional disclosures has to be provided. Now one thing you would have understood now here is, there is a requirement to disclose. The standard says this is my list. If this list does not meet the objectives, add whatever has to be added to ensure that this particular objective is met, right? So as far as additional disclosures are concerned, there could be a case where the entity might present an analysis of the present value of the defined benefit obligation that distinguishes the nature, characteristic and risk of obligation between these three. So basically, you might give a present value analysis. You might distinguish between whom? Between the active members, deferred members and pensioners. So how many members are active? For how many members the benefits are deferred? How many of them are pensioners? So you can give a segregation in this way, and you can segregate between vested benefits and accrued but not vested benefits. Means what? Vested means, let us say gratuity, 5 years is completed. How much of the obligation is towards that? The other case could be accrual is happening, means let us say an employee has completed 3 years. 3 years accrual is completed, but vesting has not yet happened. So that disclosure can be given. Or you can distinguish between conditional benefits, amount attributable to future salary increase and other benefits. So you can analyze the obligation or the benefits between conditional benefits. So something which will be paid based on future condition, that could be one case, or amount attributable to future salary increase and other benefits. So basically, how much is attributable to future conditions, how much is attributable to future salary increase, how much is attributable to other aspects, that can be segregated. So basically, give an analysis so that the users can understand the financial impact of these items in the financial statements, right? Then moving on, the entity is also required to disclose the characteristic of the defined benefit plans and risk associated with them, right? So we have understood it here. Right? Explain the characteristics of the defined benefit plans and risk associated with them. For that, what are the disclosures required? Then the amount in the financial statements, for that what are the disclosures required? Then how the plans may affect the amount, timing and uncertainty, for that disclosure is required. So right now we are seeing this particular aspect which explains the characteristics of the defined benefit plan and risk associated with them. So when we talk about information, the entity has to disclose information about its characteristics. Now what could you include in the information? Who is covered by this? What kind of benefits are payable? How is the benefit calculated? That information has to be given. So the information includes the nature of benefits, gratuity, pension, whatever is that. Then description of regulatory framework in which the plan operates. If at all the plan operates under a regulatory framework, let us say under the Payment of Gratuity Act or under the EPF Act, that has to be disclosed. Then a description of any other entity's responsibilities for the governance of the plan. Now what is the meaning of these additional responsibilities? Say an entity has created a trust. The trust has to be managed. You have to appoint trustees. The trust will not work on its own. So does the entity have any responsibility to manage the trust? That has to be disclosed. So this is the information about the characteristics of the defined benefit plan. Then you have to explain the risks. What is the risk? What kind of risk does the plan expose the entity to? Now the risk could be any unusual risk which is not factored in earlier, or any entity specific risk. So risk specific to an entity. Let us say there is a lot of agitation from the employees regarding a particular benefit plan. Now that is an entity specific risk. That risk has to be disclosed. Then coming to the next aspect, which is description of the risk. So what are the various risks that the plan exposes the entity to? Now see, some risks are general risks which are across the industry, which is understood as well. But are there any unusual risks? Are there any unusual risks which the entity anticipates that has to be disclosed? Are there any entity specific or plan specific risks? Let us say there is agitation going on that the plan has to be changed, more benefits has to be provided. So that is a risk to the entity, because if the entity agrees to that agitation, if the entity agrees to the union, then higher benefits has to be paid. So that is another risk. And any significant concentration of risk. Now significant concentration means, let us say the investments which are done by the entity are in few corporate bonds or few corporate houses. Okay, I am just giving an hypothetical example. Let us say Tata has invested 50% of the plan assets in the bonds of Reliance. Now 50% of assets is dependent on Reliance, and tomorrow if Reliance goes bankrupt, I know it doesn't happen and I pray it doesn't happen. Let's say that if that happens, then the asset worth is lost, right? The asset that the Tata Trust had invested in Reliance bonds, that value becomes zero. So is there any concentration risk? That also needs to be explained. Generally in the Indian context, considering the statutory requirement, there is a well defined criteria as to how the investments has to happen. But is there any concentration of risk that has to be disclosed? Okay, then there could be risk that some of the assets may not yield returns, some of the assets might have gone bad. Okay, does the entity foresee any kind of such risk? That has to be disclosed. Now one thing that I want to highlight here is these disclosures are based on IAS 19 as well. Okay, and in India we don't see the provident fund trust or the pension fund trust investing outside the country there, but in foreign countries we would see that lot of these pension funds, lot of these pension trust, social security trust, they invest in assets outside the country. So you would see a lot of times where you would see that some pension fund in Canada has invested in India, they have invested in highway projects in India. Okay, so these things keep on happening when you see the foreign countries, the way the funds are managed there. So you will be surprised to know that a lot of the foreign pension funds, a lot of the foreign post retirement funds, they make investments in other countries. Let's say they make investments in India. Now when such foreign investments happen, then those funds would also need to disclose, is there any investment risk that is involved, because you are investing it outside India, outside their own country, you are investing in foreign assets. Let us say tomorrow there is a rule which comes up and which says that repatriation is restricted, then there is a huge risk. So such kind of risk also needs to be disclosed. Then description of any plan amendments, curtailments and settlements. Now if you remember in the Tata example, we saw a case of a plan amendment where they they gave an option and they gave some protective rights and all of that. Such description has to be disclosed. Okay, so this is about characteristic of defined benefit plans and risk associated with them. What will you disclose here? Information of the plan, risk associated with the plan, and any description of plan amendments, curtailments and settlements. These things would be disclosed under the first category, that is characteristics of defined benefit plans and risks associated with them. Now we have seen the disclosure requirements when we explain the characteristics of defined benefit plan and also the risks associated with defined benefit plan. Now let us understand items to be disclosed when we explain the amounts in the financial statement. Now what is the meaning of explaining the amounts in the financial statement? We would have, let us say, balance in defined benefit obligation account. We will have the opening balance, we will have the closing balance. So we basically need to prepare and present a reconciliation statement. We saw this reconciliation statement in the notes to accounts of Tata Motors. We also did a few problems based on that. The same things have to be disclosed is what the standard requires. So what do we need to disclose? Reconciliation from the opening balance to the closing balance. This is one thing you need to remember. Reconciliation from opening balance to closing balance. What were the items which resulted in increase and what were those items which resulted in decrease? Then, so we have to show the reconciliation from opening to closing for each of the following. The first one is net defined benefit liability or asset. So either there would be a net defined benefit liability, that is when the obligation is more than assets, or there would be a net defined benefit asset when the fair value of plan assets is more than obligation. So one of these two would be the situation, and so you have to show the reconciliation either from the opening balance of asset to the closing balance of asset, or opening balance of liability to closing balance of liability. Sometimes a liability may become asset by the end of the period, so the reconciliation has to be given for that. Then you also have to prepare separate reconciliation for plan assets, DBO and the effect of the asset ceiling, right? So we have seen how do we prepare the reconciliation statement for plan assets, that you have to do it. For DBO, that is defined benefit obligation, present value of DBO, for that you have to prepare a reconciliation. When you combine these two along with the asset ceiling aspect, you will get the reconciliation for net defined benefit liability or the asset, right? So once you do these three, the reconciliation automatically happens. Then are there any reimbursement rights? Are there any reimbursement rights? That also needs to be disclosed. Now reimbursement may be possible from insurance company, reimbursement may come sometime from the plan itself, right? If there is any reimbursement right, that has to be disclosed separately. And entity shall also describe relationship between any reimbursement right and related obligation. So let us say there is an insurance policy which the company has taken, and the company gets a reimbursement. In that case, the company has to disclose what is the reimbursement right, and correspondingly, are there any liability towards that has to be disclosed. Then moving on to reconciliation items, you will have current service cost. We have already seen that. You have either interest income or expense. We have already seen that. Always remember, this you will calculate on the opening balance of the net asset or the liability. Then remeasurement of the net defined benefit liability or asset. So you have to show if at all there are any remeasurement related adjustments, and you have to show separately the return on plan assets excluding amount included in interest income or expense. So basically that portion of return on plan asset which has not been considered in the measurement of interest income or interest cost, that has to be shown separately. We saw an example where the return on plan asset was different from expected return on plan asset. Maybe the discount rate is 6% and actual return is actually 7%. So in that case, the difference of 1% is what will be accounted and shown here as a remeasurement gain or loss. Then actuarial gains and losses arising from changes in either demographic assumptions or financial assumptions. So whatever are the actual gains or losses, that will be classified under remeasurements. Then changes in the effect of limiting a net defined benefit asset to the asset ceiling excluding amount included in the interest income or expense. Now what does this mean? If at all we have considered an asset ceiling, the difference between the fair value of plan asset and that asset ceiling, it has to be disclosed as a part of remeasurement gain or loss. If that portion is already accounted for as an interest income, then you need not show it again, but if it has not been accounted for, then the difference will be shown as a remeasurement gain or loss, right? So what are the reconciliation item? Current service cost, interest income or expense, and remeasurement related gains or losses. Remeasurement related gains or losses would be into three parts. The first part is the return on plan assets which are not included in interest income. Second part is actual gains or losses. The third part is the asset ceiling related adjustment. Now, when it comes to the asset ceiling, the entity should also disclose how it determined the maximum economic benefit available. So, how did it determine that? What will be the maximum economic benefit available? Whether it would be in form of refunds, that is the entity will get the refund, or it will be reduction in future contribution, or a combination of both. So whenever there is an asset ceiling, and now this comes in a case where the surplus in plan assets will be adjusted either against future contribution or the entity will get a refund, right? And we have seen we will calculate the present value of that. Now, how did we arrive at this asset ceiling? How did we determine what will be the maximum economic benefit available? Whether there will be reduction in contributions in the future or there will be a refund from the plan. So that has to be disclosed separately. Then moving on to other reconciliation items, past service cost, gains and losses from settlements, right? So even this has to be disclosed separately. What are the items related to past service cost, and if at all there are settlements, the gains and losses related to arising from settlements. Then if permitted by the standard, past service cost and gains and losses, then we have seen that if there is a past service cost and correspondingly if there is a gain and loss from settlement, then the entity did not distinguish between these two, right? And if the standard is permitting that part need not be distinguished at the time of making the disclosures. Then if at all there are foreign exchange rates, what are the effects of changes in the foreign exchange rates, that has to be disclosed. Then if at all there are contribution to the plan, you have to show what is the contribution to the plan, and you have to separately disclose contribution to the plan by the employer and by the plan participants. Plan participants meaning the employees. Then payment from the plan, showing separately the amount paid in respect of any settlement. So if at all there are any payments to the plan, now payments to the plan to whom? Payments to the plan to the employees, right? So the benefit payments have to be shown, and if at all there are any settlement related payments, that has to be shown separately. And effect of business combination and disposals, that also needs to be shown separately. So basically, if you see, these are the same items that we had done in the few problems that we saw. those items has to be disclosed. Now, for you to remember in the examination, if at all they ask a theory question, it's very simple. You will have current service cost. Immediately the next item will be interest income or expense, then there will be remeasurement related gains or losses. Now remeasurement can be because of return on plan assets, it can be because of actual gains or losses, or because of asset ceiling, right? These three items. Then you have past service cost and gains and losses from settlement, then you have effects of changes in foreign exchange rates, then you have contributions to the plan, then you have any payment from the plan separately showing the settlement made from the plan, and if at all there are any effects of business combinations and disposals, right? Now what are these items? These are the items related to reconciliation. Reconciliation of what? The opening asset and the closing asset, or the opening liability and the closing liability. So far as disclosures are concerned, we saw one aspect where we describe the plan and risk in that plan. Then the second item, then the other item that we have seen is the reconciliation part or explanation of the amounts in the financial statements. Now we have seen the items related to reconciliation. Let us now understand the presentation of fair value of plan assets. How do we present that? So what the standard says is you have to disaggregate the fair value of plan asset into classes that distinguish the nature and risk of those assets. Now what do we mean by that? Basically, based on the nature and risk of the plan assets, you have to segregate them. Just don't show one single item of fair value of plan assets. Segregate them based on their nature and risk. Now the standard also requires that you have to see if it has an active market and those assets which do not have an active market. Based on that, you have to segregate. Now this you will be able to better understand with an example. So you can have different categories of segregation of the plan assets. What could those be? Cash and cash equivalent. This is very pretty simple and straightforward. Then you can have equity instruments. Again, under equity instruments, you have to segregate them by industry type, company size, geography, etc. For example, in the banking and finance sector, so much is the investment. Then in manufacturing sector, so much is the investment. In large cap, this is the investment. In mid cap, this is the investment. In the small cap stocks, this is the investment. So based on that, you have to do a segregation. Then again, same thing for debt instruments. So based on the issuer type, the credit rating and the geography, you have to again segregate them. So how much is for domestic, how much is international issued, what is issued by government, corporates, what are the categories of corporates, A plus, A minus, B, right? All of those things have to be disclosed. Then real estate, if at all the plan owns real estate, you have to again segregate the real estate normally by the geographical area. Then derivatives. So if at all a plan asset has entered into some derivatives, contract, that has to be segregated and shown separately. Generally, only a very small portion would be into this derivatives, because normally derivatives carry a much higher risk. So plans may not be allowed to invest in derivatives. Okay. So again here you have to segregate it by the type of underlying risk, for example, based on interest rate, or if it is a foreign exchange contract, or if it is equity, or if it is a swap contract, right? All of these things you will learn in detail in SFM. So based on that, you will do a segregation. Then investment funds. So if at all the plan has invested in some investment funds, you have to again show that separately and segregate them. Then asset backed securities. So if at all there are any securities which are asset backed, that has to be shown separately. If at all the plan has entered into some structured debt, that has to be shown separately, right? So this is basically an example of how should you segregate the fair value of plan assets. So you cannot just simply say the total fair value of plan assets is 100. You have to segregate them. What is in bond, what is in equity, what is in cash and cash equivalent, how much is property, all of them have to be disclosed separately. Then the standard also requires that the entity should disclose the fair value of entity's own transferable financial instruments held as plan assets. Now what do I mean by that? If the entity has issued a transferable financial instrument. Now what is this transferable financial instrument? Let us say the entity has issued some debt instruments to the plan, and the plan can transfer those debt instruments. We have seen that if it is a non-transferable financial instrument, then it will not be considered as a part of plan assets. So let us say the company has issued some debt, the plan has subscribed to the debt of the company, and the plan has the right to transfer those debt to some third parties. So let us say there is a trust. The company has issued debentures to this trust, and the trust can transfer these debentures to a third party, right? Now this debenture is a transferable financial instrument. So what is to be disclosed? What is the fair value of entity's own transferable financial instruments held as plan assets? Why is this disclosure necessary? See, we have the company. The company's debt instrument are purchased by the trust or the plan. Now what is the meaning of that, or what is the impact of that? The trust is indirectly funding the company. So the trust is giving a loan to the company. So if that is the relationship, that has to be disclosed, because there can be an element of risk. the money which belongs to the employee, which is to be held by the trust, is again being given back to the company. So, it has to be disclosed separately. Then, the fair value of plan assets that are property occupied by or other assets used by the entity. Or other assets used by the entity. Now, what is the meaning of this? Say for example, the plan has purchased land and buildings, and this land and building is being used by the company. Okay, maybe the company will be paying rent, but the company is using that land and building. So, again this has to be disclosed separately. So, this is the disclosure with related to assets. What is that you need to remember? You have to segregate them based on the nature and risk, and you have to subdivide them into those which have a quoted market price in an active market and which do not have a quoted market price in an active market, right? So, this has to be disclosed, and this is an example of how the segregation has to be done. Then, another item for disclosure is assumptions which the entity has made for DBO, which is the defined benefit obligation. What are the assumptions, right? What are the various assumptions that the entity has taken? It has to be disclosed. Now, after assets, the next aspect to be disclosed is the assumption for DBO, right? Now, what do we mean by assumption for DBO? What are the significant actuarial assumptions which have gone into when calculating the defined benefit obligation? So, an entity shall disclose the significant actuarial assumptions used to determine the present value of the defined benefit obligation. The disclosure shall be in absolute terms. For example, you have to give the absolute percentage that you have considered for, let us say, salary increases. So, you have to define that in absolute terms. And if the entity provides disclosures in total for grouping of plans, it shall provide such disclosures in the form of weighted averages or relative narrow ranges. So, if you remember when we saw the annual report of Tata Motors, let me just bring that to you. Here you can see the assumptions used in accounting for pension and post-retirement medical plans, and they have said, okay, these are the discount rate 6.1 to 6.9, rate of increase in compensation level covered 5.75 to 10%. So, such kind of disclosures have to be given, significant actual assumptions. And just some time back we saw about assets. You have seen cash and cash equivalent, debt instruments quoted, debt instruments unquoted, equity instruments quoted, and deposits with insurance company. For that they have given a disclosure or a breakup, right? So, that is the assumptions with respect to defined benefit obligation. Then the entity shall also disclose amount, timing and uncertainty of future cash flow. So, basically a sensitivity analysis. This also we had seen as a part of notes to account. What will happen if the salary increment is higher by 1% or if the discount rate changes by 1%. All of those sensitivity analysis should also be given. So, an entity shall disclose a sensitivity analysis for each significant actuarial assumption as at the end of the reporting period, showing how the defined benefit obligation would have been affected by changes in the relevant actuarial assumption that were reasonably possible at that date. So, again if you come back to the thing, right. So, here if you see, if the discount rate changes by 1%, if it increases by 1%, impact on DBO will be 92 crores. If it decreases by 1%, impact will be 127.06 crores. Similarly, the impact on interest cost and service cost, even that has to be disclosed. So, in those lines a sensitivity analysis has to be given, because these are actuarial assumptions, significant actuarial assumptions. So, if there is a change, it will definitely have an impact on cash flow. The impact has to be disclosed. Then, the methods and assumptions used in preparing this sensitivity analysis and the limitation of those methods, right. So, what were the methods used in preparing that sensitivity analysis and what are the limitation of those methods? Those have to be disclosed, and changes from the previous period in the methods and assumptions used in preparing the sensitivity analysis and the reason for such changes. So, basically if I have to summarize this, you have to prepare a sensitivity analysis. What will that sensitivity analysis tell us? If at all there is a change in the assumption, what will be the impact on DBO, what will be the impact on assets, what will be the impact on service cost. So, to summarize, the entity has to prepare a sensitivity analysis. What are the various assumptions, significant actuarial assumptions, and if at all there is a change in those assumptions, what will be the impact on the DBO as well as the service cost and interest cost. So let us say the discount rate increases by 1%. What is the impact on DBO? What is the impact on service cost? What is the impact on interest cost? That has to be disclosed. That is first part. Then, how did we do this sensitivity analysis? What was the method applied and what are the limitations of those methods? That has to be disclosed. And if at all there is a change in the method of the sensitivity analysis, that aspect has to be disclosed. So, basically the standard wants the entity to disclose how did we arrive at this employee benefit cost and what will happen if those assumptions change, what will be the impact on the obligation as well as the service cost. Now, whenever we talk about a defined benefit plan, there is an expected outflow of benefits in the future. So, the cash flow of the entity will be impacted because we'll have to make benefit payments in the future. So, what the standard requires is for the benefit payments, what will be the impact on cash flow? Are there any arrangements that the company is making or the entity is making? How will they meet future contributions? All of those things have to be disclosed. So, to provide an indication of the effect of the defined benefit plan on an entity's future cash flow, an entity shall disclose first a description of any funding arrangements and funding policy that affect future contributions. So, say for example, in the future there has to be some contribution to the plan. What is the funding arrangement for that? How will the entity fund it? Is there any funding policy that has to be disclosed? Maybe the entity may have a policy that, okay, out of the profits a specific percentage would be set aside so that in the future they can make a contribution, right? So, that has to be disclosed. Then the expected contribution to the plan for the next annual reporting period. So, in the next annual reporting period, how much is the contribution that is expected to be made to the plan? So, currently we will show in the current period, this is our liability, and in the next period, what is the estimated contribution, right? So, that part would largely be your current liability. So, how much is the contribution that the entity has to make in the next period, that has to be disclosed. And information about the maturity profile of the defined benefit obligation. Now, what does that mean? So, what is the maturity profile? How much has to be paid in this period? What is the weighted average remaining service life? Such things have to be disclosed. So, the entity will disclose weighted average duration of the defined benefit obligation and may include other information about the distribution of the timing of benefit payments such as maturity analysis of the benefit payment. So, basically aging analysis of the benefit payment and what is the average age of the benefit or the defined benefit obligation. So, let us say for example, there are 100 employees and we have to pay gratuity to all of the 100 employees. So, maybe on an average, the employees are entitled to 7 years of gratuity payment. Some may be entitled to higher amount, others may be entitled to a lower amount, but we have to give this aging analysis. So, this covers the cash flow related disclosures. Now, friends, so far whatever disclosures we have learned, the most important ones are the description, the risk related aspects, the reconciliation related aspects, and disclosure of plan assets and the actuarial assumptions or assumptions related to DBO. The ancillary discussions that we are doing, the remaining disclosures what we are doing are not very important from your examination point of view. So, you should not be wasting time in, learning them or mugging them by heart. Okay. So, what is important is this one, when you explain the characteristics, obviously the general disclosures are needed, definitely there. Then explanation of amounts in the financial statement. What are the reconciliation items? How do we present the fair value of plan assets, including the disaggregation? What are the assumptions for defined benefit obligation? And what are the, sensitivity related disclosures, right? So, these are the ones which are more important from your examination point of view. Try to read them and remember them. The things which we will be discussing now are more ancillary in nature, and I don't expect that the institute would be testing the specific of these disclosures, right? So, read it once or twice, but don't break your head in, trying to by heart these disclosures. Now, moving on to the next disclosure, which is in relation to multi-employer plans. So, if at all an entity is participating in multi-employer defined benefit plan, and we have seen the meaning of multi-employer defined benefit plan, where we have seen that an employee is not identified to a specific employer. The benefit payment, the formula for benefit payment would be common for all the employees of all participating employers, right? So, there what should be disclosed? You should disclose again the description of funding arrangements, including the method used to determine the entity's rate of contribution and any minimum funding requirements. So, because an entity is participating in a multi-employer plan, how is the funding arrangement? How will the entity fund the contribution? What is the minimum expected contribution? Those things have to be disclosed. Then, a description of the extent to which the entity can be liable to the plan for other entities' obligation under the terms and conditions of the multi-employer plan. What is the meaning of this? If at all the entity has to bear a burden or share the burden of the obligations of other entities, maybe because of changes in actuarial assumptions or because of changes in discount rates or experience adjustments, if such things arises, then what is the entity's share in that has to be disclosed. So, to what extent will the entity be liable for other entities' obligation, that has to be disclosed. Then, a description of any agreed allocation of a deficit or surplus on winding up of the plan or an entity's withdrawal from the plan. Now, what does this mean? Let us say if the plan is wound up. Now, whenever there is a winding up, there can be surplus or there can be deficit, right? You would have seen it at the time of winding up of partnership, dissolution of partnership or liquidation of companies. There can be a surplus or there can be a deficit. then in that case, how will the surplus or deficit be shared? That has to be disclosed. And secondly, if the entity withdraws from the plan, like there is a retirement of a partner, okay, so in that case also, how will the deficit or surplus be shared? That has to be disclosed. Then, if the entity accounts for the plan as if it was a defined contribution plan, now we have seen a case where if the entity is not able to get sufficient information to account for it as a defined benefit plan, then the entity will account that plan as a defined contribution plan. Now, whenever an entity is accounting for that as a defined contribution plan, then the entity has to disclose that actually the plan is a defined benefit plan. The plan is actually a defined benefit plan, but we have accounted for it as a defined contribution plan. And we also need to explain why are we accounting for it as a defined contribution plan. So, the reason why sufficient information is not available to enable the entity to account for the plan as a defined benefit plan. Then, the expected contribution to the plan for the next annual reporting period, this has to be disclosed. Then, if you are accounting for the plan as a defined contribution plan, information about any deficit or surplus in the plan that may affect the amount of future contribution, including the basis to determine the deficit or surplus and the implications for the entity. So basically, if there is any deficit or surplus, how is that deficit or surplus going to impact the entity, is going to impact the future contribution, that has to be disclosed. And an indication of the level of participation of the entity in the plan compared with other participating entities. So, what is our participation? Maybe based on number of employees, maybe based on our share of contribution. What is our extent of participation as compared to other entities? That has to be disclosed. Let's now understand disclosures for defined benefit plans that share risk between entities under common control. So, we have understood about this. There could be a common plan which shares the risk of the entities which are under common control. In that case, what are the disclosures to be given? If an entity participates in a defined benefit plan that shares the risk between entities under common control, it shall disclose first, the contractual agreement or stated policy for charging the net defined benefit cost or the fact that there is no such policy. So, basically, how is the net defined benefit cost allocated? What is the agreement for that or what is the policy for that? If there is no agreement, if there is no policy, state the fact. Then, the policy for determining the contribution to be paid by the entity. So, how do we decide the contribution which is to be paid by the entity? That has to be disclosed. And if you account for it as a defined benefit cost, meaning to say the net share in the defined benefit cost, if that is accounted by the entity, then all the disclosures we have seen above with respect to the defined benefit cost, the obligation, all of those things have to be disclosed in full. Otherwise, if the entity does not account for the net defined benefit cost, it only accounts for the contribution payable, relevant information for that has to be disclosed. So, disclosure of net defined benefit cost or the defined contribution payable as applicable. If it is defined benefit cost, full disclosures, the obligation, the assets, everything has to be disclosed in full. Otherwise, relevant information related to contribution payable has to be disclosed. If then cross-referencing to another entity financial statement can be done. What do you mean by that? Generally, if you see the annual report of any company, you will have consolidated financial statements and standalone financial statements. Now, if the consolidated financial statements has full details about the plan, then in the standalone financial statements, you can make a cross-reference to the consolidated financial statements. Now, this can be done only if the details of the plan is available and the users have the access to the other entities' financial statements. Generally, this will not be done because cross-referencing makes it more complex. Rather, bring up the relevant information and show it in the notes to the financial statement. So, these are the various disclosures that are to be done when it comes to defined benefit plan. And as I told you, this is one standard which has extensive list of disclosures. You would have seen, right, almost about an hour or so, we have been just reading out the disclosures. We have seen the disclosures given in the financial statements of the company. That is what is the depth of the disclosures required by this standard. Now, in the examination, I am repeating this again because students tend to get scared with the long list of disclosures. Don't worry about that. What you should be understanding by now is how do you show the reconciliation? What are the components of the service cost that will be disclosed, right? What are the assumptions for DBO that has to be disclosed, and the segregation or disaggregation of fair value of plan assets? How do we do that? Once you understand that, that should be sufficient for your examination. So far we have understood short-term employee benefits, which is the benefits which would be settled wholly within a period of 12 months, and these short-term employee benefits would not include your post-employment benefit or termination benefits. Then we understood about the post-employment benefits, where we understood defined contribution plans and defined benefit plans. Now we'll understand other long-term employee benefits. Now, what would be covered here? These would be the benefits which are not settled or which are not expected to be settled wholly within a period of 12 months from the end of the financial reporting period, right? So, any benefit which is not a short-term employee benefit, which is also not a post-employment benefit, which is also not a termination benefit, would be your other long-term employee benefit. Now, what could be the example of these? This could be long-term compensation absences, or there could be long service award, right, which would accrue after 5 years or 10 years or 15 years. These are not short-term employee benefits. Those are other long-term employee benefits. So, other long-term employee benefits cover employee benefits other than short-term employee benefits, post-employment benefits and termination benefits. So, if you look at the definition, other long-term employee benefits are those employee benefits which are not expected to be settled wholly before 12 months after the end of the annual reporting period, and these include long-term paid absences, these include long service or sabbatical leaves, these include jubilee or other long service benefits. I gave you an example, right? After completion of let's say 15 years, you get 15 grams of gold. And that's a other long-term employee benefit. Then it could include long-term disability benefits. For example, if an employee becomes disabled during service, then the entity may say that we will take care of you, we will pay you some amount over a period of multiple years in the future, right? So, while being disabled, the employee might work, the employee might not work, accordingly we will have to do the classification. Then there could be profit sharing or bonuses plan, which are again to be settled after 12 months. That would be other long-term employee benefit. Then there could be some remuneration which is deferred, again payable after the end of 12 months. That would be other long-term employee benefit. Now, when it comes to accounting for other long-term employee benefits, how do we do that? Is it also very complex? Yes, it is slightly complex, but the accounting would be the same that we have already learned earlier for post-employment benefits. Accordingly, you will do the accounting. Now, here only difference is the remeasurement gain or loss will not be taken to other comprehensive income. That is the only difference. To simplify the accounting, you need not transfer the remeasurement related gains or loss to OCI. Apart from that, the accounting treatment for other long-term employee benefits is same as we have learned earlier. So, you will have your service cost, you will have your net interest expense or net interest cost, you will have remeasurement related gains or loss, you will have net asset or net liability. All of those things would be there. The only thing is remeasurement related gains or losses would not be taken to OCI, it would be routed to P&L. So, for other long-term employee benefits, an entity shall recognize the net total of the following amounts in the P&L. What are the amounts? Service cost. So, whatever you have learnt as service cost, that will be recognized. Then, net interest on the net defined benefit liability or asset, and remeasurements of the net defined benefit liability or asset. All of these things will be taken to P&L. Let's now move on to the last category, which is termination benefit. Now, please note, termination benefit is a benefit which is paid to the employee at the time of termination. And now this termination covers two types. One, employer terminating the service, basically firing of employees or asking the employees to leave. And the other one is employee accepting an offer from the entity for termination of employment. Basically, the employment is coming to an end. Now, this does not include employee resigning from the services. So, if the employee resigns on his own, that is not covered as a part of termination benefit. Any benefit payable at the time of employee's resignation on his own is not a termination benefit. It would be most likely covered under post-employment benefit. But if the entity asks the employees to leave, then it would be a termination benefit. Or otherwise, if the employee accepts an offer from the enterprise, then that also would become a termination benefit. Now, when employer is asking, basically firing what we call, you would see largely in private organizations, hire and fire what they call, and the other part where the employer is making an offer and the employee accepts it, these kind of VRS schemes, what you see, voluntary retirement scheme, those are largely seen in PSU setups or government setups, okay. There could be manufacturing entities also who are adopting this, but largely this is how it is seen. Now, when we talk about VRS, basically the employer believes that, carrying this employee till the age of retirement is not fruitful to the organization, he is not efficient enough. So, the enterprise makes an offer, the entity makes an offer that, boss, you have 10 years of service left. Okay, in the next 10 years you will earn some amount of money, we'll make you a good offer, we'll give you some lump sum payment. Now you can enjoy vacations with your families, you can do things that you like rather than coming to office at this age. Why don't you take retirement, right? That is what is called voluntary retirement scheme, right? So what does termination benefit include? Termination benefits results from either an entity's decision to terminate the employment, that is the employer has terminated the employment, or an employee decision to accept an entity's offer of benefits in exchange for termination of employment. And as I told you, this does not include employee on his own terminating the employment. Now, why is it kept separately? This is kept separately because in case of other benefits, the entity receives some services in the future. Whereas for termination benefits, the entity does not receive any benefits or services in the future. It is like this is the end, the service is terminated here and we are making a lump sum payment for that. In future, the entity does not get any benefit or entity does not get any services from the employee. That is why it has been kept separately. Now, sometimes what happens is when the employee's services are being terminated either by the employer or the entity or the employee accepting an offer of the entity, apart from termination benefits, normal post-employment benefit would also be payable. For example, you will also pay gratuity to the employee whose services are being terminated. Now, is that gratuity payment a termination benefit? No, that is not a termination benefit. Gratuity payment is your post-employment benefit itself. So, you have to make a distinction as to what is the benefit that is being paid because of termination. Only that part is called the termination benefit. Other normal benefit payments like your leave encashment, your gratuity, all of those are other than termination benefits. So, for example, gratuity, it would be your post-employment benefit. Leave encashment, it would be your short-term employee benefit or other long-term employee benefit as applicable, right? So, this is the distinction that you need to make when we talk about termination benefit. Now, when it comes to termination benefit, even here, you will have to recognize an expense and you will have to recognize a liability. Now, depending on whether it is payable wholly within 12 months after the end of reporting period, in that case, you will apply the principles that you would have learned in short-term employment benefits. Otherwise, if it is to be settled after 12 months, you will apply the principles for other long-term employment benefits. Basically, if it is to be settled after 12 months from the end of the reporting period, right? So, accounting will depend on when will it be settled. But here definitely you will have an expense to be recognized and corresponding liability to be recognized. The next question that we need to address is, when should we recognize this expense and the liability? What should be the date? When should we recognize that? For this, what the standard says is, consider two dates. First date is the date when the entity no longer can withdraw its offer. The entity no longer can withdraw its offer. For example, if it is a voluntary retirement scheme, it has been offered to the employees. Employees have accepted it. Can the entity withdraw? The entity cannot withdraw that. So, the first date is the date from which the entity cannot withdraw the offers which are made to the employees. That is the first date. The other date is when the entity recognizes the restructuring related provision as per Ind AS 37. So, we have already understood in Ind AS 37 when do we recognize the liability for restructuring. So, earlier of these two dates, you will have to account for the expense and the corresponding liability. So, an entity is required to recognize a liability and expense for termination benefits at the earlier of the following dates. The first date is when the entity can no longer withdraw the offer of those benefits. So, you cannot withdraw the offer of those benefits, and when the entity recognizes cost for restructuring within the scope of Ind AS 37 and it involves payment of termination benefits. So, we have understood about restructuring related liabilities, right? So, if the entity recognizes a restructuring related liability and that includes termination benefits, then that is the date which you need to consider. So, earlier of these two dates is when you would recognize an expense and a liability. Now, coming to the first part, which is the entity can no longer withdraw its offer. Now, as far as termination benefits are concerned, we have understood two types. One, the employer terminating the employee's services on his own. The second one is the employee accepting an offer from the entity. Now, if you come to the second one, when do you think that the entity can no longer withdraw its offer? If you recollect what you learned in your Indian Contract Act, once the offer is accepted by the employee, the entity cannot withdraw its offer. So, that is one date that you need to consider. And if at all there are any statutory limit, say for example, as per the statute, the entity cannot withdraw the offer after 30 days. So, that is the date what you need to consider. So say for example, the entity made an offer on 1st of April. 30 days period expires on 30th of April. That is one date which you need to consider. And let us say the employees have accepted the offer on 20th of April itself. So, earlier of these two dates is 20th of April. This is the date from which the entity will not be able to withdraw its offer. If let us say the employees have not accepted till 30th of April, then 30th of April is the date from which the entity will not be in a position to withdraw its offer, right? So, this is how you calculate the date on which the entity is not in a position to withdraw its offer. Now coming to the first category. What is the first category? Employer himself is firing the employees. The employer himself is terminating the services of the employees. Now in that case, once the employer has communicated the plan in details, no further significant changes to the plan would be made. The employer has already laid out what are the number of employees being impacted, how much of benefit will be paid, right? Once a detailed plan is communicated to the employees, then we can say that the employer is not in a position to withdraw the plan, right? Now this is useful to determine the dates, generally will be given to you in the examination, but still, once the employer has made a detailed communication, what is the plan, what are the employees, which are the locations being impacted, what is the benefit that would be paid, if all of these details are communicated to the employees, then the employer cannot withdraw that particular plan, the employer cannot withdraw that particular offer, right? The employer cannot withdraw that particular plan. So that would be the date which you would be considering for recognizing the termination benefit. But of course, if the Ind AS 37 date comes prior to that, that is the date on which you will recognize the employee benefit expense and a corresponding liability. Let's have a look at an example on termination benefits. As a result of a recent acquisition, an entity plans to close a factory in 10 months and at that time terminate the employment of all remaining employees at the factory. So basically, because of some acquisition, an entity has decided to shut down a factory, and because they are shutting down the factory, they are terminating the services of employees after 10 months. Because the entity needs the expertise of the employees at the factory to complete some contracts, it announces a plan of termination as follows. So some services are needed, so the termination plan is announced. Each employee who stays and renders services until the closure of the factory will receive on the termination date a cash payment of 30,000. Employee living before the closure of the factory will receive 10,000. Okay, so what is the offer? Those of you who want to leave immediately, you can leave and get 10,000 per person or per employee. Those of you who can work for another 10 months and then leave the organization or leave the factory, they will get 30,000. Now, if you look at these two payments, what is the minimum payment that the employee would get on leaving the factory? 10,000. That 10,000 will be given irrespective of whether the employee renders services in the future or not, right? So the 10,000 of payment is related to termination. The extra 20,000 that the employer is paying to the employees who provide service for the remaining period, that is not related to termination. That is dependent on future services rendered by the employee. Now, what do I mean by that? If the employee works for additional 10 months, then the employee would get additional 20,000 as payment. So the way you need to distinguish is, out of the total compensation of 30,000, 10,000 is towards termination. You will get even though if you don't work further in the organization. The balance 20,000 is dependent on future service. So that 20,000 is not for termination, but that 20,000 is in exchange for service. Now, this total of 30,000 would be paid over and above the salary that the employees would be drawing, right? Now, how do we account for this? The 10,000 of termination benefit, when the entity provides a restructuring provision, at that point of time, the entity will account for 10,000 as a liability and corresponding expense will be provided. The balance 20,000 for employees who want to work in the organization for remaining 10 months, each month you will provide it as employee benefit expense. So 20,000 is for 10 months, each month you will attribute 2,000. Will there be any discounting and all of that? It will not be, because it is within 12 months. It is within 12 months and hence there will not be any discounting involved, right? So we will treat it as a short-term employee benefit. Reading further. There are 120 employees at the factory. At the time of announcing the plan, the entity expects that 20 of them will leave before closure. Therefore, total expected cash outflow under the plan is 32 lakhs. Now, how did we get to this 32 lakhs? 20 employees into 10,000, that is 2 lakhs, and for balance 100 employees, 30,000, that is 30 lakhs. Total payment is 32 lakhs. Now, how will we account for this? 10,000 for 120 employees is termination benefit. So 120 multiplied by 10,000, that is 12 lakhs. This 12 lakhs is termination benefit. You will have to provide for an expense. You will recognize an expense and a liability immediately, right? When you decide to, carry out this restructuring activity. The other part of 20 lakhs, that is basically 100 employees and 20,000 per employee. This will be spread over 10 months period. For each month of service, you will provide an employee benefit expense, that is a short-term employee benefit of 2 lakhs, and you will create a liability for 2 lakhs. Finally, when you settle it, you will knock off the liability with a corresponding payment, right? So, this is how you need to carry out a distinction. What part is termination benefit? What part is benefit pertaining to services to be rendered in the future, right? So, accordingly, you will have to do the accounting for it. So, here 12 lakhs will be accounted for immediately. You will create a liability and you will provide for an expense. The balance 20 lakhs will be spread over the 10-month period. No discounting is needed because it is to be settled within 12 months. Now, with these discussions, we have covered the various aspects of Ind AS 19. Now, what we are left with is understanding Appendix B, which is given as a part of Ind AS 19, and also the differences between AS 15 and Ind AS 19. Now, coming to Appendix B, what does Appendix B talks about? What does it deal with? Now, friends, if you recollect, we discussed something called asset ceiling, right? Asset ceiling was a case where the fair value of plan assets was greater than the defined benefit obligation or the present value of defined benefit obligation. That surplus was subject to a ceiling. So, say for example, if the fair value of plan asset is 1,50,000, the present value of defined benefit obligation is 1 lakh, we had a net surplus of 50,000. Now, that is the total value of net asset which an entity would normally recognize in its books. Now, when we were discussing this surplus, we also discussed about asset ceiling. There could be a case where the entire 50,000 may not be available as benefit to the entity, right? Maybe because of time value factor, maybe because of the full amount not being refunded. There could be multiple reasons. So, we introduced a concept called asset ceiling. So, say for example, the economic benefits that will be attributable to the surplus is only 40,000. So, what the standard said was, you have to recognize the net asset at 40,000 only and not at 50,000. That 40,000 is nothing but the asset ceiling. Now, this appendix gives us guidance as to how do we account and value for this asset ceiling when there is a refund, when there is a reduction in contribution in the future, and in cases where there are minimum future contribution requirement. Now, what do I mean by that? Say for example, there is a surplus in the plan. But even though there is a surplus in the plan, the entity may have a liability to make minimum contributions in the future. In that case, how do we value the asset ceiling? That is what is explained by Appendix B. Now, if you look at the appendix, it's quite lengthy and quite elaborate, but as far as examination is concerned, if you are clear with few concepts and how should we apply that appendix, that is sufficient. So, don't get scared again here that there are so many pages, so much of literature, I have to remember everything, nothing like that. You just need to understand what is the concept of asset ceiling that we have already understood. Then we need to understand what will happen if there is a refund available, what will happen if there is a reduction in contribution, and what will happen if there are minimum contribution liability on the entity, right? In these three cases is where we have to understand these aspects around asset ceiling. Now, let's have a look at the first aspect, which is a right to refund. Now, friends, a right to refund exists only if the entity has an unconditional right to refund. Unconditional meaning there are no future conditions to be fulfilled. Whatever is the surplus, either the entire surplus or a part of that surplus or maybe a fixed amount will be refunded from the plan. So, when I say the plan, it could be the trust here, from the plan to the entity. That is when we say there is a right to refund. Now, how do we measure the asset ceiling in case of right to refund? In that case, we have to see what will be the economic benefit. So, what the standard says is, if the refund is of the full amount or is defined as a proportion of the surplus, then in that case, whatever is the proportion of surplus, that should be considered as the economic benefit available to the entity. So, say for example, the surplus is 50,000. As per the plan, 60% will be refunded to the entity, 60% of the surplus. What is 60% of the surplus? 30,000. This 30,000 will be the asset ceiling what the entity determines. Now, the question is, if this 30,000 will be received after some period, then do we consider time value of money? What the standard says is, if the entire surplus or a part of the surplus is being refunded, then don't consider time value of money. Now, what could be the reason for that? See, today the surplus is 50,000. Even if they don't do anything, will this surplus not increase in the future? It will definitely increase in the future. So, in the future, the entity may get a higher surplus as refund. The entity may get a higher surplus as refund. So, even if you apply the time value of money, you will again come back to the same 30,000, right? So, that is the logic which you can remember to understand why when there is a surplus or a proportion of surplus, you do not apply time value of money. But if it is a fixed amount, let us say the plan says out of the surplus, the fixed amount of 10,000 will be paid over the next 5 years as refund. In that case, you will definitely apply the time value of money, right? But generally, whenever there is a case of refund, it would be mostly defined as a percentage of the surplus, right? In that case, you will not apply time value of money. And please note, the refund has to be unconditional. If the refund depends on one or more future events, then it is contingent, it is not unconditional, and hence we cannot say that the refund is unconditional. So, what you need to understand, when there is a right to refund, that right to refund has to be unconditional. The right to refund has to be unconditional, and if it is of the full amount or a proportion of the surplus, then you will not apply time value of money. If it is a fixed amount being refunded, then you will apply time value of money. Now let's move on to the second category, where there would be reductions in future contribution, and also this is a case where there are no minimum future contributions requirement, right? So basically, if there will be a reduction in future contributions, then how should we measure the economic benefit? What the standard says is, the economic benefit is nothing but the future service cost. The economic benefit is nothing but the future service cost. So whatever is the future service cost which is getting reduced, that will be the economic benefit, and you will calculate the present value of that to arrive at the asset ceiling. As simple as that, right? So here, how will you measure the future service cost? The way you are measuring the current service cost, using the same assumptions, using the similar plan benefits, you will also measure the future service cost, and to the extent the future contributions are being reduced, that is what will be the economic benefit to the entity. Let's now look at the last aspect, which deals with the minimum funding requirement, and that is what the guidance is all about. Now, what is this minimum funding requirement? Now, in case of some plans, there may be a condition that the entity has to contribute a minimum amount to the plan irrespective of the obligation. Say for example, the plan says that every year 1 lakh has to be contributed to the particular plan. Now, is that 1 lakh required or not? Is there an obligation of 1 lakh? That is irrelevant. The obligation may be only 50,000, but still 1 lakh has to be contributed to the plan. Now, if these kind of arrangement exist, we call it as a minimum funding requirement. So, even though a plan may have a surplus, say for example, a plan has a surplus of 5 lakhs at the end of year 1, but in year 2, the entity has to make a minimum contribution of 1 lakh even though there is a surplus. So, the entire surplus may not be available immediately to the entity. See, if there is no minimum contribution requirement, whatever is the future service cost, that is the economic benefit available to the entity. Say for example, the future service cost is 1,50,000. The surplus already is 5 lakhs. If there is no minimum contribution requirement, the entire 1,50,000 will be your economic benefit. But say 1 lakh of minimum contribution is required, then how much is the economic benefit? 1,50,000 minus 1 lakh, 50,000 is the economic benefit for the next year. Similarly, you will have to calculate economic benefit for the future years and arrive at the present value to determine the asset ceiling. It's a very simple and logical way of explaining. I don't know why did they add it to the appendix in such detail. It is very simple approach. That is, what will be my reduction in contribution in the future? To that extent, I will have the benefit from the plan, and that will be my asset ceiling. Now, sometimes what the entity may do is they may do some prepayments which will reduce the future minimum contribution. That is to say, in our example, there is a minimum contribution requirement of 1 lakh. But let us say the entity has done a prepayment for this in the current year itself. Then, in the next year, what will be the economic benefit? 1,50,000 of the future service cost, and because you have already done the prepayment of minimum funding requirement, there is no need to pay that amount again. So, entire 1,50,000 will be the economic benefit which is available, right? So, this is how you will calculate the economic benefit, arrive at the present value and determine the asset ceiling. Now, sometimes there may be an obligation on the entity to make certain minimum contribution because of past service, maybe because of plan amendment. The plan now requires that even for past service, some minimum contribution has to be done. Now, if that is the case, then whatever is being paid for the past service, whatever is the amount of contribution that is payable, the entity has to check whether any refund will be available in the future. If refund will not be available in the future, then the entity will have to recognize an obligation to that extent. So, if something is for the past, you have to check whether in the future you will get a refund of that. If refund is available, then there is no obligation, but if refund is not available, then there is an obligation on the entity. To put it very simply, what you need to do is, from the surplus that is available in the plan, you have to check what is the present value of the future economic benefits. What is the present value of future economic benefits? Now, there will be a lot of adjustments, plus, minus and all of that, but this is the crux of the discussion. Based on that, you will arrive at the maximum amount of surplus that you will be disclosing in the balance sheet as a net defined benefit asset. Let's now have a look at the significant differences between AS 15 and Ind AS 19. Now friends, you have not learned AS 15 at your CA intermediate level, right? No need to worry about that. You just need to understand what are the major differences. And largely both the standards are on similar lines, just that Ind AS 19 has few more guidance on some specific aspects, and there are few accounting treatment which are different in Ind AS 19. You don't need to go back and understand what is AS 15 all about, that is not needed. So we'll look at what are the major significant differences between AS 15 and Ind AS 19. The first difference is with respect to constructive obligation. Now accounting standard, the Indian GAAP what we had earlier, they don't largely deal with constructive obligation, okay. Though because of a constructive obligation you may recognize a liability, but standards do not specifically deal with that. When we talk about Ind AS 19, it specifically covers benefits arising out of constructive obligation. AS 15 does not cover that. And when it comes to definition, there are few differences in definitions as well. The first difference is in the term employee, Ind AS 19 covers the term directors, whereas AS 15 specifically includes whole-time directors. See, even though AS 15 mentions whole-time directors, if there is a regular director who is an employee, that also will be covered. Whereas as far as Ind AS 19 is covered, all the directors are included in the definition of employees. Then there are slight differences in the definitions of short-term employee benefits, other long-term employee benefits, and past service cost, right? We will not get into details of what are those differences, but there is some difference in this particular aspect as well. Then Ind AS 19 covers contractual agreement between a multi-employer plan, that is covered. Then it also covers participation in defined benefit plan which shares risk between various entities under common control. These two are covered in Ind AS 19. It is not covered specifically in AS 15. Then one major item of difference is with respect to recognition of past service cost. If you remember friends, past service cost is recognized immediately in the statement of P&L, right? There is no concept of deferral, whereas under AS 15, deferral of past service cost was allowed just to ensure that the entity does not get a big hit because of a one-time past service cost. In fact, even in US GAAP, deferral is allowed. You have to do a deferral. So as per AS 15, an enterprise recognizes past service cost as an expense on a straight line basis over the average period until the benefits become vested. To the extent that the benefits are already vested, following the introduction of or changes to the plan, an enterprise should recognize past service cost immediately. So there are two aspects. For vested benefits, recognize past service cost immediately. For non-vested benefits, you defer it and amortize it over the remaining life of the employees. That is what is the treatment given by AS 15. Whereas, as far as Ind AS 19 is concerned, it does not make a distinction about what is vested, what is not vested. Whatever is the past service cost, everything will be recognized in the P&L in the same period. Then when it comes to actual gains or losses, Ind AS 19 requires that actual gains and losses should be recognized in OCI, whereas AS 15 requires that actual gains or losses to be recognized in P&L. Now that is but obvious because under the Indian GAAP, which is the accounting standard series, when we prepare financial statements, we do not have a segment called other comprehensive income. Then when we talk about discounting rate, we have specific guidance in Ind AS 19 as to how do we deal with operations or foreign joint ventures or divisions which operate in a foreign country. What should be the discounting rate? There is a guidance available in Ind AS 19. AS 15 just mentions that the discounting rate should be with reference to the government bonds. Then we have a couple of appendices in Ind AS 19 which gives us guidance as to how do we account for contributions from employee, how do we account for asset ceiling when there is a minimum funding requirement. Such guidances are not available as a part of AS 15. Let's now quickly summarize whatever we have learned in this standard. Now as I told you earlier, this standard appears to be lengthy, lots of disclosures, lots of theory, but if you understand the concept, handling problems in the examination will not be a difficult task, right? As far as Ind AS 19 is concerned, it covers employee benefits, and there are 4 types of employee benefits which are dealt by this standard. What is the first one? Short-term employee benefit, which are expected to be settled wholly within 12 months from the end of the reporting period, right? That is what is short-term employee benefits. Then we had termination benefits, which is payable at the time of termination of employment. Then we had post-employment benefit. What are these post-employment benefit? These are the benefits which are payable post completion of employment by the employee, right? So after the employment is over, whatever is the benefit payable, that is what is called post-employment benefit. A difference between termination benefit and post-employment benefit is that as far as termination is concerned, any benefit arising out of termination, that is called termination benefit. But let us say we pay gratuity to an employee who is being terminated, that is a post-employment benefit. And lastly, the residual category is other long-term employee benefits, which are neither short-term employee benefits nor post-employment benefits nor your termination benefits. Those are classified as other long-term employment benefits. Now, amongst these four, as far as the short-term employee benefit is concerned, a very simple way of accounting, you will recognize an expense, and if the amount is not paid, you will recognize a liability. There will not be any discounting involved. A simple accounting treatment, nothing complicated, right? In the short-term employee benefits, another important aspect that we discussed about was short-term paid absences. Now, what are short-term paid absences? Employees take absences or employees take leaves, but the employer has to pay them, right? Now, accounting for this was pretty simple. You have to classify them into whether they are accumulating or non-accumulating. Non-accumulating means leaves for a current year has to be taken in the current year. If the leaves are not taken, they get lapsed. In the future, employee will not get additional leave because they have not taken leave in the first year, right? Those are called non-accumulating, and there is no specific accounting for this, for the simple reason being that there is no carry forward of leaves, and because there is no carry forward of leaves, neither the employer is liable to make, provide some benefits in form of leaves or in form of payment, nor the employee has a right to take those leaves. So if they are lapsed, they are lapsed. If they are taken, they are taken. No specific accounting for this or no special accounting for this. When it comes to accumulating, you have to see whether they are vested or non-vested. Vested meaning they can be encashed. This is different from the vested we learned in the vesting of plans. Okay. Now, when it is a vested absence, the employer has an obligation. What is the obligation? The obligation to pay some amount in the future because the employees have not taken leaves. What is non-vested? In case of non-vested, also the employer has an obligation not to pay an amount but to give leaves to the employees in the next period. Now, when they take leaves in the next period, obviously they will not work. So, employees would anyways get paid for that leave period. And indirectly, the employer is providing benefit to the employees in the future, right? We have taken a detailed example to understand as to why both in case of vested as well as non-vested, we are saying that the employer has an obligation. What is the obligation? In case of vested, payment has to be done, that is an obligation. In case of non-vested, employees will take leave, and even though employees have taken leave, employer has to make the payment, right? And how do you do the accounting for these? Because these are accumulated paid absences, whatever is the balance of paid absences at the end of the period, based on that average salary, based on the average leaves which the employees would take, based on that we will create a liability, and we will also provide for employee benefit expense. Now, one difference between vested and non-vested is, as far as vested is concerned, for the entire balance you will have to provide for the expense, whereas in case of non-vested, employer will create a liability only to the extent employees are likely to take leaves. For example, if there are 10 vested absences, then for the entire 10 days you will have to create a liability. But let us say if there are 10 unvested absences and employees are likely to take only 4 absences in the next year, then you will create a liability only for those 4 absences and not for the entire 10 absences, right? This is about short-term paid absences. Then when it comes to termination benefit, even in case of termination benefit, you will have to recognize what is the expense on account of termination, and the corresponding liability will be recognized, right? If at all termination benefit is payable beyond 12 months, then you will involve the discounting factor. The most complex part of the standard is the post-employment benefit. Now, what are covered under post-employment benefits? We have the defined contribution plan and defined benefit plan. As far as defined contribution plan is concerned, the contribution is defined and the employer does not bear any actual risk on account of any future shortfall. So, you pay a contribution, a fixed amount or a determined amount of contribution. After that, the employer does not have any further liability. The best example for this is a provident fund contribution. Employer contributes 12%. After that, the employer is not worried about it. The other category is a defined benefit plan where the benefit is defined. You have a formula for the benefit, and the best example for this is gratuity, 15 days of salary for every completed year of service. Now, there the employer has the actual risk. If at all there is a shortfall, the employer has to pay from his or her own pocket, right? So, when it comes to a defined benefit plan, what is defined? Benefit is defined, actual risk is retained by the employer. When it is a defined contribution plan, the contribution is defined and actual risks are not retained by the employer. Again, contribution plan accounting is simple and straightforward. Whenever the obligation to pay contribution arises, the entity will recognize an employee benefit expense and credit the contribution payable. When it comes to defined benefit plan, there is a lot of complications and calculations involving actuaries. Then we understood about various aspects around a defined benefit plan. We understood what is the defined benefit obligation and what is its present value, what are plan assets, what is deficit, what is surplus. Let us quickly recap them as well. So, the present value of a defined benefit obligation is the present value without deducting any plan assets of expected future payments required to settle the obligation resulting from the employee service in the current and prior period. So, this present value of defined benefit obligation is nothing but what is the present value of the obligation which is attributable to current periods and the prior periods as at the end of the reporting period. That is what is your present value of defined benefit obligation or the liability part. Then we also understood about plan assets. What are plan assets? They are assets which are held by long-term employee benefit fund and qualifying insurance policies, right? So we understood these two terms. So on one side you have a defined benefit obligation, the present value of that, and on the other side we have fair value of plan assets. You compare these two. If the present value of defined benefit obligation is higher, it is a deficit. If the fair value of plan assets is higher, it is a surplus. If it is a surplus, you will show a net defined benefit asset. If it is a deficit, you will show a net defined benefit liability in the financial statements. Then one thing that you need to keep in mind is whenever we show a net asset, it has to be restricted to the asset ceiling. Then we also understood about service cost. What are service cost? Service cost comprises the current service cost, the past service cost, and any gain or loss on settlement. What is the current service cost? Current service cost is the increase in the present value of defined benefit obligation because the employee has rendered service in the current period. So whatever is the increase in the DBO which is attributable to current service is called current service cost. What is the past service cost? Past service cost is the increase in the present value of defined benefit obligation because of either an amendment to the plan or because of some curtailment, right? Because of some changes in the plan, there is a cost which is arising because of past service. If the cost arises because of current service, it is the current service cost. If it arises because of past service, it's a past service cost. So, what is the past service cost? It is a change in the present value of defined benefit obligation for employee service in prior periods resulting from a plan amendment, that is you have introduced a plan, you have withdrawn a plan, or you have made changes to a plan, or curtailment, you have significantly reduced the number of employees covered by the plan. That is what is the past service cost. It could be a gain, it could be a loss as well. And now the service cost also includes gains or losses on settlement. What is a settlement? It is a transaction that eliminates all further legal or constructive obligation for part or all of the benefits provided under a defined benefit plan other than payment of benefits to the employees that is set out in the terms of the plan and included in the actual assumptions. So basically what does it mean? When you are settling a plan, then as on that date you would have agreed upon some terms. Based on that terms you will be making some benefit payments, but in the future there is no legal or constructive obligations to provide additional benefits after the settlement has been done, right? And when we do a settlement, there could be a gain or loss which is recognized as a part of service cost, and service cost is recognized in the P&L. So now we have the present value of DBO, which is the liability part, then we have the fair value of plan assets, which is the asset part. You present them on a net basis. Now on this net amount, there is a net interest. There is a net interest. Now that net interest can be an interest cost or it can be a return. It depends on whether there is a liability or an asset, right? So on the liability, you have an interest cost. On the asset, you have a return on plan asset. For this, you will use the discount factor only. Even though there would be different rates of expected returns, actual returns and all of that given, you will consider only the discounting factor to calculate the net interest cost. And where will you recognize the net interest cost? You will recognize the net interest cost or net interest income in the P&L. Then what about the difference between the interest rate applied and the actual return on plan assets? That will be taken to your remeasurement gain or losses as a part of OCI, right? So the next component is your remeasurement of defined benefit liability or asset, right? Now that can be out of actual gains or losses, which is with respect to the defined benefit obligation, the return on plan assets excluding the amount included in the net interest on the defined benefit liability or asset, which is to the extent you have considered return in the net interest, that you can ignore. Whatever is left over that will form part of your remeasurement gains or losses. So this generally we used to understand it as actual return versus expected return. So say 6% is the discount rate, actual return is 10%. 6% will go into the calculation of net interest, whereas the balance 4% will be your remeasurement gains or losses. And the third component of the remeasurement is any change in the effect of the asset ceiling. So because of asset ceiling, if there is any remeasurement required, that also forms part of your remeasurement gains or losses. And where do we take this remeasurement gains or losses? We take it to the other comprehensive income that will not be reclassified to the P&L. You will never take it to the P&L. It will be shown as a part of other comprehensive income. Now, in the entire discussion of defined benefit plans, we discussed a lot about actuaries. We talked about actuarial assumptions, we talked about actuarial gains and losses. What are these actuarial assumptions? See, when you have to calculate or estimate what will be the benefit payable in the future, for that we'll have to make certain assumptions. These are done by actuaries. It could be a demographic assumptions or it could be a financial assumptions. Demographic meaning something to do with the age, average age to retirement, resignations from the employees, all of those things are demographic. Then financial assumptions, what will be the increase in salary, the inflation rate, the interest rate, something to do with the financial numbers, those are financial assumptions. These assumptions are built in to estimate the benefit obligation which would be paid to the employees after the employment, right? And these actuarial assumptions keep on changing. It could be because the actuals turn out to be very different, which we call as experience adjustments, or there could be certain changes in the assumptions themselves, right? Now, because of these changes, there may be gains or there may be losses. Those are considered as remeasurement related gains and losses, and those are taken to OCI. Coming to calculations of amount for defined benefit plan, the method we follow is the projected unit credit method. Now, what does this method talk about? This method talks about for every unit of service, there is a benefit attributable. So, what the actuary would do is, they would estimate the benefit payable at the end of the employment, and that would be attributed to each of the years. So, say for example, there is a benefit which is payable of 1 lakh at the end of 10 years and the employee is expected to serve us for 10 years, and based on this, each year 10,000 would be attributed, right? Now, this 10,000 of attribution is called projected unit credit method. That is, each unit of service will entitle the employee to some benefits in the future. Now, do we do the accounting based on 10,000? No. We calculate the present value. And based on that present value, we arrive at the current service cost, right? And as time passes, we also provide interest cost, and at the end of the period, the amount reaches to 1 lakh, which will be paid to the employee, right? So this is how the projected unit credit method works. We have already done a problem on this where you have understood how do we attribute the final benefit payable to each year of service, and we will discount that, we will provide for interest cost, we will provide for current service cost, and based on that we will do the calculations, right? This is one aspect which you need to remember, that we follow the projected unit credit method. And when it comes to the presentation in the financial statements, what you need to understand is what is the obligation part and what is the asset part. So, when we have the obligation, what is the opening obligation? And what would result in increase in obligation and decrease in obligation? So, you will have opening obligation. What will increase the obligation? Your current service cost, that will increase the opening obligation. Your past service cost will increase the obligation. If there is any loss on settlement, that will increase the obligation. If there is any gain on settlement, that will decrease your obligation. Then interest cost will increase the obligation. If any benefits are paid to the employees, then your obligation would come down. So benefit payment would reduce the obligation. Then if there are any actuarial losses, it will increase the obligation. If there are any actuarial gains, it will reduce your obligation, right? So like this, you will have to start from opening obligation, prepare, adjust for each of these items, and arrive at the ending obligation. Similarly, when it comes to the assets, you have opening balance of assets. Whatever is the return that you get, that will increase the obligation. Then if there are any contribution made to the plan, that will increase the asset value. If there are benefit payment, it will reduce the asset value, and you will arrive at the closing balance, right? Now, in examination, you can prepare obligation, asset and net amount, or after some practice, if you can directly prepare based on the net amount, that is also perfectly fine. But if they ask you to specifically prepare the reconciliation of both assets as well as the obligation, you have to prepare them separately. Then what you also need to understand is, out of these items, what are the items which would go to P&L and what are the items which would go to OCI. In OCI, you will take remeasurement related gains or losses, that is your actual gains or losses, expected versus actual return on plan assets, and any impact of asset ceiling. The current service cost, the past service cost, the interest cost, all of these would go to your P&L. You will recognize them in the P&L as your defined benefit cost. Then we also talked about the presentation related requirement. So if it is a surplus, you will present it as a net asset. If it is a deficit, you will present it as a net liability. And if the question asks you to compute service cost or current service cost or defined benefit cost, you have to be careful as to what is to be computed. If it is service cost, then you have to calculate the current service cost, the past service cost, and the gain or loss on settlement. If they ask you to calculate the defined benefit cost, then you'll also need to include the remeasurement related gains and losses. You'll also need to include the interest cost in that matter, right? So it depends on what is the question asking, and based on that you can give your calculations, right? Then we discussed in detail about the various disclosure requirements. Again, give a couple of reading to that. No need to be worried about too much of details of disclosures, but make sure that you are perfect in the reconciliation aspect. How do we take the opening balance and how do we arrive at the closing balance? That is what you should be perfect at, right? And again, as I told you, it is more logical. What will increase the obligation, what will increase the asset, what will reduce the obligation, what will reduce the asset. Once you practice a couple of problems, you should be thorough with that, right? This was about the defined benefit plan in a nutshell, right? It's a very, this is a quick summary of what we have discussed on defined benefit plans. I think we have spent close to about 4 to 5 hours only on that topic. This is just a quick recap of whatever we have learned, right? Then we also understood about other long-term employment benefits, and here the accounting is pretty similar to post-employment benefits under the defined benefit plan. Only difference being there is nothing which will be taken to the OCI. Everything will be routed through your P&L only, right? That is what is about other long-term employment benefits. Then we also spoke about termination benefits and how do we recognize and account for termination benefits, right? So this is the summary of Ind AS 19, and what you need to be very clear about is the defined benefit plan. That is where questions would be mostly tested in the examination, and that would where students would make mistake and get unnecessarily scared about the defined benefit plans. So with this, we have come to the end of Ind AS 19 employee benefits. One of the tricky standards, but I would not put it as a difficult standard, but again highly scoring as well. There are only limited type of questions which can be tested from this standard. So if you are thorough with the questions what you have done in the class, that should be more than sufficient. Be clear with your concepts, and to address this standard in the examination, it will not be a tough task.